and they're going to have to prove they can get through it on their if you will.
I think the analyst cuts are important, right? Because when you've got that kind of sentiment that
they say that additional board change is needed to provide shareholders with sufficient confidence in the sustainability of Exxon's business, an immediate concern, and one that should arguably take precedence in the order of operations over an assessment of the general sustainability of the industry. Give me your response to what we've heard this morning from ISS.
Well, good morning, David. It's good to be with you. And obviously, we disagree with that recommendation. If you look at our board, we've got one of the strongest boards in corporate America, one that we have been refreshing fairly regularly since I came in 2017. We've brought on 6 new board members. That's over half the board. We've got board members that have extensive experience running global complex businesses, capital-intensive businesses, businesses that are grounded in science and technology, a lot of experience in managing companies, large companies, through significant transitions. We've got shareholder perspective, industry perspective, a lot of capital allocation perspective. So we feel very strongly that we have the board in place to help manage this company, not only drive success in today's environment, but position the company for longer-term success as the industry transitions. And I think we're seeing that actually with the results of the first quarter as we managed through the pandemic period. And we see the results of the work that we did last year and the work that we've been engaged in since 2017 in reshaping the business, investing in high return projects, driving simplicity in our business, gaining synergies, and reducing costs. And all those are coming together today. We're seeing those in our first quarter results, and quite frankly, feel very good about the future that lies ahead of us.
Yeah, and we've had a bit of that conversation, of course, when you joined us not that long ago, and I want to talk more about that. But on this specific fight, because that's kind of what it is. I mean, when they say ExxonMobil, to your point, or at least about the experience of the board, has for years filled its board with former CEOs without any energy experience, which does seem to be at least behind some of this ISS recommendation. How do you respond to that?
I think the challenge in this space is understanding the technology that's going to be required to drive the industry forward and to support society's ambition to transition the energy system to a less carbon-intensive energy system. So there's I think, a lot of work in terms of thinking about the company, the advantages the company has, the strengths we have, and how we apply those to successfully transition the company as society moves to a lower carbon future. And frankly, the board that we have today has a good understanding of that, understands the complexity associated with moving a business like ourselves through that transition. And as I said, if you look at the plans that we've laid out, the technology that we've been investing in to address the sectors in society that are hard to decarbonize, we've got a very good plan, a very good technology pipeline to address not only the challenges today, but the challenges that we see coming forward in the future.
Well, let's get to that. I mean, the last time you joined us, of course, we did spend a decent amount of time talking about carbon capture. I had that conversation as well with your board member, Jeffrey Ubben, not long ago as well. But, specific, Darren, to some of the criticism still, for example, Engine One says, even by your own limited standards, you've actually gone backwards when it comes to upstream emission intensity. They say ExxonMobil has gone backwards, aims to do worse in 2025 than 2010. Upstream emission intensity has worsened over the last decade, increasing 26%. Put that in perspective for people so that we can understand at least your perspective on that statistic.
Well, we've been very supportive of the efforts globally and within the industry to reduce our carbon intensity and carbon emissions. If you look at the progress the company's made since the Paris Agreement has come out, which we supported at the time it came out and supported it, has been very vocal in our support since then. We've reduced emissions through 2020 from 2016 by 11%. We've got plans in place today that drive emissions down even further and frankly put us on the path consistent with the Paris ambitions and the less than 2 degrees C scenarios. And so I think we've done a lot of work to reduce emissions. More importantly, if you look at what's going to be required for society to achieve the Paris ambitions, there are a number of sectors in the economy, critical to the economy and critical to people's lifestyles, that are going to be very hard to decarbonize, that today don't have solutions. We have been working for decades on technologies and the technologies required to address those hard to decarbonize sectors to help society achieve that lower carbon vision. And so I would tell you that that work that we have been doing is starting to pay off. You know that we've recently announced a very large opportunity in Houston that can make a significant contribution to the Biden administration's recent announcements of significantly reducing CO2 emissions, make a significant contribution to Houston reaching its net zero by 2050 emissions target. And so I would tell you, we've been doing the work within our own operations to reduce emissions and doing the work required by society to help them reduce their emisins.
All right, Darren, I actually want to talk about energy for a second.
Sure, Jim.
Switch
Good morning.
things up. Good morning. Permian. I don't understand it. You have $64 price of oil. I think you guys generally have been cutting back on your drilling plans. To me, I got a feeling you could make a fortune here, Darren. It's $60. Come on, let's bring it on.
We've made very good progress in what we've been doing in the Permian. And actually, we are at a fairly steady state with what we're doing in the Permian. Last year, as you know, Jim, with the pandemic, the drop in prices and revenue, we had to pull back across the board on a number of our investments. But we maintained a level of spend and investment within the Permian to make sure that we're continuing to progress the technology advances that we feel like we can achieve in that to lower the cost, become more productive. We're seeing the results of that. In fact, I shared that in our first quarter call. Great success at improving the Permian production, and our plans today grow our production in the Permian. You know that one of our priorities is rebuilding the balance sheet, which we leaned on pretty heavily last year. And so right now, we've got a good pace of production in the Permian, making good progress on that operation. And as we continue down that path and generate more cash like we did in the first quarter, we'll use it to pay down the debt, make sure the company's in a very good position to face whatever the future holds and whatever the commodity cycle does to us.
Yeah, we had a similar conversation yesterday with Pioneer Scott Sheffield.
Yeah.
Scott Sheffield. Darren, back to carbon capture, because it is such an important component, at least of what things people perhaps want to hear, certainly those who may not be ExxonMobil shareholders as yet, and the criticism that you've received from from Engine One. Again, I'd love you to respond. You know, when they say you've trumpeted carbon capture, but your actual carbon capture has changed little, and your projects to reduce Scope 3 emissions are incredibly costly and prone to failure and heavily dependent upon government subsidies, and therefore unlikely to enable you to avoid transforming your business model. Even the most advanced carbon capture, unlikely to enable you to avoid transforming your business model over the long term. Again, your response.
That is not.
He is not choosing not to respond.
Right. That's like it's not the empty chair, and it's not the fifth.
We lost the connection.
That's a great question. Because it's
Darren, we're going to try and get him back.
What you hear that it's $100 billion project, right?
Right.
That's a lot of money.
Right. Right.
I mean, even for this administration throwing around trillion here, trillion there, $100 billion is a lot of money.
It is an awful lot. Are we going to be able to reestablish contact with Mr. Woods? We're trying to do that.
David, meanwhile, some of the people, I would discard them as anti-energy. That
the people who are the nominees.
Yeah, anti-energy.
You know, given they already added 2 members to the board, as we know, Mike Angelakis and Jeff Ubben, as a result of some of the actions undertaken by D.E. Shaw, this hadn't gotten as much attention, but this ISS move this morning could perhaps put more attention on it.
David, it would tip it so that the people would be against carbon. This is Exxon.
Let's take a quick break, see if we can reestablish connection with Darren Woods. We'll be right back. Welcome back to Squawk on the Street One. We've reestablished contact with Darren Woods, although via telephone. Darren, we look forward to the day when you will join us in person. We won't have to deal with any potential issues, but certainly wanted
I look forward to that as well, David.
Yeah, certainly wanted to finish up. So I'd asked, of course, again about this criticism in terms of carbon capture and your real efforts there, and basically whether or not even what your critics would say, even the most advanced carbon capture, highly unlikely to enable you to avoid transforming your business model over the long term. How do you respond?
Yeah, I would say, David, that's one of the unfortunate things with our discussions with Engine One and their refusal to sign an NDA and allow us to spend some time taking them through our plans, our strategies, and some of the technologies that we're working on. Frankly, any credible independent body will tell you that carbon capture and storage is a critical element for the world to achieve the Paris ambitions. The IEA, the UN's IPCC, the Intergovernment Panel on Climate Change all recognize the importance of carbon capture and what that's going to play with respect to reducing emissions in society. As a company, we have decades of experience operating and investing in carbon capture. We know that technology very well. We launched a venture 3 years ago to look at, one, commercializing new carbon capture technologies that we're developing, but two, to look for opportunities around the world where we can use existing technology to reduce carbon capture and storage. And that's behind the proposal that we have begun discussing with the administration in Houston. I would tell you the cost of that project is we can reduce significant amount of CO2 on the order of 100 million tons per annum by 2040. We can protect jobs in industries that are currently making products and helping support people's livelihoods and modern life. And we can create new jobs, build infrastructure, and do that at a cost that's anywhere from a half to a quarter of what the government is currently spending on carbon reduction. So this is an attractive opportunity set, and it's a very important technology and one that we have a lot of experience in.
Yeah, and this conversation we're going to continue to have in the short time I have left. You're saying basically Engine One, you would have them come in and they weren't willing to do so in terms of signing non-disclosure agreements?
Absolutely. We offered them the same opportunity that we offered D.E. Shaw, and you see the outcome of that. D.E. Shaw came in. We spent time talking to them about the plan. I think they're very supportive of the direction and the basis on which the board and management have developed those plans going forward. Offered the same opportunity with Engine Number One. They were not interested in engaging. They were instead focused on us exiting the business that we're currently in, undermining the plans that we have and the strength of those plans, and frankly putting the company's future and the dividend in jeopardy.
And finally, Darren, because we have you, and of course it's been the big story this week, real quickly, but give me your take on the Colonial Pipeline ransomware attack, how you think about it, and whether or not it concerns you in some way for the future.
Well, cybersecurity as a topic in itself is a real important one, and one that the industry is very focused on, and as a company we've been very focused on. Frankly, it requires the right kind of architecture and architecture configuration. It requires the right kind of software systems, the right protocol to manage that architecture and the software, and obviously the people and the right behavior around the people using those systems. And so it's a constant challenge, one that we have worked as a company fairly aggressively, and continue to evolve the work that we're doing there. I would tell you, I think the industry as a whole is very focused on this topic and recognizes the threat that it represents. And frankly, the industry association, the American Petroleum Institute, has a standard that we've put in place to try to help companies in the industry manage cybersecurity. They're actually in the process of updating that standard, and I think we'll learn more from this as the particulars of this incident come out and improve those standards.
Darren, always appreciate it. Sorry for the technological glitch there, but happy we could conclude the interview and look forward to seeing you again soon. Thank you.
Nice talking to you, David and Jim.
Thank you. Darren Woods, Chairman and CEO.
Jim, we packed the hour.
I can't believe it's over.
What's going to come up on
Engine
Matt
One
tonight?
News that they wouldn't do the. Okay, so we have got on Matt tonight. Got Constellation Brands unveiling their first minority investment. I cannot wait that. And then 5.9, one of the few that has held up. Boy, there are so many stocks that are down big in technology from their highs, Carl. And have a great weekend.
Jim, you too. We'll see you at 6. Got 1% gains, back above 41.50. Don't go away.
Squawk on the Street. Rick Santella here. Live breaking news. Our March read on business inventories expected up 0.3, and it arrived exactly as expected, up 0.3. And of course, this follows at least up to this moment, a non-revised up 0.5%. Now let's get to the Moneyball number. Our May preliminary read on University of Michigan sentiment, 82.8. Big miss. We were looking for a number closer to 90. That's the weakest since February. And if we look at all the internals, if we look at current conditions are 90.8, also a miss, sequentially following a final read last month of 97.2. Expectations a miss, 77.6, following a final previous month read at 82.7. Now, there are lots of reasons to think that this is occurring, but of course, with vaccination getting out there and reopenings, hopefully this will turn around with the final read. But the inflation numbers are big. I have to go through these. 1 year inflation at 4.6. You have to go back to August of 2008 to find a bigger level, and that level was 4.8. And that was 1 year. 5 to 10 year outlook on inflation is 3.1. To find a bigger number than 3.1, you have to go to March of 2011. So just like CPI, Consumer Price Index, PPI, Producer Price Index, the future outlook on inflation from University of Michigan also a bit hot. Carl, back to you.
All right, Rick. Wow, the final data points of the week. Good Friday morning. Welcome to another hour of Squawk in the Street. I'm Carl Quintanilla with David Faber and Morgan Brennan. It looks like at the moment market's going to look past that miss on Michigan. We're up better than 1% on the S&P, 41.57, and the VIX back to 20. Morgan.
Yeah, we're 30 minutes into the trading session as well. Here are three of the big movers we are watching today. We're going to start with the drop in Disney. Subscriber numbers for Disney's streaming service falling short of Wall Street predictions. We've got more on the quarter in general in just a second. But you can see those shares are down 4%. DoorDash, meantime, surging despite reporting a wider than expected quarterly loss, blaming a shortage of delivery drivers. Revenue did, however, come in above forecasts. It tripled year on year as people continue to order out. You can see those shares are up 14.5%. And finally, Fisker shares are all charged up after signing a deal with contract manufacturer Foxconn to co-develop electric vehicles, with those first EVs expected to roll out in 2023. Stock is up almost 9% right now. However, it's still down about 25% year to date. David?
Thank you, Morgan. Well, stocks are looking to continue what is a rebound, of course. It started yesterday after what had been fairly large losses for the previous few days. Joining us now is Phil Camporelli. He's of J.P. Morgan Asset Management. Good morning to you, Phil.
Morning, David.
What do you make of this week? You know, how should we view it? Obviously, these concerns about inflation, this rotation that we've seen, dramatic as it's been out of some of the big, very highly valued growth names into value. Will it continue?
Yeah, David, good question. This week's data is just a stark reminder that this recovery is going to be like nothing we've ever seen in our careers, similar to the way the recession last year was like nothing we've ever seen. I mean, you're talking about a month-over-month CPI number earlier this week that was the highest in nearly 40 years, which is really an eye-opener. And I think what Rick went through on some of those, longer-term inflation expectation numbers are certainly going to catch the Fed's eye. However, there is nothing that we've seen this month or this week that is getting us to change our view that investors should be overweight U.S. equities and adding balance to a growth posture that worked for years. That is not going to work. We expect this to continue through the end of the year, David, and I think that some of the things that folks should be open to is getting away from the cap-weighted index exposure, which is just the largest and most popular companies, into more equal-weighted index exposure, where you want all 500 companies at the S&P. And I think value still makes a lot of sense, as you can make the argument right now that the U.S. consumer has never been as strong and rearing and ready to go as they are right now, which should help value in the U.S. as well as abroad in places like Europe.
I mean, Phil, we can go back so many years where there was hope for those value investors, and then it was just dashed as they watched growth severely outperform. What, in your mind, is going to make it different this time?
So what's going to make it different this time is the fundamental backdrop that we haven't seen anything like this since Ronald Reagan was president. And David, you can replace the value head fake with Europe as well. It's kind of the same thing. I mean, the people that have talked about Europe, it was like a blasphemous word to add to a balanced portfolio. But what makes Europe a little bit different, similar to what we've been talking about in the US, is the fact that we're going to pass the baton of the peak of the global recovery to Europe in a couple of months. So that's new. We really haven't been able to say that a lot. We're also looking at German Bund rates almost getting back to positive. I'm going to throw a party when German Bund rates go positive. So that's definitely new information as those rates are moving higher and helping financials. And then the European Recovery Fund, which obviously is a symbolic kind of matching a fiscal union with the monetary union, is something that we haven't seen before. So, that fundamental backdrop, the savings rate in the U.S., not enough people are talking about the U.S. savings rate at 15%. Just to put that into numbers, that's $6 trillion in a savings rate, right? And that was about $900 billion pre-COVID. So these are all really important data points that are new to 2021. And it's very crowded to have stocks in your portfolio over bonds. Everyone's saying that. We've seen tremendous flows into equities. The difference this year is going to be security selection dated, and that's where the kind of value balance comes in.
To your point, I mean, Rick Santelli just said it, inflation data this week, hot, hot, hot. And yet we saw Treasury yields climb higher midweek, and now since then they've basically retreated. So what is the bond market signaling, and at what point does that actually shift and become a bigger story if we continue to get these hot, hot, hot numbers?
Yeah, Morgan, that's the $1 million question here. That's the tail risk to this base case of recovery and reflation that I've been talking about. And also, I read this morning that inflation has never been Googled this much. So everybody's talking about inflation. Our clients are asking about inflation. What the Treasury market is saying, especially with the fact that it hasn't been able to break into a new higher range, is that they're giving the Fed the benefit of the doubt with the T word, transitory. If you look at that month-over-month number that I mentioned was the highest in 40 years, mostly all of the miss from consensus was based on used car sales and car rentals. The Fed is not going to hike rates based on used car sales surging and car rentals surging. They need to see a more inclusive labor market. Loretta Mester was on the tape talking about that this morning. There's still 8 to 10 million people that are unemployed since pre-COVID. They want to see that improve before they believe that we're moving from a transitory environment to a more sustained higher inflation regime. So again, the bond market right now is giving the Fed the benefit of the doubt on transitory, and frankly, so is the stock market. Because if we were really moving from a reflation regime to inflation regime, you wouldn't see all this green on the screen the past couple of days. So, the benefit of the doubt is certainly being given to the Fed. Let's see how long that lasts. But again, Morgan, you can't assign a zero probability to any event in this recovery. There's nothing we've ever seen before. So that's the piece that bears watching the most.
All right. Yeah, the T word. Phil, thank you. And look forward to that party when the German Bund yield actually goes positive.
It'll be like New Year's Eve. We'll count down the basis points.
Okay.
We'll do hats like we used to do for the Dow.
There you go. Thank you, Phil.
Okay, take care.
Guys, Disney is really the only Dow component in the red on a pretty good tape. Despite those better than expected earnings last night, a lot of focus on subs. Julia Borston talked to Bob Chapek on Fast last night and has more this morning on the quarter. IJB.
Good morning to you, Carl. Well, Bob Chapek telling me that Disney Plus's growth picked up in the last month of the quarter, stressing throughout our interview that streaming and going direct to consumer is Disney's top priority, including with sports, announcing 2 new sports deals, an extension of Major League Baseball rights through 2028 and an 8-year deal with La Liga Spanish football, which both feature streaming rights.
We've insisted in every deal that we've done, and as you've mentioned, we've done quite a few in the last few months, our flexibility to pivot to ESPN Plus when we see fit, and in some cases, simulcast. And it's an extremely important component to us because we know the consumer is evolving and changing, and that consumer is going to drive the rate of that evolution. And we want to be on the front end of that wave, actually a little bit ahead of the consumer.
Chapek also reacting to the CDC news that masks will no longer be mandated for people who are vaccinated.
Going to be a lot more comfortable people this summer in Orlando. You can only imagine what it would be like in 95 degrees and 95% humidity wearing a mask. So we're thrilled to be able to do that. I think it speaks to the ability for our guests now to come in, more significant ways to our parks. And right now, as we speak, we're already increasing the capacities to our parks, given the guidance that we've gotten.
JPEG saying that they are seeing strong parks demand back to 2019 levels in terms of those bookings. You can find more from my interview with Bob Chapek on CNBC.com. Morgan, back over to you.
And I urge everyone to go there. Julia Borston, thank you. Well, we're going to unmask the mask mandate debate. Our Frank Holland has more on how other corporations are responding. Frank.
You know, Morgan, it's been more than a year since the CDC first advised all of us to wear a cloth face covering to protect ourselves from COVID-19. This new guidance from the CDC comes as just about 59% of all American adults have had at least one shot. And fingers crossed, hopefully we are inching towards that 70 to 80% level where we would all get herd immunity. But this new guidance also puts businesses in a kind of difficult decision to decide between going by what was announced yesterday and federal, state, and local regulations and guidelines that were already in place. A lot of these companies have to make that decision. Right now, you see we're here at a Starbucks in the Atlanta area. We're still waiting to hear what this company plans to do. We know other companies like Walmart, Target, and Walgreens, they're still reviewing these CDC guidelines. We've also heard from one company that says they plan to relax their mask guidelines. That's the Wynn Las Vegas. They gave us a statement telling us in part they plan to communicate to guests that if they are not required to wear a mask if they are fully vaccinated and required to wear a mask if they are not. So businesses trying to figure this all out. Still very important to remember when it comes to airports, planes, healthcare settings, and also public transit. Guidelines are that you should still wear a mask if you're vaccinated or not. Back over to you.
All right. Americans have a lot to absorb in terms of rules in the coming days. Frank, thanks so much. As we go to break, take a look at the roadmap for the rest of the hour, starting with the bull case for Coinbase, with that stock reporting its first quarterly results as a public company.
Plus, is the New York exodus overblown? We're going to have a closer look at the city's rental resurgence.
And later this hour, the CEO of the National Association of Manufacturers, Jay Timmons, on the economic recovery, infrastructure spending, the potential impact of corporate tax changes. Squawk in the Street will be right back. Don't go anywhere.
Keep your eye on Coinbase reporting its first results as a public company and what's been a wild week for crypto. Our Kate Rooney has more. Hey, Kate.
Hey, Carl, definitely a wild week here. One of the biggest headlines out of Coinbase earnings, Coinbase saying that it's going to start letting clients trade the meme-based cryptocurrency Dogecoin. During the first quarter earnings call, Coinbase CEO Brian Armstrong says Dogecoin will be up and running in 6 to 8 weeks. He talked about some approval process for coins. He didn't give much detail on why that will take up to 2 months, but Armstrong says going forward, they're really focused on adding new assets faster. And part of that need for speed, guys, is competition. There are a lot of new fintech players in the market offering crypto trading for free, including Robinhood. Analysts fear that could put some pressure on Coinbase's margins. CFO Alicia Haas told me that it's great that everybody wants to get into crypto, but it, quote, also means we need to move faster. She says they could have done more trading volume if they had those assets on their platform, referring to Dogecoin in particular there. Coinbase revenue, meanwhile, tripled in the quarter. They now have 56 million users. And they say this current quarter right now is on track to match or exceed those first quarter numbers. Coinbase results are still closely linked to the performance of cryptos, though. Roughly 94% of net revenues came from transaction fees. The company, of course, benefiting from that bull market in Q1, but highlighting some volatility going forward in cryptocurrencies. Coinbase, though, guys, is not the only thing boosting Dogecoin in this wild week. Elon Musk, after calling it a hustle on SNL, he says today, tweeting out that he is working with the Doge developers to improve system transaction efficiency. He calls it potentially promising. Carl, back to you.
Yep. What a week it has been for Musk, for Tesla, for crypto, for Coinbase. Kate Rooney, thanks so much. We'll take a break here. A lot of green arrows on the screens today. Nasdaq's up 200, S&P 4155 as we add to that turnaround on Thursday. Don't go away.
Welcome back. It is now time for our ETF Spotlight. We are taking a look at the pot stocks, ticker MJ in the green again, and up more than 30% year to date with top holdings like Tilray helping the cause. You can see the shares are up about 2.5% right now. But one pot name, cannabis name that is dropping is Aurora Cannabis, reporting lower than expected third quarter revenue hit by pandemic-related restrictions in Canada. Separately, though, the company also announcing a move in its U.S. stock listing to the NASDAQ from the New York Stock Exchange, citing lower costs there. Shares of Aurora are down about 3.5% right now. They're down more than 15% year to date. David.
Thank you, Morgan. Despite all the attention to that exodus from New York City, tens of thousands of people are moving in or perhaps even buying an apartment for the first time. Our Robert Frank has that uplifting story for us. Robert.
Good morning, David. In fact, yes, more than 20,000 people moved into Manhattan in the beginning of the year. That's according to the data tracking firm Unicast. Low mortgage rates and low prices allowing many to buy or rent for the first time. April actually saw the highest number of new rental leases on record with over 9,000 new leases. Rental prices down 21%. Landlords now giving an average of more than 2 months of free rent. Apartment sales also strong in the first quarter thanks to people like Greg Franklin. He's a Chicago native, just started a consulting job in New York City, and while he planned to rent, he and his brother were able to buy a one-bedroom in Midtown Manhattan for just $500,000.
And me and my brother hated the idea of paying rent. We thought, okay, well, if we're going to pay $2,000 a month, we might as well get some of that back.
The problem is the city still has a near record amount of inventory. There are over 20,000 empty apartments for rent and over 9,000 for sale in Manhattan, with the vacancy rate about 3 times the historical average. The luxury segment doing the best with the largest number of contracts over $5 million in over a decade. So, David, finally, we have a new wave of New Yorkers who can afford to live here. Now all we need is for someone to pick up the trash and we'll start to have a city again.
You are just so on my issues. Yeah, of course, important mayoral election coming up as well. And most of them are not going to have to pay the higher taxes, I guess. Robert, what does it say overall about the economy for the city at this point, or what the expectations may actually be in terms of whether you can really raise enough revenue to meet that $98.6 billion budget?
Well, the big question is property taxes. As you know, the highest source of revenue for New York City. Only 15% of office workers are back in the city, so the commercial side of real estate is still really in the tank, probably going to get worse before it gets better. The residential side, again, strong, and we're seeing strong income taxes in the city. So, the big question will be what happens to commercial real estate, and we won't know that until the fall, and even the companies don't know how many workers will actually come back and for how long. So that's going to be the big question to watch.
Robert Frank, thank you. We're going to go back to the ongoing volatility trade for cryptocurrencies, rallying this morning, the major assets that we follow. Let's bring in Arjun Sethi, Tribe Capital co-founder and CEO, and a former partner at Social Capital. Arjun, welcome to the show. Thanks for joining us.
Thanks for having me.
So let's start with, there's a lot to get to, but let's start with the fact that we did just get these first results from Coinbase as a publicly traded company, seen very much as a proxy, at least from an equity standpoint, for the broader cryptocurrency market right now. Your takeaway?
Yeah, the parallel that we like to draw, because we spent most of our careers in network effect companies, we like to call it N of 1. So broader internet, Google, Facebook, Yahoo. You draw that same parallel and say, okay, great, where's Coinbase today and how is it starting? So they have roughly about 50 million users that are starting to use it, about 6 million MTUs, so monthly transacting users. And so if you think about what the global population looks like here in the United States, Southeast Asia, Latin America, you have massive growth to get to about 780 million to about 1 billion people using this, and with monthly transacting users. So you have a 10x to 50x to 100x proposition over the next, I'd call it 3 to 5 to 10 years, especially since it's all super linear exponential growth.
So given that fact, I mean, I know you've invested in Coinbase and other crypto platforms in the past. You've made a very sizable, I think, $120 million investment into Kraken, which is a close competitor to Coinbase, and you're on the board there as well. How do you decide, given the fact that this landscape is really just exploding and there's so many different ways to, as an investor, potentially play it right now, and not a lot of regulation to go with it necessarily either? How do you decide where to put your money to work?
You know, you could have asked the same question about social networking, the internet, but I think the way we'd like to think about what's happening across the board with Bitcoin, alternative currencies, is that Visa was a network that we thought about from hardware, eventually became more software. And you have edges and nodes of how that connected people. And if you think about currency as a network of how people connect through goods and services, how large is that and where do you put it? So the early innings of the internet was Amazon, Google, eventually Facebook, Twitter, LinkedIn. And so while we think about Coinbase or Kraken or FTX or any of these decentralized or centralized exchanges, how large are they going to be? How proliferated are they going to be in our everyday lives? And where should you be putting your capital? In some senses, I would say you should be putting in your capital or investing in some of these protocols across the board, anything that has traction. And so we think about gross demand. We have more data than anyone else in the world for private and public companies. And so when you think about an open world, open protocol, programmable and upgradable, where would you put your capital? It's going to be anything that's gross demand that's towards the future, payments, rails, settlements, et cetera.
Hey, Arjun, you know, we keep our eyes peeled for any news about a big bank establishing a new trading desk, creating new instruments, ETFs. How critical is that, do you think, for the broader crypto population? And where would you look for it to happen first? With which big player?
Yeah, I think the way to think about it is you have everyday people, bottoms up retail, and then you have institutions that are starting to adopt this. And so when you have flows of capital all over the world starting to adopt different alternative coins, Bitcoin, and the liquidity that comes through that system, tokenization of securities and assets, who are all the people that are going to play with it? And so I think you're going to look at every major bank, and you're going to look at every major company, and you're going to look at every major technology company that's thinking about revolutionizing or staying current with their customer base. They're all going to use it. So I wouldn't name any names, but I think you look at every Fortune 500 company, they're all thinking, what do I think about blockchain? What do I think about crypto?
Yeah, I'm curious what you think about Dogecoin right now. I mean, certainly we're talking about a coin that was started essentially as a joke. I wonder who you think has the last laugh, especially given the fact that we've seen the tweets from Elon Musk again in the last 24 hours, Coinbase looking to launch a trading service around that coin as well.
Yeah, if what's really great about what Elon has done to the overall community is just bring it overall attention. And so it's kind of a call to arms to think about, hey, Dogecoin or Bitcoin, it may or may not be green. There's uses a lot of energy. But the great thing about crypto, the great thing about blockchain is that it's programmable and it's upgradable. And so the sheer fact that you make changes over time is, I think, what he's calling other folks in the industry, open source community developers and technologists, to start figuring out how to fix. The early stages of the internet, the early stages of social networking, you can make an argument that they weren't green, they weren't efficient, but they got more efficient over time. The other piece I'd ask and talk through is, look, if you think about how we print cash, how we distribute it, we secure it, it's about 0.5% to 1.5% of our GDP. That's fairly expensive.
When you talk about the early stages of the internet in terms of a metaphor, I can think of another sector that you're invested in where it might be a similar comparison, and that's the space sector. You're invested in a number of names there. Relativity, Momentous, which is looking to go public via SPAC, is in focus right now given the national security reviews. CFIUS outline that was released this morning as well. I wonder what you think not only of that sector, but also of the possibility of all of these companies actually coming to the public market in coming months.
If you take a step back and look at the overall sectors of technology, what do you have? In bioinformatics, it's now becoming more programmable. So that means faster iteration time. We've all felt the effects of that over the last year with mRNA technology and getting out there quicker, better, faster. And who knows what that means over the next 5 to 10 years. We're talking about cryptocurrencies. We're talking about blockchain that's programmable, upgradable. And I think the same thing is in frontier. So when we think about space manufacturing, launch vehicles, quicker, iterable design that's faster, so that we can actually innovate quicker. And so when we think about space, vaccine delivery, technology companies, vertically integrated software flows, they're all in the same plethora of innovation. And at the same time, you take all of that and say, okay, how do you make these companies faster? How do you make these companies better? And how do you innovate? And that's the piece that is the resounding theme across all of these sectors.
Arjun Sethi, thanks for joining us today.
Thanks for having me.
Dow session high was up 328. We're just off the highs of that. Let's get to Rahel Solomon for a COVID update. Hi, Rahel.
Hi, Carl. Good morning. Well, for the first time in 3 weeks, India's top leader is addressing the country's devastating crisis. Prime Minister Modi calling the virus a, quote, invisible enemy and saying that the nation has lost many loved ones. India reporting another day of more than 300,000 new COVID cases, pushing the total case count above 24 million. Singapore is tightening COVID restrictions again. That's after seeing an increase in cases with an unclear link to already identified infections. The new measures will stop in-person dining and limit gatherings to just 2 people. Dr. Anthony Fauci telling MSNBC this morning that elementary-age students likely will not be vaccinated until after the start of the new school year. And 1.7 million people passed through security checkpoints yesterday. That is a new pandemic-era high. Now, despite the new CDC guidance on masking, the TSA says that masks will continue to be required for all travelers through mid-September. You're now up to date. More Squawk on the Street right after this.
As we continue to wait for more clarity about infrastructure and policy at the White House, the National Association of Manufacturers is releasing a new study detailing the short and long-term policy implications for a corporate tax hike. Jay Timmons joins us this morning, the CEO of the National Association of Manufacturers. Jay, it's always good to have you. Welcome back.
Morning.
What has your study found?
So very similar to what we talked about just a few weeks ago, that a 28% corporate tax rate would result in 2 million jobs lost in the first, or 1 million jobs lost in the first 2 years and 6 million jobs lost in 5 years. Some folks are talking about a 25% rate, and while that might be well-intentioned, it still has a very similar detrimental effect on the economy. There's still 1 million jobs lost over 2 years, 5 million jobs lost over 10 years. So we don't think that's the right way to go. We've presented other options such as public-private partnerships, user fees, bonds for financing a very large infrastructure investment, which, Carl, we are very, very much on board with.
So 25 is still $1 million lost. I assume there's no number between where we are today and 25 where NAM would be happy to settle at?
Well, first of all, you have to look at the proposals during the campaign of increased taxes on many things, including not only large companies, but small companies as well and small businesses. And that's what our study shows. That shows the impact of those tax increases. And the bottom line, Carl, is that when we received those tools that we had argued for decades, a lower corporate tax rate, a lower rate for small businesses, it resulted in job increases that were record for 21 years. We had more jobs created over the course of 2018 than had been produced or had been created since for 21 years before that. We saw record investment in manufacturing facilities. We saw record increases in pay and benefits. We don't want to lose that. And I know we will take several steps forward when we invest in infrastructure. There's no doubt about that. But we don't want to, at the same time, take steps backwards by penalizing those businesses that are actually hiring and investing in America.
Jay, it's Morgan. Speaking of...
Inevitably, Jay, inevitably there are going to be people who argue, any worry about job losses is serious and legitimate. But when you have Jolts arguing there are 8 million job openings in the country right now, GDP's looking to grow 10 in Q2, best earnings season for the S&P in a decade, that maybe those worries are a little bit easier to dismiss right now.
Well, I suppose, the narrative, we're in good times, so why not punish business, may be some sort of a popular, might be popular in some sectors. But I think that the most important thing that we have to realize is that the reason we are where we are, which means a strong economy coming out of a pandemic, is because business, especially manufacturing, has been doing the right things for the last 14 months. We've been investing, we've been hiring, we've been keeping people on payroll as best we can. That same JOLTS report, I will say, Carl, shows 700,000 open jobs in manufacturing today. And that is a record for our sector. That's not particularly a good record, because what that means is we can't find the talent that we need to fill these incredible jobs that we have open in manufacturing, jobs, by the way, that pay higher than any other sector of the economy. But there are consequences to government actions. When you drive up the cost of doing business, it means less investment, it means less jobs. And that's a fact. We've proven that fact. We proved the opposite by getting the tools that we were given in 2017 with competitive tax policy. We proved that with those right tax policies in place, we're going to invest and hire and raise wages and benefits. We did it. We don't want to go back to those archaic tax policies of the past.
Jay, it's Morgan. Just to go back to infrastructure for a minute. I mean, we've got this cracked Memphis bridge. We've seen in the last 24 hours or so, something like 900 barges that backed up in the Mississippi River. I mean, we're now getting word from the Coast Guard that that traffic is starting to move again. But it's one more example, I think, that highlights all of the pain we've seen within supply chains, within transportation networks as well right now as the economy fires back up. I wonder, based on your conversations with manufacturers that your organization, your association represents, whether people feel like, companies feel like the worst is behind in terms of some of these bottlenecks and the costs that are the result of them, or whether it speaks to potentially more pain ahead.
No, the worst is not over, because we have not made a substantial investment in infrastructure in decades. If you look at a lot of the infrastructure that we put in place, it was really a result of the 1950s and 1960s. I mean, those were incredible investments then. It helped us be incredibly competitive globally, but now we're falling behind. You'll see those bottlenecks. Just look at the pipeline issues that we've just had. That's critical infrastructure as well. And look at what's happened to the ability to obtain gasoline, something that literally a week ago we just took for granted. Look how quickly that fell apart. The same is happening in our ports. The same is happening with our drinking water systems. bridges, 55,000 bridges in our country are structurally deficient. We're getting a consistent D to D minus from on our grades for infrastructure in the United States. That's not acceptable for a country that is so exceptional and that leads the world. An infrastructure investment at this time, and by the way, I'm very optimistic. I'm very gung-ho that we can get a bipartisan agreement. I've talked to senators and congressmen, Republican and Democrat. I've talked to Secretary Buttigieg. I've talked to folks at the White House. We've presented our plans, Building to Win, that's available at NAM.org. And we are there ready to help get this across the line. I think we can do it this year.
But Jay, you're not willing to pay anything for it, right? In terms of the corporate tax rate, which you just termed archaic, even though from 1947 to 2017 it averaged roughly 35%, and we went through recessions and we went through booms, and now you're saying we need infrastructure, but not corporate America, not going to even go to 25.
So I think you have to look at how our country has changed, and not only our country, but the world. So the rest of the world is frankly lapping us when it comes to taxes on job creators. They're lowering the cost of doing business in their countries to try to attract investment to their shores. We don't want to see that. We want the investment to be here in the United States, which means we have to have competitive tax policies. And again, we proved in 2017, or after 2017, in 2018, 19, and 20, even during a pandemic, that with those competitive tax policies, we would invest, we would hire, and we would raise wages and benefits. We don't want to turn our back on that. That was good news for the American economy. We've also offered alternatives in our Building to Win proposal. As I said, user fees. User fees are going to hit business. They're going to hit them pretty hard, but they're for specifically what we're trying to accomplish when it comes to using various infrastructure systems throughout the United States. It makes sense. We're talking about bonds. If there was ever a time to use debt, it's for a project that's going to last 50 or 60 years. It's something that our grandchildren, even our great-grandchildren, are going to be using in the future. Why not invest in that today with debt, like we would our own homes, and pay for it over time? Also, public-private partnership. There's a lot of private sector dollars that are ready to go into some of these infrastructure projects. And by government and the private sector working together, we can really expand on that. And there's been some really good ideas coming from folks like Senator Rob Portman about some repurposing of dollars that already exist that can be used for infrastructure. We can do this without punishing those people who are producing jobs, without punishing small business and companies that are creating jobs and investing in America.
Jay, we were hoping that the picture on infrastructure clarifies a bit in the next couple of weeks, and we look forward to checking in with you if and when it does. Thanks so much. Appreciate it.
Great to be here.
Well, as we head to break, the S&P is up about 1% right now, 41.51. We're on pace for the best 2 days since early April, but here are the laggards in the index nonetheless. Hanesbrand, Tesla down 12%, Occidental, Biomed, and Micron, which is down 8.5%. We'll be right back. Stay with us.
We check in with the FANG stocks after a rough week for the group. Find out which one could have more pain ahead on tradingnation.cnbc.com. More Squawk on the Street coming up.
Brad Stone, award-winning author, has a new book out. It's called Amazon Unbound, Jeff Bezos and the Invention of a Global Empire. And Brad joins us this morning. Brad, congratulations on this. I can't wait to dig into it. Thanks for being with us.
Thanks, Carl.
You wrote The Everything Store a decade ago, which was about Bezos as an innovator. This sounds like it's more like Bezos as an innovator at scale and operating globally and with incredible discipline. Is that the general take?
And perhaps a monopolist, as someone who, has built an empire beyond Amazon. The Washington Post, I have a chapter on the remarkable turnaround there. Blue Origin, his space company, which is trailing badly Elon Musk's SpaceX. And of course, the personal saga and Amazon's navigation of the pandemic.
Is this about Bezos himself and digging deep into his own discipline and personality, or is it about the team he's assembled at Amazon, which we know is a pretty cohesive group?
Carl, you can't separate the two. I mean, the story of Amazon until probably sometime this summer is the story of Jeff Bezos. It is scaffolding built around his brain, his intellect, his drive, his personality, all the assets that he has and some of the, deficiencies. A lot of people look at Amazon, the culture and the fulfillment centers in the offices and say, that's a tough culture. It can be a mean culture. But at the same time, the company I wrote about in the Everything Store was this small little $80 billion market cap company, and it's $1.7 trillion today. So the book really charts the trajectory, how it got there.
Hey, Brad, it's David Faber. A number of years ago when we did a documentary on Amazon, you, of course, were very helpful. It's funny when I think back on that, there were certain things we were looking for, I remember, even photos from the early days, employees we were trying to reach, and suddenly nothing was available. Nobody would talk to us. I can't imagine how much what you face from the Bezos operations, so to speak, but I'd love you to talk a bit about it, particularly in light of what I know is also in the book in terms of how he dealt with his divorce and any number of other things associated with that.
David, I don't want to say the walls have come down at Amazon because they really haven't, but I think they sort of understand that, it's not enough to, reject folks who want to understand them better and just sort of move forward. The company's too big now. So I think back to like Nomadland and how they cooperated with that. I got pretty good access. I talked to Dave Clark, the new CEO of the Amazon consumer business, Andy Jassy, who's taking over from Bezos later this year. They probably gave me a dozen or so senior executives. Bezos, of course, not. He prefers to remain a sort of out of reach cipher. But I don't know. I think the times since when I helped you with that documentary, Amazon has opened up maybe just a little bit.
Brad, it's Morgan. Congrats on the book. I can't wait to read the rest of it, especially that part on Blue Origin. But to go back to something you just said and this idea of Bezos as the monopolist, I see this tidbit here that talking about that vast trove of data from third-party Amazon vendors to make competing private label products and then lying about it. I mean, that gets right at the heart of the antitrust debate that's afoot and that investors are keeping a close eye on when it comes to a company like Amazon. What do you mean by that? What happened?
It's something so easy for, I think, regulators and lawmakers to understand in this complex business. The question is, when we look at those Amazon products that they brand themselves, have they decided, for example, what supplement to introduce by looking at the data of their third-party sellers and what's working? And what Bezos said in front of Congress and what other Amazon executives have said is that they don't do it. And if those policies were broken, they're going to investigate it. And I don't know that they've lied about it as much as they've obfuscated and tried to prevent from answering the question. But what my reporting in Amazon Unbound shows, and I talked to employees who showed me the spreadsheets that they had from third-party sellers, is that for a while the cookie jar was open. And so this is one of the areas in which I think regulators in the U.S. and in the EU are going to take a really hard look at.
Brad, again, the book Amazon Unbound. We wish you much success. Thanks for coming on. Good to see you.
Thanks, guys.
Well, as we head to break, take a look at some of the players in online sports betting. A lot of green arrows today, rebounding after what was a tough week. DraftKings is up more than 9% right now. They're still poised for its 7th weekly decline in 8. There's more Squawk on the Street on the other side of this break, so stay with us.
Coming up on Tech Check, do not miss Airbnb's Brian Chesky at the top of the hour on the quarter. The stock bouncing off its lows for the year. Gross bookings come in way ahead. But first, as part of Asian American and Pacific Islander Heritage Month, we are spotlighting CNBC contributors, business leaders, and our own anchors and reporters. Here's CNBC's Hugh Son.
I think being an outsider gives you some huge advantages. I know personally from quite often being the only Asian American person in the room, you develop a little bit of a chip on your shoulder. You want to outwork your competitors because that is within your control. That work ethic is really useful. I think it's rocket fuel for career success.
More governors announcing they are opting out of the enhanced unemployment benefits. But do states have the legal right to refuse a federal program? Rahel Solomon has more for us. Rahel.
Hi, David. Yeah, the number of states opting out currently stands at least 14. And as you said, it's growing. State leaders say that the federal benefits are encouraging people to stay home instead of return to work. But according to a report from the Century Foundation, cutting off these benefits could impact more than 1 million people within weeks. It's about 1 in 9 of those currently unemployed. Now, one group sounding the alarm that opting out of at least part of that program may not be legal. The National Employment Law Project sending a memo to the Federal Department of Labor outlining that while other CARES Act programs may be discretionary, pandemic unemployment assistance is not.
It states that the secretary shall provide to any covered individual employment benefit assistance while that individual is unemployed, partially employed, or unable to return to work. So for the Pandemic Unemployment Assistance Program, PUA, which a lot of states are ending, that program is a requirement.
So NALPA is suggesting either the DOL force those states to continue or recruit states that will administer the benefits. The DOL, meantime, saying that they have received that memo. Morgan, I'll send it back to you.
Rahel Solomon, thank you. Major averages are higher, poised to end the week down. That's going to do it for Squawk on the Street. Tech Check starts now.
Good Friday morning. Welcome to Tech Check. I'm Carl Quintanilla with John Ford and Deirdre Bosa. Coming up this hour, Disney falling short on subs. The stock this morning does follow suit. Why that slowing in streaming is a concern. Plus, 2 sharing economy stocks getting a nice boost in today's session. We'll dive into DoorDash, talk to the CEO of Airbnb this hour. And then finally, Coinbase ticking higher, takes Doge with it. A lot more on Elon and crypto later on this hour, John.
Yeah, and let's talk about some of that. Let's start with the future. The mask-off trade, those Airbnb shares now rising after a drop at the open as investors turn bullish on the pent-up travel demand as vacationers get back out there. And DoorDash, close to erasing the month's losses, up 19% right now. Loyal Dash Pass subs balancing out the return to restaurants and the post-stimulus return of its driver supply, keeping that stock well in the green this morning. And Disney, sure, it's down today on a subs miss, maybe suggesting more people are heading outside for their fun. But fortunately, Disney parks are outside. So maybe we'll see a rebound there sooner with masks off. I know we're going to talk Disney in just a moment. So, Dee, got to think about DoorDash here because what a reaction here. It's interesting. They had some trouble and they attributed this to stimulus. The stimulus had people ordering in more, but it also left drivers, the Dashers, perhaps less eager to go out there and make a buck. And DoorDash has told us most of the drivers only drive about 4 hours in, or maybe 4 hours in a week. It's something really short, really. And so it's really interesting how the levers get pulled here. They need a lot of people driving to make this work.
Yeah, and DoorDash proving that it can really efficiently pull these levers. But you know, Carl and John, it was kind of thought that both Airbnb and DoorDash couldn't win in a year like this because, one, Airbnb is a reopening trade and DoorDash is more of a pandemic stay-at-home trade. It turns out, though, guys, that we can do things like unmask, get out and travel while still ordering food, watching Marvel shows, even trade Dogecoin. So perhaps this raises the prospect for now that it doesn't have to be one or the other, that the reopening trade and the stay-at-home trade can work because some of the trends that have been accelerated over the last year, Carl, they're not just trends, they're habits that have formed and may be here to stay post-pandemic.
Yeah, Airbnb up almost 3%. That's certainly what you would take away from gross bookings, up 52D year on year, $3 billion above the street estimates. Their guidance, of course, this event coming up on the 24th, most comprehensive upgrade to the service in 12 years. So, John, it's going to be fascinating to see what Chesky says in a few minutes.
It will indeed. And Deirdre, like you said, I mean, we talk about these trades, and yes, there's some truth in aggregate, but there are strategic things that all of these companies are trying to do beneath the surface. And a lot of it has to do with core
assets. With DoorDash, they're trying to build out this subscriber habit. We see them not quite there on getting more people to order from pharmacy as opposed to food, but that's a key metric to track. And then Airbnb trying to keep those super hosts because the experience is so much of where the value is, right?
Yeah, they proved their brand power as well. I mean, Airbnb recovering so much faster than the rest of the travel industry. And as we've talked about before, DoorDash showing a level of profitability, in some ways better than its competitors like Uber Eats, and getting that supply back online when some of the other names in the gig economy are having a little bit more trouble doing that. We are going to be discussing all of this, all of those names throughout the hour. We're going to get to Coinbase too. But for now, let's dig in deeper on Disney. A miss on subs and revenue driving the stock down this morning. Julia Borston has the breakdown though. Julia, good morning.
Well, Deirdre, though Disney added 9 million new Disney Plus subscribers rather than the 14 million that analysts expected, Disney CEO Bob Chapek telling me that Disney Plus growth picked up in the last month of the quarter, stressing that streaming and direct-to-consumer is Disney's top priority and that they're on track for their long-term goals.
We've added 30 million new households to Disney Plus just in the first 6 months of the year. So we're extremely bullish. And in fact, this quarter's numbers were exactly as we projected internally. So no disappointment here. I think if you want to look at the actual rate of net adds, we've actually added more in the last month than we have in the prior 2 months in terms of households.
Chapek announcing that after simultaneously releasing movies in theaters and on Disney Plus for an extra fee, that they will give 2 films an exclusive 45-day theatrical release in August and September.
We're hopeful that by the end of summer, more and more consumers will feel free, particularly with the CDC guidelines today about relieving the constraint on masks, that will give us the ability then to go ahead and return to a shortened window, but at least an exclusive window where we can continue to build those Disney franchises the way that we have in the past and continue to fuel the growth, not only for our theatrical exhibition business, but most importantly, to our Disney Plus business.
It's unclear how much Disney plans to give films that exclusive window in a fully post-COVID world, but it does sound like they're going to do whatever it takes to build that Disney Plus subscriber business. And John, a lot of commentary about how they expect the subscriber numbers to grow as they add more content. So similar to Netflix, this idea that content growth is going to drive user growth.
Julia, there's talk about direct-to-consumer here, maybe some concern about the subs growth in this one quarter, but I wonder how much talk there is even from Disney, maybe even among analysts, about whether they're going to really flesh out direct-to-consumer as an idea, like Amazon has done. I mean, you got these barcodes from Prime that you can scan in Whole Foods, to get into Ghost stores, things like that. When are they going to bridge that direct-consumer relationship into parks to drive traffic, maybe differentiate on pricing? There's so much they could do. Are they doing it?
Yes, I actually think they are, John, and this is a direction they've been moving in for a while. I mean, I think that Disney is unique from so many of the other media companies because it already had that direct-to-consumer relationship thanks to the parks long before people were doing streaming. So Disney already had email addresses, had people buying tickets directly from them. They already knew how to transact directly with consumers. So I think what's interesting with the parks is that, they've moved away from the wristbands, these magic wristbands that they had in Disney World that were designed to get people around the parks faster and with fewer lines. And now they're going to be launching this new Genie app. That's going to be all about using data to make sure people have a better experience in the parks. So I think that Disney is going to try to make all of that seamless. So you go to the parks, you subscribe to Disney Plus, you can access all the content, through Disney. And this idea that Disney doesn't have to go through middlemen anymore. They're not reliant on the TV bundle, the cable TV bundle, which is something that that Chapek alluded to. They really want to be able to own that relationship directly.
We love to kick around release dates, Julia, and the science that is the new window. Whether it's Cruella, Jungle Cruise, Black Widow, what is their strategy telling you about what they think cinema attendance is going to be like?
Well, I think it's fascinating that the movies for the next couple of months, sort of until the end of August, are going to be available for Disney Plus subscribers for an additional $30 fee and also available in theaters. I think to me that indicates that they think that some people, maybe people with kids who are not yet vaccinated, people with kids will be a little bit more reluctant about going to theaters. But then by the end of the summer, once you've had far more vaccinations, then they think they're going to be able to really maximize an exclusive theatrical window. Disney is also unique from many of the other studios in that it dominated the theatrical movie-going business pre-COVID. It had the biggest market share by a lot. So now they're going to be able to, wait until they think there's really going to be a movie-going audience and then drive people to theaters. They have a Marvel movie coming out. They have a Ryan Reynolds comedy, and that's going to be a really important test of how big demand is for theatrical only.
Great insight with Chapek, especially, Julia. Thanks. We're going to stick with Disney, bring in Needham's Laura Martin. Laura, you got a hold on Disney, but here's the part that I wonder about. Is Disney more compelling longer term if you believe they're going to be able to stitch together the Disney Plus data that they've got, plus the parks stuff, and somehow create more insight, drive more business and higher value through that direct relationship?
Right. I think you're hitting on the asset that most investors miss, which is the direct relationship to consumers. They've always had connections to their consumers through the parks, and now they have 159 subscriber emails and relationships from their DTC business. So they're going to try to bring you into the Disney fold when your kids are 4 and not let you or your kids out of that relationship until you die, essentially. So they are trying to find they're going to have your consumer data and drive revenue from that over decades.
What you're describing there, Laura, is this flywheel that another company, Amazon, has been so successful in creating. So if that's true, then why the hold? Aren't they going to continue to add more to this ecosystem, get more of our dollars, more of our data?
Yep. I just, I think this streaming service is costing them a lot more money in the near term. And this is a company that used to trade on EPS. I've been covering it for 20 years, and it just doesn't trade on EPS anymore. But call me an old dog, hard with new tricks. So the streaming assets are wonderful, and they have a lot of long-term value, especially in their data. But, I would like to see EPS growth as those parks open. What's so funny is we're all talking about streaming today, which is fantastic. But let's recall the CEO here ran parks for over a decade. So I am highly confident that these parks are going to do fantastic once they're allowed to open regulatorily and go back to full capacity.
Good point. We are all talking Disney Plus. There is a lot of discussion around parks. Something I'm not hearing a ton about, though, is sports. I mean, as sports returns to a normal cadence, where's ESPN Plus position? Could this sort of be a bright spot? Do you think that they are able to make big strides in this space, especially, as they get the UFC contract and more live sports moves to streaming?
Yeah, the first quarter linear networks, which is primarily ESPN, really saved them $2.8 billion of EBITDA, up 15% year over year. So a lot of their free cash flow on the positive side coming from this empire is these linear networks. And already, as you said, the second quarter last year, all live sports was essentially off. So the numbers start getting really big really fast as we go into second, third, and fourth calendar quarter of this year for Disney, because all their sports is going to be back being played and viewing up. And so we're just waiting for venues to open in the real world.
Laura, finally, I know cruises are, comparatively a small part of the business, but it does seem to be the epicenter of everything political regarding vaccine passports and testing and CDC scrutiny. Cruises were an issue pre-COVID. We had our episodes. I just wonder how you think they're going to manage it, what their biggest concerns are.
Yeah, I think cruises is probably going to be the last thing to come back. I think it will come back after theaters. But I think, again, this is just about touch points to the Disney ecosystem. We talk about like the cable bundle or the streaming bundle. Bundling in cruises is just another form of consumer immersion in the Disney cult, let's call it. So I expect that super fans to take advantage of the cruises, but it's a narrow group of people, meaning you don't need 1 million people. You don't have room actually for 1 million people a year to do cruises. So it's just it's the tip of the spear for the most avid Disney super fans. And it's a great touch point for those fans, but I don't think it drives the empire's upside value here.
All right, Laura Martin. Thank you. With a hold, but it might be the happiest hold on earth.
Magic.
And it only feels like 1 million people on cruises, not actually that many. Airbnb CEO Brian Chesky in another CNBC first. That is up next. Tech Check is only getting started.
All right, guys, it's been a hell of a morning. We are getting just absolutely just huge comeback on the markets, especially these momentum tech stocks doing super well. Some really good earnings reports coming out from a lot of companies yesterday, which has really helped. A couple like Coinbase has gone back down after that, I think. But DoorDash, for example, is still just absolutely crushing it. All the cryptos are back up.
Takes it to a buy this morning. Price target 275, which is where it was trading about
Cringe.
after the IPO. So
Thinking
Snowflake's
about
well positioned to benefit
whether or
from
not
the shift in data
good
to the cloud and has room to run since we are in the quote
Elon
early innings. There's
market
that
first.
innings analogy
What to
again
do, not
of a cloud adoption.
pressure around
Shares
what you're
jumping
capable of
nearly,
setting it
let's see, about 8% this morning, taking it back
did
above the 200 level.
Let's
John,
completely
Airbnb shares, they're also up today about
be real
3%.
here.
Its latest results providing
He
more
makes
evidence
a
that
comment
its
about
model and brand is recovering much
when it comes to
faster
market
than
over
the rest of the travel industry.
before
Average
SNL.
daily rates rose more than
Then he
30%
comes out
in the first
3 days
quarter
ago and
compared to
talks about
double-digit
how,
declines
or 2
in
days
the
ago, he talks
hotels
about
and
how
just 8%
their
growth from
Bitcoin's
Expedia.
not going to be accepted for
Revenue
Tesla
also
anymore
growing
because of
again,
the
while the
medical
OTAs are
sovereignty.
still far below pre-COVID levels.
So it completely questions the entire ecosystem and infrastructure of cryptocurrency. And then comes back again today. I mean, or yesterday. Yesterday, it says completely backtracks. Well, I'm actually working with a developer Dogecoin to make sustainable. Then there's people, saw a bunch of people online calling BS on that because the development of Dogecoin is basically any modern teaching school development of Dogecoin. That's a little bit archaic, but sure, trust some people know more than that. But then, of course, now he's saying, oh, well, Elon Musk to be in charge of the environmental revolution of the environmental revolution of cryptocurrency will be a part of that, and so they're investing back in it. Man, it's a roller coaster, and you just wonder, like, is something happening here that we're not really paying attention to? And I want to make any disparity comments about Elon Musk. I think he's an awesome guy, very influential and innovative guy, but he's taking influence from everything. But it's just what doing this on purpose for personal gain or maintenance company, and doing it in a way where it's not something that is that hurts the any SEC regulations or anything like that. That's my I don't know. It's just it's a worry, it's a concern, right? So anyway, we'll see. We'll get back to this when what Brian Chesky has to say.
Very hard to build up their supply.
Well, again, if we see a huge spike in urban demand, that would be great for our host and cities. They've been hurting over the last year, but we are still seeing more and more demand coming to the urban area, especially for longer term stays.
Right now, you sound extremely positive on your outlook for the summer and the first half of this year, but you were somewhat conservative on your guidance for the back half of the year, pointing to limited visibility. Why is that the case? What makes you think that the rebound could stall or gives you hesitation when it comes to predicting the second half of the year?
Well, I'm very confident about the second half of the year. And I, again, think this will be a travel rebound unlike anything we've seen before. Certainly, I've been doing this for 13 years in Airbnb, and never have we seen anything quite like this. The amount of people that are interested in traveling. And of course, all this was before a few hours ago when the head of CDC said that now if you're vaccinated, you can resume activities that you were doing before the pandemic. And I think one of those activities that I'm sure people come to mind right before Memorial Day is travel. So we are very confident and we're going to be prepared for whatever the demand is.
You guys broke out longer term stays this quarter, those over 28 days, and they now make up a quarter of all nights booked in Q1. Does that trend continue as economies reopen?
It probably does. I mean, it probably will happen is there might be some rebalancing as cross-border increases, as urban increases, and more people travel. That could rebalance it a little bit because you're going to see a lot more growth in short term. But over the long run, over the course of a number of years, I think the trend to increasingly people staying in Airbnb for long-term stays, as defined by 28 days or longer, it increases. And the reason it increases is because increasingly fewer and fewer people are being tethered to one city to live and work. And so as people become more flexible, more and more people decide that staying in Airbnb is actually a great option for a week at a time, a month at a time, or a few months at a time.
If long-term continues and it goes up, what kind of opportunity does that open up for Airbnb in terms of your addressable market and ways to monetize the platform?
Well, I mean, the market for living is much larger than the market for traveling. There's no question. Most of us, travel for a portion of the year and we're living the rest of the year. So I think, number one, most of our market size that we described to investors, especially in RS1, was primarily focused on travel, which is already one of the biggest industries in the world. It is, by some measures, between 5% of global GDP or even larger. It really depends on how you size it. If you add another category of living, and if traveling and living start to blur, I think Airbnb is absolutely a beneficiary.
Now, have you seen the same kind of recovery in experiences that you have seen in home bookings? What are you looking to as an indication that this business is working or isn't?
It's absolutely working. And one of the things I'll point out on experiences is statistically, guests are more satisfied with experience on Airbnb even than homes. The percent of people leave a 5-star review for experiences is higher than homes. Now, this product has been somewhat on hold. Last year, we paused the entire experiences product because obviously during a pandemic, it's really hard to gather, let alone with other strangers. I remain very bullish over the long term.
Brian, are you seeing any evidence of cross-border travel returning yet?
We are starting to. Where we see restrictions open up, we are seeing the beginnings of some emerging growth in cross-border. I think the next, few weeks and months are going to be really, really important. but it makes complete sense. I heard a lot of anecdotes of people being at airports recently, and it's the most crowded they've ever seen an airport in a long, long time. So people are getting back on planes. As they get vaccinated, they are going to be crossing borders. And I think that Memorial Day will be probably a threshold we cross. And after Memorial Day, I think you're going to see a lot more cross-border. Exactly when, obviously, that's going to be really hard for me to predict, but we will see the data probably before others.
Interesting. What about business travel? Any evidence of that returning? And I know you've said before that it's going to return in a very different way. What are some of the early signs, if you're seeing any?
I mean, again, at risk of predicting the future and being wrong, I don't think business travel as we know it is coming back to levels that they were before the pandemic. The simple reason why is I think the bar to get on a plane to go to a meeting is higher than it used to be because you can do a lot more. And so what I think this is going to be is not the end of business travel, a change of business travel to longer length of stay business travel and more group business travel, because you're going to have a lot of people working remotely, but they're going to need to go back to headquarters.
Now, I know that you guys cut a lot of your marketing expenses over the last year and you got a lot of traffic organically, hosts organically too. But as you see greater competition from the OTAs, are you considering upping your marketing spend once again, or still the same outlook there?
I think we're pretty different than our competitors, and we have also a quite different approach to marketing. I mean, I think Airbnb, we're one brand. We're not like a house of brands. And that brand drives direct traffic to Airbnb. More than 90% of our traffic is paid, unpaid or direct. Additionally, we have approximately the same traffic now as we did in 2019, but we spent 50% less on marketing. So I think we're going to be permanently more efficient.
Carl and John, I think one of the most interesting things that he talked about was that trend of longer term stays. And it makes you wonder, could Airbnb eventually go beyond travel, become a property company? What kind of opportunities does that open up? He didn't bite. I asked him if they'd eventually displace the property agent, opportunities in insurance, but he didn't really answer that. It is an interesting question for longer term investors, though. Does that addressable market expand in a major way, Carl?
Yeah, especially when bookings, or a good share of bookings, D, are for more than 28 days. You're essentially in a bit of a property management business. But fascinating, and what a great interview on a pretty impressive quarter, despite what the stock has done since the IPO. When we come back, Dogecoin getting a big boost this morning from who else? Elon Musk. We're going to break down that and talk some Coinbase earnings. In the meantime, watch Unity. OPI upgrades this morning goes to outperform. Says the current level is an attractive entry point for investors looking for a high-growth software stock. And the shares are up 6% or better. Tech Check's back in 3 minutes. Bottom of the hour here. Welcome back to Tech Check. I'm Carl Quintanilla with Deirdre Bosa and John Ford. Stocks are higher for a second day. Tech stocks leading the rebound. NASDAQ's now flirting with a 2% gain. We'll see if we get there later on today. Some of the pandemic winners that saw drops this week are turning around. Zoom's up 6. Names like Okta and DocuSign up nearly 4. Let's get a news update this morning. Get back to Rahel Solomon. Hi, Rahel.
Hi, Carl. Good morning. The Coast Guard is again allowing maritime traffic on the Mississippi River that will start to alleviate a backup of dozens of vessels and more than 1,000 barges. The movement was stopped after a crack was discovered on this interstate here between Tennessee and Arkansas. The Coast Guard says that it has determined it is safe to travel under that bridge as repairs continue. The positive effects of government stimulus checks appear to be fading. U.S. retail sales were unchanged in April. A small increase had been expected. The stagnant sales in April, a big contrast from March when they soared almost 11%. And New York Representative Elise Stefanik all smiles this morning. House Republicans voted to put her in the leadership post that had been held by the now ousted Liz Cheney. Cheney, of course, has been very critical of President Trump's claim that the election was stolen from him. Stefanik, meantime, has been supporting him.
I believe that voters determine the leader of the Republican Party, and President Trump is the leader that they look to. I support President Trump. Voters support President Trump. He is an important voice in our Republican Party, and we look forward to working with him.
And you are now up to date. Deirdre, I'll send it back to you.
Rahel, thanks for that. Take a look at Coinbase getting a nice boost this morning as revenue tripled in its first quarter since going public. Kay Verney, it's not just Coinbase that's up this morning, Dogecoin too.
That's right, Dogecoin getting a boost, but this was a huge quarter for Coinbase. You had that revenue growth, a boost in user growth, and Coinbase says that it's on track to deliver similar or better results in this current quarter. But Deirdre, you mentioned it, one of the biggest headlines, Coinbase is going to start letting clients trade that meme-based cryptocurrency, Dogecoin. It was the first topic on the earnings call. Coinbase CEO Brian Armstrong says Dogecoin will be up and running in 6 to 8 weeks. He talked about an approval framework for new coins and looking to add those assets faster, but he didn't give much detail on why that will take up to 2 months. Part of that need for speed, guys, is competition. There's a lot of new fintech players in the market offering crypto trading for free, including Robinhood. Analysts fear that could put some pressure on Coinbase's margins. CFO Alicia Haas told me yesterday it's great that everybody wants to get into crypto now, but it also, quote, means they need to move faster. She says they could have done more trading volume if they had those assets on their platform, referring to Dogecoin there. Revenue came in at $1.8 billion. Profit for Coinbase, $771 million. That increased more than 20x from a year earlier. Coinbase now has 56 million users, and it saw growth in subscription and services revenue. Coinbase results, though, guys, are still very closely linked to the performance of cryptos. Roughly 94% of net revenue still comes from transaction fees, the company benefiting from that bull market in Q1. Executives did strike a sort of cautionary tone, though. They talked about volatility and needing to spend more on marketing to keep ahead of that competition going forward. We mentioned Dogecoin. Coinbase is not the only thing boosting those prices today. Elon Musk, after calling it a hustle on SNL last weekend, tweeting this morning that he is, quote, working with Doge developers to improve transaction efficiency. He calls it potentially promising. Guys, back to you.
Kate, the SEC had a headache before dealing with Elon Musk when it comes to Tesla stock. But right now, there doesn't seem to be anything moving crypto up or down more than Elon Musk. And then crypto is moving Coinbase. I mean, how many different things, how many different financial equities or financial instruments are tied to the whims of Elon Musk right now?
It is sort of a Russian doll of influence of a Musk tweet going to Dogecoin or Bitcoin. One of the things, so Bitcoin is technically regulated by the CFTC. So it's not the same as if you had Elon Musk coming out and tweeting that he was going to take Tesla private at 420. It's different. So CFTC is sort of in charge of looking after Bitcoin. Dogecoin is under sort of a certain regulatory structure, but this market is still relatively new. I don't think they've figured out how to sort of police that. And you have influencers, CEOs tweeting about it. There's not a lot of disclosure. It's not just Elon Musk. People on Reddit, Twitter, talking about their positions. They don't really ever disclose how much they really have at stake. So some of these CEOs might have more skin in the game than we realize.
And Kate, how are investors responding to that timeline that you mentioned, up to 2 months to add Dogecoin? I mean, Coinbase has to be nimble, but they also got to do their due diligence. The reason they received the valuation they did at their IPO and have right now is because they're seeing sort of the gold standard exchange, right? These things may take time. We can't forget that Dogecoin is still a meme coin and created initially as a joke, even if it is being taken more seriously.
Yeah, a lot could happen in 2 months. I mean, we've seen Dogecoin rise almost 10,000% this year. You don't know where it'll be in 2 months. But I asked Alicia Haas about what happened with Binance. So there's reports that they're under investigation. She said that they really have taken pride in being the sort of more regulated gold standard. And that has been, like you said, part of the big valuation story. Analysts this morning are coming out and saying that is Coinbase's appeal, is that it is the compliant version of any of these crypto exchanges. So they sort of leaned into that narrative that they want to be compliant. And the whole regulatory structure and framework that they use to approve coins really, really relies on regulation. They have to make sure that these things are compliant. We saw it. They took XRP off of their platform for that very reason. So I think they'd rather be slow here than immediately launch Dogecoin, although they do. It seemed like they had a little bit of FOMO on the earnings call. They missed out on that big run up.
Yeah, although your point about the competitors, Kate, is such a good one. Piper, when they initiated Coin today, at an overweight, they make the point that the market share of overall crypto market cap has gone from 5 to 11 in just a few years, in what is obviously a market growing 8x. So we're going to talk more about who has what amount of share versus their peers.
Absolutely, absolutely. They have seen, you saw that rise. You mentioned 11% of the crypto market is now custodied at Coinbase. So they are growing their share. People seem to be willing, at least right now, to pay some of those higher fees at Coinbase to trade there. And they also do certain forms of banking. They've got other sides of the business. I think the big thing people are watching is the percent of revenue that comes from just transaction fees. If that's really their bread and butter and you have others coming in, like Robinhood offering this for free, that could really put some pressure on the company. Alicia Haas, again, though, said that they're really not looking to compete on fees. They're trying to be sort of the first mover. She really tried to sort of shift the narrative from, oh, there's coming in, there's going to be some margin pressure similar to what we saw in the brokerage industry, but that definitely seems to be a big risk.
Kate, thanks. Our Kate Rooney. And coming up, a closer look at DoorDash's results and why that stock is up 21% this morning, plus a group of former Uber execs, Ghost, Travis Kalanick. We will explain. Tech Check, back in 2. We said a theme to focus on is unmasking. Going a level deeper on that, a key idea this earnings season for gig and flex economy stocks, supply. A shortage of drivers costing Uber and Lyft $250 million in incentives, an abundance of hosts giving Airbnb an edge over competitors, and this DoorDash stock pop that we're seeing after earnings could be related to the resolution of its driver supply issue. DoorDash saying they're getting drivers back, Carl, and that issue where the typical Dasher for them works 4 hours a week. We heard from Rahel Solomon earlier that the effects of stimulus are fading in a way that's good for DoorDash, right? Because one of the effects of stimulus that they were seeing is that some of their gig workers weren't as eager to work. That combined with the subscription ecosystem they seem to be building, maybe giving them some value that investors are seeing today.
Yeah, it's definitely a pivot point this morning, John. I'm looking at the upgrade out of Wells today. They went to overweight, and they say that the beat was large enough, D, to offset the rotation to value that has afflicted growth stocks so far year to date. So if Dash is going to be a poster child for anything, you might want to see it be something that at least reinforces some confidence in growth.
Yeah, and what's remarkable to me is that DoorDash is already commanding a much higher valuation than Uber, 15 times price to sales versus 8 times for Uber. And it's really seen as the company that is able to resolve some of the issues. We've heard Dara Khosrowshahi speak about the driver shortage, how they're spending money. They might have to spend more money. But John, DoorDash just kind of showed us that they put the money in. It did hit their bottom line this past quarter. But they say that they resolved the issue, that they had their Dasher supply back up and running by the end of Q1. They didn't talk a lot about, concern for the rest of the year. And of course, on that profitability metric, right? Even if you want to take adjusted EBITDA profitability, they're getting there much quicker. And one other thing, they are now number one in terms of food delivery market share, convenience delivery market share, and now pickup or takeout. So they have just found a way to take market share and also do it in a more profitable manner.
Carl, here's the next shoe to drop. Is the impact, if there is one, of this pricing change that they've done with restaurants. They think this is going to make them more competitive, where they're giving restaurants more options versus DoorDash taking just 30%. They're saying, hey, a la carte, you picked how much service you want, how much marketing you want. You can pay less, you can pay more. If restaurants like that more than they like the offerings from some competitors, then maybe DoorDash widens its lead here and its supply of restaurants. But we'll see. Jury's out.
Yeah. Speaking of restaurants, guys, a group of former Uber executives have launched their own virtual kitchen startup, which is a direct challenge, obviously, to Travis Kalanick's effort. Our Kate Rogers has more on that. Morning, Kate.
Hey, Carl, good morning to you. Well, VC money is really flowing to companies in the ghost and virtual kitchen space, which could be a $1 trillion global market by 2030. Virtual Kitchen Co. has rebranded itself now as All Day Kitchens. The company announcing a $20 million Series B funding round, bringing its total funding now to $37.5 million. It's just revealed that DoorDash CEO Tony Xu and Open Door CEO Eric Wu participated in that latest round, which was led by Founders Fund. CEO Ken Chong, who is a former Uber Eats alum, says the capital will fuel its expansion into Chicago. That's the first location it'll move into outside of the Bay Area. With its network of satellite kitchens that host 46 brands today, they offer a one-stop shop to drive training, cooking, and distribution for digital delivery. Take a listen.
There's no cost for them to get started up front. A lot of our restaurant partners really like that, and they make money on the first order to the last order. So it's really thinking about how do we build this for a sustainable long-term future, because that's clearly where the industry's headed.
It's not just startups, though, that are getting into the virtual kitchen business. Big restaurant chains are too right now. Denny's rolling out 2 concepts virtually for burgers and sandwiches called the Burger Den and the Meltdown. There's also Brinker International, parent company of Chili's, launching its Just Wings. That's a virtual wing concept, which helped to boost same-store sales in recent months. And most recently, Chick-fil-A announcing its new virtual delivery concept, Little Blue Brand, selling wings, salads, and more in Nashville. That'll debut next year. Now we just need to get through ongoing shortages of chicken, sauces, ketchup, and more. But these kitchens could also be an answer to the ongoing labor shortage because, of course, they require less labor than a traditional restaurant. Deirdre, over to you.
Yeah, Good point, Kate. Also, just more evidence of perhaps habits that many are expecting to stick post-pandemic. People keep ordering in. Thank you for that. Coming up next, the winners and losers in streaming and what to make of Disney's miss on subs. That's next. Meantime, watch Peloton, stock down about 2% this morning, but it's changed directions, now up 1.5% following that recall. And even this year, though, it is down about 40%. We are back in just a moment.
Plenty of analyst action this morning with calls on three of the earnings movers we've been talking about this hour. Dash gets upgraded at both Truist and Wells Fargo, buy and overweight respectively there. Price targets of 185 and 170, both saying the positive outlook the company guided to is too good to pass up. Would have been even better yesterday. Wells also likes Airbnb, says that stock could reach the $200 mark after its own strong results. And then you've got Piper initiating Coinbase, overweight, 335 target, says Coin has a commanding position in the evolving crypto economy. You can get more on all of these notes on CNBC Pro online. And we're back in a moment.
Disney shares down after growth figures for Disney Plus did fall shy of expectations, but who's left to benefit? Joining us this morning is Lazard's Telecom Media Entertainment Managing Director, our good friend Dennis Berman. Dennis, welcome back. It's great to see you again.
Hey, it's great to see you. When can we get back in the studio? I'm ready.
Yes, we're going to do that soon. I know Lazard has done a lot of work, actually a beautiful report on digital subs, streaming, churn, and basically where we're all going to settle out in the number of services we subscribe to. Is there a way to sum it up in a line or two?
Yeah, look, we are no doubt heading to a subscription-based economy. We're all taking in so many different subscriptions. We may not keep all of them, but there's no doubt, Carl, that we are going to be taking on more of them. The gist of what we found and some of the work we've been doing is that these can be very attractive business models. They are perhaps not as attractive as software as a service companies, and the valuations reflect that. The SaaS companies trading 15, 17 times, and these digital consumer subscription companies trading at 8 times. But really, when you come down to it, those that can produce the best scale, and that means internationally at this point, Carl, are really going to be the winners, as opposed to some of the ones that are smaller and are really having a hard time gathering customers at a fair price. But there's no doubt, Carl, this space is hot, and people are really reorienting their business models around a subscription-first approach, and you can see it in the markets today.
Now, we know that subs are driven by content, and content's expensive, and expenses pressure margins. How much of that is going to be a worry in the quarters to come as they keep trying to outdo each other?
Look, that is exactly the point, and this is where scale begets scale, and capital begets that scale. And so when you see with some of the truly global players, the ability to amortize this content across so many different audience sets really is a competitive advantage. And frankly, the biggest companies stand to be at an advantage because they can accumulate that content. I think you will see some moderation on some of these IP packages that will go for sale, whether it's sports or entertainment. But overall, because the subscription, if the churn can come down at a reasonable level, the economics really start to kick off. So the best companies and the work we've done, Carl, they're keeping 70% of their customers in a given year. That means they're also losing about 30% of their customers every year, whereas the ones sort of at the middle or near the bottom of the pack are losing almost half their customers. So more content creates less churn, creates more economic opportunity for those subscription-based companies.
Yes. That's good news for content creators. Dennis, we got some breaking news. I'm going to have to cut it a bit short today, but we'll talk a lot more in the days to come.
Okay.
Dennis Berman.
I look forward to it.
Check us back in a minute.
Now that breaking news, some developments on DarkSide, the group behind the Colonial Pipeline hack. Eamon Javers has that for us. Eamon?
John, yesterday we saw President Biden suggest that the U.S. government is going to respond to DarkSide. And today I can tell you that we are seeing reports that something very bad from DarkSide's perspective is happening to DarkSide. 2 cybersecurity consulting firms giving reports just within the past half hour. Mandiant telling us that they see dark web posts that are claiming that DarkSide has now lost access to its infrastructure, including its blog, payment, and servers, and will be closing its service, that is, its hacking service. Mandiant also says that posts claim that decryptors will be provided for companies who have not yet paid. That is, if you've been hacked by DarkSide, this report is allegedly you might be getting out for free as a result of this. The cybersecurity firm Intel 471 is also reporting that posts claim that DarkSide has now promised to compensate outstanding financial obligations to its criminal affiliates by May 23rd. And posts also claim that funds from DarkSide cryptocurrency wallets have allegedly been exfiltrated. That means their wallets were full and now they are not. Intel 471 also reporting that the cryptocurrency mixing service BitMix is reportedly inaccessible this week. BitMix is a mixing service that's important to hackers online because it allows them to mix their cryptocurrency, and it's useful allegedly in the laundering of cryptocurrency proceeds from criminal activity on the web. So that's significant if that service is now no longer available to those hackers. All of this based on reports from the dark web. You have to bear all of this with a grain of salt in the sense that all of these people are criminals. They're all posting anonymously on the dark web. They tend to lie, but clearly something is going on with DarkSide right now. No indication if the U.S. government is behind all of this, but we did see that promise from President Biden yesterday, John.
Yeah, makes me wonder if this is true, does it mean that DarkSide has been busted, or does it mean DarkSide is trying to look like it's been busted in order to clean everything up and get out of this? I guess that's the question, Eamon, quickly.
Yeah, exactly the right question. We do expect that these guys will skitter and then maybe try to reconstitute under some other brand and some other format. But for right now, it looks like a disruptive event.
Eamon, thank you for that. A couple of interesting swirling developments, Eamon Javers, as we continue to watch not just the prospects for DarkSide, but the recovery of the Colonial Pipeline. Busy week, best two-day gain for the Dow since March 8th. Have a good weekend. Let's get to the half.
All right, Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner, front and center this Friday. Why one major market watcher says the bottom is in, at least for one part of your portfolio. We'll debate the call, see if our investment committee agrees, and discuss where your money goes from here. Now, joining me for the hour today, Shannon Sakosha is the Chief Investment Officer at Boston Private Wealth. Degas Wright, the Chief Investment Officer of Decatur Capital Management. Liz Young is the Head of Investment Strategy at SoFi. Rich Saperstein, Hightower Treasury Partners, the CIO. He is also one of Barron's top 100 financial advisors. Pete Najarian is here, too. It's great to see everybody. Let's go to the wall, see where stocks are. They continue to bounce. You heard Carl say best two-day gain for the Dow since March 8th. Dow's good for 270, 0.75%. Look at the NASDAQ, a near 2% gain, 241 points for the NASDAQ. All right, Liz Young, Tom Lee, our friend Tom Lee. He says the bottom is in, at least for small caps and epicenter stocks, not necessarily for technology. He says the VIX, after surging 78%, has fallen more than 20% in the past day. He calls that a VIX peak, says that equals a market bottom. Do you agree?
I agree that technology is likely to see some challenges going forward throughout the year. I do think that today is a little bit of an anomaly, seeing the NASDAQ so strong. What happened is the market got confused by the softer retail sales and thought, oh, maybe inflation isn't going to be a huge problem in the immediate term, so we can still buy technology, we can buy those high growth stocks. I don't know that that was a peak in the VIX. I don't know that that's going to be the 2021 peak in the VIX. I think that we're going to have a rough transition as we hand the baton from policy back to fundamentals, and we try to figure out whether or not stocks can stand on their own 2 feet. But I think that there's opportunity here, and as we look at a lot of the different industry groups that have gotten beaten up, I still think there's opportunity in them, and a lot of that was a buying opportunity.
Okay, Pete Kalanovic, JP Morgan's Marco Kalanovic came on this program a couple days ago, said selling's overdone, says the bottom's close, he thinks that's over. I mentioned a big fund manager I spoke with who dramatically took up his exposure in stocks Wednesday towards the close in the big sell-off, okay? Do you think, as Tom Lee says, the bottom is in?
I don't know necessarily, Scott, that I think the bottom is in, but certainly, you know, and Tom also referred to the volatility. I don't know that the top is in on volatility either, Scott. I think we have a lot of different elements to this marketplace that certainly could continue to be very, very volatile, especially as we're dealing with all the different inflation measures that we're all keeping an eye on. We're watching copper, we're watching steel, we're watching crude, you name it, we're keeping a very close eye on just about everything that goes into it, including labor costs. So there are a lot of different elements, I think, that could cause some jerks here and there to the upside and to the downside in terms of volatility. But are we at a bottom? I don't know that we're necessarily at a bottom. That was a pretty brief pullback if you consider just a couple of days. But I do think, and I agree, I think that's an opportunity. And each and every time that we see these kind of pullbacks like we've seen, I think we have to view those as an opportunity, because I think overall we are in a very solid market. The government obviously backing us up pretty nicely with all the stimulus, and the Fed. I think there's a lot of combinations that make sense on why this is a market that can be bought on a lot of these sell-offs.
Right,
So
well,
as a matter of fact, I used this opportunity to buy quite a few different, but options, not stocks, because of the fact that I don't feel all that confident that I was looking at bottoms just the other day and suddenly we're actually moving to the upside.
Well,
I actually wouldn't be surprised to see us see some more severe drops to the downside.
It's not like you're just buying anything either, Pete. You bought snowflake calls. I mean, you went right to the heart of the sell-off and bought calls in Snowflake, which, by the way, gets an upgrade today at Goldman Sachs, which I thought was interesting, just as a statement perhaps of the overall market as to whether stocks like that have come down too far. I mean, it's corrected 34%, Pete, and you have called out these stocks.
Well, not only
You've
that, Scott,
called
but let's
out
just
the
think
high
about the fact
multiple.
that this is a stock that was $429, and then it's just come down and down and down, and it was very close to the most recent lows. It was trading about 196 this morning, and we saw some unusual option activity in there. So that's what helped trigger me to decide, you know what? I know the valuation levels is in a position where we really don't know at what point in time where we're going to see the actual numbers reflect something of a PE. But what we do know is this is an unbelievable company. It probably was way over bought when we got to some of those 400 plus levels, even the 300 plus levels. But I think you can trade it. I don't know necessarily that you want to be buying the stock right now, right here. But I think at the same time, the trading opportunities that the option world has given us really do reflect something that gives you an opportunity, especially if there's any continuation of what we have seen, at least today, in this nice little move that we're seeing to the upside. We were just trading 194. Then we saw buyers at 196. Last I looked, the stock was trading, I don't know where it is right this moment, but it was trading about 204. So I think that there's a lot of reasons and a lot of different names like this where I think from the options perspective, at least you have a risk reward that makes some sense, because buying the stock, I'm not so sure that part of it, for me at least, makes sense.
Okay. Let's talk about some of these other names. I want to talk to the highly rated Barron's guy right in the middle of your screen in our Hollywood squares, in the bottom in the center. That's Rich Saperstein. All right, so are your peeps calling you up and saying, okay, Rich, Palantir's down 56% from its 52-week high. DocuSign's down 36% from its high. DraftKings 40, Peloton 43, Coinbase 38, Cloudflare 28, Roblox 14, Unity Software's 51. Should we be buying these things now? Rich Saperstein, and what do you tell them?
Good news is we don't own any of them. And the important thing to look at with the tech sector is dividing it into the infinity multiple, the aspirational multiple, and those with really strong cash flow. So if you look at the large cap FANGs, okay, their operational cash flow is running anywhere from 4 to 5%. And the S&P's operating cash flow is roughly 6%. The cash flow of these large cap FANGs, or these large cap tech companies, is growing dramatically. In the last 4 years, Amazon's operating cash flow is up 265%. I think these names are in a whole world of their own. I wouldn't be categorizing them with the nosebleed PE multiple stocks, because they're going to trade very separately. When it comes to rising interest rates impacting the tech sector, I'm okay buying these large cap tech stocks with very strong operating cash flow of 4 to 5% when we have a sub 2% 10-year. So if we look going forward, investors should not get caught up in or trapped in the uneven and volatile economic data. It's a lot of noise. We have supply chain log jams, we have labor shortages, but the economy is booming. And we're going to have a very strong growth period in the U.S. in 2021. We'll have global synchronized growth in 22. And investors should be long equities here.
Okay. So, you speak of those high-flying, high multiple, high valuation stocks, almost like with a badge of honor when you say we don't own any of those, right? You put your 2 thumbs up. You're like proud the fact that you don't own any of those names. But it's not like the mega cap tech stocks, Rich Saperstein, have done all that well. Alphabet's down 3.5% this week, right? Apple can't get out of its own way. Microsoft and Facebook are down a couple of percentage points this week. Are better days ahead for those big mega cap techs? Are we going to start to get some traction to the upside for those, do you think?
Well, we take a 3 to 5 year view. So I would clearly own these names for the long term. And I would be using any of these short-term pullbacks in the market to add to these positions. Investors that don't have positions in these names should make them core holdings. With regard to rounding out a portfolio, clearly you've got to have value in there. You've got to have materials, financials. You've got to own some oil in this period. But I wouldn't be concerned about adding them here.
Okay. So, Degas, you must agree with Tom Lee that maybe the worst is not over as it relates to tech, because you're reducing your tech exposure. So you think more downside is ahead. When you're reducing it, what kinds of stocks are we talking about?
Yeah, so we're talking about those stocks that may have, for instance, we reduce Apple, we're reducing Microsoft, we're reducing those companies. We have a large core holding in them, but we're taking some off the table and redeploying that into what we refer to as infrastructure stocks, because we see that's where the economy is moving. As we open up, we're going to see more performance, more growth out of those companies in the energy, materials, industrials, financials. That's where we're moving to, and that's where the economy is moving to.
Wow. So you're taking some money out of Apple and Microsoft. Are all the mouths agape on the screen right now, Degas? All the tech stocks that you're looking to take money out, that's where you're looking?
Yes, because we had overweights or equal weights to all those names, and we said that given where we are right now in the cycle, we're seeing that these companies are actually, it's a crowded trade. Everybody owns it, so there's going to be less upside in the short term. This is a tactical trade, and so we're seeing less upside on the short term, but we can redeploy that now into those other names.
Okay. Shannon, you want to take that on? What do you think about Degas's moves here in the overall conversation? Pete doesn't want any part of it. You see him waving his hands? He doesn't even want any part of it. I saw that, Pete. You got to remember the camera's always on you, pal. Shannon, go ahead.
So we actually trimmed Microsoft and Apple, but we did it in November. And we did it ahead of what we felt was going to be a post-election, pre-infrastructure plan bump in cyclical exposure. And so at this juncture, I don't know that I would be running to necessarily trim some of these names that are clearly going to benefit from an uptick in spend, both on the consumer side as well as on the business side through enterprise spending on IT. I actually think that if you're not equal weight to the market, or you don't have positions in some of these large cap tech names, and I'm not just talking about the FANGs, I'm including names like Cisco and IBM. There are areas of technology that are not high flying, that are not trading at multiples, that require significant multiple expansion over the course of the next 3 or 4 quarters to justify their price. And so I would actually be adding to some of those positions over the next couple of months if you don't have weightings, because I do believe that we're going to go into a period where a barbell between cyclical names that are going to continue to be positively correlated with economic growth, along with, this business and consumer spending increase, which we're going to continue to see, is the right way to position your portfolio. Some of these high-flying names, Scott, to your earlier question, absolutely, they'll be around in 5 to 10 years. But there's going to be consolidation, there's going to be some acquisitions, and there are going to be some players that have some missteps in some of these high-flying names. And right now for us, the prices are just still a little bit too high, even with the pullbacks that we've seen.
Liz, I'm wondering, given all this concern about where rates are, and I think the 10 years we showed at the very top of the show had dropped back down to 163 or thereabouts. You think the market has overdone this whole worry fest over inflation? You know, I flagged your tweet the other day as our jump-off point because I thought it really just hit the mark. And it sums everything up. Fed still believes it's transitory. Speaking of inflation, the market seems to think otherwise. I loved the tweet earlier that I saw from my buddy Carl Quintanilla, who says, lumber down 4 straight sessions, copper on pace for worst week since April, retail sales miss. Tell me again about the overheating. So is it much ado about not that much?
This week, I think it was overdone, yes, because what we're looking at is last year was the year of market momentum. This year is the year of economic momentum. Market momentum always leads economic momentum. When you have economic momentum, inflation should be a part of that. I would argue that if inflation wasn't a part of that, something was broken. So this is what the readings should look like. But I also agree with Carl's tweet. That's why we overdid it earlier in the week, that not all the data is showing that inflation is here and here to stay. It is still possible that it's transitory, and we have to wait until later in the year to really find that out. I don't think anybody is arguing that inflation is here, is coming. I think the real question is, what will the Fed do about it? And I don't know why there's so many people that are eager to not believe Jerome Powell and not believe what he's saying, that he'll wait. I think that if we put the Fed up against a wall and said, which mistake would you rather make? Would you rather be too early or too late? I think they'd rather be too late. So I don't think there's a huge risk of the reaction function from monetary policy officials causing us a problem.
Well, they said as much too, right, Liz? I mean, how many times does Jay Powell and the rest of the gang on the Fed and otherwise voters and non-voters have to come out and say, we're not tapering. We're not thinking about tapering. Right. We're not even thinking about tapering, not for a long time. And we're prepared to let inflation run hot past 2%. And we heard yesterday from one of the Fed speakers say, I can't remember who it was like, you know what, don't even worry about inflation until 22, 23. So that's one of the points to take into consideration. Maybe the market's going to start believing that. And as one fund manager told me yesterday, the environment for stocks as it relates to the Fed is pretty clean until you at least get to August and you start having to worry about what they're going to say at Jackson Hole if inflation actually looks a little bit more sticky later in the summer, Liz.
Yes, that's true. And the other thing that the Fed continues to say is that we're going to be on hold until the recovery is complete. And then you have to ask, what does that mean? To me, that means growth that is above pre-pandemic levels. That means inflation that is stable. And that means the job market is back and is healthy. And as we all know, the labor market is the one thing that continues to be an issue here. So if they're going to wait until the recovery is complete, I don't think we're at risk of a Fed move anytime in the next few months. And there's also this kind of cycle. If they start to talk about tapering, the next step is to actually taper. Then the next step is to actually move rates. They don't want to start that too early because the market reacts to it as soon as the words come out of their mouth.
All right, let's bring in our headliner today, Anthony Scaramucci. He is the managing partner at Skybridge Capital. Anthony, it's good to see you. Welcome back.
Good to be here, Scott. Thanks.
So you talk to a lot of big smart money, so-called smart money. What do they think about the market right here and right now?
Well, listen, I'm sort of in Liz's camp on the market. I think that you've got a little bit of overheating, but not a lot of overheating. And frankly, you can't get the inflation numbers that would scare the Fed without wage increases. And so we've been debating all week on CNBC about labor shortages and supply shortages related to labor. But if you actually look at the wage data, Scott, it's not moving. It's been sticky flat, if you will, and in some cases sticky downward for middle and lower income people. And so until you get wage growth, you're not going to set alarm bells off at the Fed. And so I think the bull market is very much so intact. It feels like a Goldilocks situation where you're getting some price increases in commodities, and it's going to lead to an acceleration of likely 24 months of economic growth. But you don't have the inflation that would scare the Fed at this time, which is a reason why I think you're going to see a cycle back into those growth names that some of our panelists want to avoid.
But the fear, though, to what you just said is that you're going to have wage inflation to entice some people to get back to work. And then you're going to really start to have some more sticky inflation. And you're already seeing some major companies like McDonald's, you know, raising wages, and you've seen others do the very same thing. The thought process is that maybe you're going to see even more.
Well, listen, that's going to happen in a weird way. It's happening in a black market sort of way. You know, I'm obviously in the restaurant business in New York. It's hard to find people at certain prices. And remember, if you're paying $15 an hour for the dishwasher, well, then the sous chef's got to get $22 an hour. And so you're going to move the pricing umbrella for everybody when you raise wages. But I think the mistake that people are making is they're suggesting that blue-collar people would rather sit at home and collect welfare. I honestly don't believe that. They're just super creative. Some of them have cash jobs, off-the-books jobs, black market jobs, if you will, and they're out there working. And so until you can get the price, the supply-demand equilibrium to intersect with each other, they're not going to return to those jobs that they were doing pre-COVID. So I don't think people are sitting at home, Scott. I'm just never going to buy that argument.
Well, maybe there's a multitude. Maybe there's a multitude of reasons. I don't think we're suggesting that it's the only reason because of the government support they're getting, but I think it's part of the punch bowl, if you will, as to why we're witnessing that
story. There's always a percentage of people like that, but I just don't think it's the greater totality. But if you're making the point that as the economy starts to accelerate, people will lift the wage ceilings that they have to get people back to work, they will. That will start to show up in the Fed's data, and that will raise alarm bells. You'll start seeing tapering, and you'll start hearing whispers of rising rates. But remember, we had rising rates for a 24-month period of time, and it didn't necessarily impact stock prices. If anything, the stock market was still going up. And so I'm not super worried right now. You have had tremendous pent-up consumerism. The last 15 months, many people have been stuck at home, and I think that's gonna come out of the can like those snakes used to when we were kids.
Right.
And you're going to see a very aggressive economy over the next 24 months.
Let me ask you this. I mean, anybody who's followed you on Twitter knows how bulled up you've been on Bitcoin lately. You have your new Bitcoin fund, and you've had some major events in the last week or so, right? Elon Musk now, no Bitcoin for Tesla. I'm looking at a headline which literally moved 1 minute before our show began. Square has, quote, no plans to buy more Bitcoin after their own $20 million loss. Are you worried that we have a near-term top that was put in Bitcoin?
Well, listen, there obviously was a near-term top put in. I mean, the Coinbase IPO, you had a $64,000 high on Bitcoin. It's dropped consistent with its volatility in the past. I sort of see Bitcoin as somewhat anti-fragile here. The notion that you've had this slurry of bad news and we're still at 50,000. When you and I talked about Bitcoin in December, when we were launching our Bitcoin fund, it was in the high teens, low 20s. So I think we have to step back a little bit and look at the forest. You've had Bitcoin emerging as an asset class, going from 20,000 to, let's say where it is today, 50,000 in a few short months. I think that tells you that there's a tremendous amount of demand out there. You've had some bad news here. People have stepped in to buy it. There's a lot of institutional demand, Scott. You know, one of the good things that we're good at Skybridge, we have 34 managers, hedge fund managers in our core portfolio. We're tracking 1,200 managers, but we're talking to everybody on the street. There's a tremendous amount of demand long-term for Bitcoin. Stan Druckenmiller said on our airways earlier in the week that he believes it's an asset class here to stay, and it will be a measure of a store of value. We obviously believe that. And so we've been buying Bitcoin on these dips. Could we be in an interregnum period here where it trades in a trading zone where we are now? Yes. But I think with that bad news already in the stock, I think you're seeing sort of a floor in prices here. Now, of course, I could be wrong about that, but I like the long-term trajectory of Bitcoin. And we're recommending to our clients, you don't have to be a Bitcoin maximalist, Scott. You can own 1%, 2%, 3% of Bitcoin included in your asset class. If we're right, you're going to be very happy with your portfolio over the next 5 to 10 years.
But how do you, sorry to interrupt you, but how do you counter, how do you counter the narrative of, you know, everybody seems to be wanting to pitch Bitcoin, but it's not a store of value. How do you make the case that it is? How can it be when it's as volatile as it is? It may be a store of value, all right, but it's a store of fluctuating value.
Listen, you have to accept that it's an emerging asset class. Think about what Elon Musk was able to do to the price of Bitcoin in the last week. You've only got about 2% global saturation right now. So we're in the very early innings of Bitcoin, if not the top of the first inning. And so I'm just looking at the metrics of what we apply to the store of value equation over 5,000 years of human history. That's scarcity, that's the trust association, that's the exponential growth of the network. Bitcoin has all of those elements, but it's emerging and people are scared of it. And our 97-year-old great-grandfathers are saying it's the worst thing that's ever happened to civilization. But our 25-year-old kids are saying, you know, I'm going to own Bitcoin for the rest of my life. And so when you have that confluence of events, you're going to get volatility. But let's just think about Amazon for a second. Amazon, you had to suffer through 7 or 8 spells where Amazon dropped 50% or more before it became the Amazon of today. And if you put $10,000 in Amazon on its IPO on May 15th, 1997, it's worth over $21 million today, Scott. So it takes diamond hands to hold Bitcoin right now. And I would say it's an emerging store of value. Can we look at it today and say it has all the qualities of gold? No, we cannot. But it only has 10% of the market capitalization of gold. If that network continues to expand the way we predict it will, over 1 billion users over the next 4 years, I think you're going to get there. I think people are going to look back and say, well, that was an obvious investment. Why was I so scared to allow myself to get juked out of it, even if just for a small amount of it?
I saw what you did there too with that calling out Munger and Buffett. I caught that. I know exactly what you're doing.
Well, I was not in the
yes,
script.
exactly. You did. It was Rich Saperstein.
I didn't say they had a combined age of 187 years or anything like that. I was just focusing on the 97.
I knew exactly what you were doing. Rich Saperstein, do you have something for Anthony Scaramucci? I mean, how do you, Rich, view Bitcoin for your own clients? They must be asking about it, and for all I know, you own some, and I don't even know. So you tell us.
Well, I have more of a normalization question where, you know, our goal as market participants is to operate in a market without the support of the fiscal and the monetary policies. And now we're slowly getting into the position where the fiscal spend that might be coming is viewed negatively, as if it's too much, we have enough stim. And then on the monetary side, you know, maybe it's time to start tapering. So I'm curious how, you know, Anthony, you're viewing when and if the Fed starts to talk about tapering, and also the reaction the markets might have if we do or do not get any fiscal stim. And it's really in our goal towards getting into normal markets, and also where we can get into hunt and fish and get a nice porterhouse.
Well, now, I also noticed, Saperstein, you completely deflected from the question that I asked you. What's up with that? Do you own Bitcoin? Are you putting your clients in Bitcoin? Before you answer, Anthony, I want to hear that from very deft move from Rich Saperstein of Hightower Treasury Partners.
And we are not putting our clients in Bitcoin. I do own something related to mining. So I own a miner, but I don't own Bitcoin directly.
Okay, why? Why are you not putting your clients in Bitcoin?
Because I suffer from what Anthony's talking about.
Oh, you're too old?
Basically, basically I like liquid assets. I like things I understand, and I've stayed away from it. And it hasn't hurt me at all relative to the performance we've been having.
Okay.
But there's no question that my kids, they're in it. They're participating. I think Anthony raises a great point between a 97 and a 25-year-old. This is a transitional, you know, investment that younger people are making, and that's the handoff.
Okay, I at least wanted to get an answer from you, Rich Saperstein. All right, Anthony, you can answer the first question that he asked you about the Fed. We had to get the facts out first.
Listen, Rich doesn't need advice from me, but the generic advice I'm giving to people is learn more about it. Don't be afraid of it. And for us, we'd like to suggest everybody own a little bit of it. And I would tell Rich right now, once you own a little bit, it's what Saylor said to me. Once you buy your first Bitcoin, you're going to be saying to yourself, wow, I need to be longer Bitcoin. On the more philosophical question that Rich is raising about stimulus, fiscal and monetary policy, we have to deal with the world the way it is, not the way we want it to be. In a normative world we wouldn't have those two things, and we'd have more price discovery in the market, and we'd be less prone to bubbles. But in the world we're living in right now, if we step back 50 years from now and write an economic historical analysis, we were in a massive transition that started in 2007. The Fed stepped in to try to help the near-term economy get through these massive transitions. One was a global financial crisis, one was a pandemic, and the Fed, both the fiscal side of it and the monetary side of it, are going to be with us, Rich, whether we like it or not. And so we have to deal with the world in that way. They're not leaving anytime soon, is my message.
Right. Anthony, I got to bounce. It's good to see you. We'll see you soon. That's Anthony Scaramucci, Skybridge, of course, with us today. Have a good weekend. We'll see you soon. Coming up after the break, Disney's the worst performer in the Dow today. We'll talk about that stock, what you should do if you own it. We'll do it next.
Super interesting conversation there. Sorry, just before that break, so I was reading something on my computer, but about Bitcoin. I think it's really strange that there's so many traditional disparity between institutional investors and a lot of the retail folks all pick up on crypto, Bitcoin, and a lot of the institutional financial type investors are still staying away from it. Their customers. It's very
Strip. Israel says that it's targeting a network of tunnels built by militants to stop Hamas rocket attacks. Democrats and Republicans on the House Homeland Security Committee announcing today that they've reached a deal to create a bipartisan panel to investigate the January 6th assault on the Capitol. But then minutes later, House GOP leader Kevin McCarthy said he didn't know anything about it and has concerns. And in Oklahoma, a high-speed police chase ending with a crash. So the suspect here was wanted for threatening someone with a gun. After that collision that you see there, well, he attempted to get away on foot. Fortunately, no one was seriously hurt, but a nearby business owner of a liquor store telling the local NBC station, apparently it's never a dull moment on that corner. Scott, I'll send it back to you.
Okay, we appreciate it, Rahel. Thank you, Rahel Solomon. All right, Disney shares, mentioned it before the break. Worst performer in the Dow today. They missed on streaming subs. That's where we're going to begin the conversation, because that really, Shannon, is the headline and the concern there, right? Okay, so maybe they had some of the same issues that Netflix had, but Disney charges a lot less for its streaming service than Netflix does. So if that's slowing and something you're already paying less for, how much of a concern is that to you?
Well, it is a little bit of a concern. We trimmed the stock back on March 15th. It's still a large position for us, but we felt like a lot of the enthusiasm around streaming and the stay-at-home story was going to potentially be in jeopardy over the course of the next couple of quarters. But when you look at the actual data and you think about the progression of what happened with Netflix and their subscribers, this is not at all dissimilar to what Disney's reporting. You want more international subscribers, you lower the price. Average revenue per user becomes a lower number as you begin to grow the service over the next few years. It's only recently that Netflix has been able to create a path towards increasing prices here in the United States and had those be sticky enough so that they're not losing subscribers. So I think when you look at Disney right now, if you're thinking about buying it, there's two things on the horizon that are likely to happen. You've got parks revenue that's clearly going to increase. You're going to get more free cash flow, which is, by the way, why you own the stock before Disney Plus. And you could see a dividend next year. So I think if you don't own Disney now, this is a good entry point. I have a full position, so I'm not adding to it here. But I wouldn't get too caught up in the subscriber numbers because this is a path that we've seen before. And frankly, as a Netflix owner, it's not one that keeps me up at night.
Degas, you own it. You suggest there's too much focus on the subs. How can there possibly be too much focus on the subs? That's the whole game in town. I mean, not the whole game, but you know what I'm talking about.
Well, Scott, I would disagree with you because the subscription Disney Plus only makes up about 25% of the revenue. If you look at the largest portion is the media, and that's about 45%. So what's going to happen as we reopen? There's going to be more ad dollars. Also, when you're looking at the studios, another about 15%. So these are the places that Disney has a great opportunity to grow. It's a transformative company, and this is a company that we see that's going to have outperformance going forward.
Right. I mean, we are talking about a growth engine, right? It may be a smaller part of the revenue mix, as you say, but it's probably a much larger part of the growth trajectory of a Disney, wouldn't you say?
Well, once again, I'm breaking it down by where the revenue comes from now. It's a fast growth. However, you have to look at where is the majority of the revenue coming from, and that's where Disney actually outdoes everyone else in the field. There's a lot of competition in streaming, but where does Disney dominate? Parks, studios, media. That's what you focus on if you're a holder, a long-term holder in Disney.
Yeah, our parent company, Comcast, has something to say about that domination with the parks and the media and all that, too. Just saying. Universal. All right, we'll take a quick break. Pete's got unusual activity. We'll do it next. Before the break, check out the S&P sectors. Energy's leading. Consumer staples are lagging. We're back after this. All right, Pete, unusual. What do you see for us today?
All right. Yeah, I'm going to start off with Airbnb, Scott. Now, this one's pretty interesting because this is one of those stocks that was well over $200 a share. It pulled back significantly. Yesterday, when the stock was trading about 134, we had some buyers of the May 155 calls. As a matter of fact, they bought about 5,000 of those. But today, they're back in here again, and now they're buying about 10,000 of the May 150 calls, Scott. So pretty aggressive buying. Stock was about 138 at the time. It's jumped up a little bit, not a lot yet. But those options were going for anywhere between $1.70 and a little over $3. So pretty aggressive buying 2 days in a row. Somebody expecting this to be a stock that's going to move very, very rapidly because May expiration is coming up very quickly on us. Number two, I've got an interesting one for you. Under Armour. You and I know this stock really, really well. Stock was just underneath 19, and we got a buyer of 6,000 of the May 19 calls. Again, expiring very soon. But those options were only going for about 35 cents to about 50 cents. So in terms of cost, not a lot of cost, but expecting a pretty rapid move out of both of these stocks over the next week or so to see how fast can they actually explode to the upside. Under Armour's already there, but can Airbnb get up to those kind of numbers? This could be pretty interesting if they do.
So you own the Under Armour calls?
I do. I own the Under Armour calls. I also own the Airbnb calls as well.
I ask you about Under Armour because for somebody who hasn't liked Nike for such a long period of time and has always said on this program that you prefer Lulu, is this going to be just an options play for you for UA, or you see yourself buying the equity too?
No, I see this more as an options play. I like the company. They do have a lot of missteps, though, Scott, and that's bothered me for a really long time, and they seem to do this often, whereas Lulu did it early on, but ever since then, they've been actually executing to perfection, I think, to the upside, especially with the e-commerce. So Lulu's still my stock when I'm talking about the athletic world, the athleisure world.
I gotcha. All right, Pete, thank you. Three Dow stocks. They are set to report earnings next week. We'll talk about them. Home Depot, Walmart, Cisco Systems are the three. We'll set you up when we come back. All right, welcome back. A big week of earnings coming up. There is the calendar: Walmart, Target, Home Depot, Cisco, and more. I know most people own Home Depot. I do want to start out with Walmart, though. Pete, you've got the calls, and we'll get to Depot in a second, which you own as well. I'm looking at Walmart at 139.50 right now. The 52-week high is 153 and change. Is this the week, or is next week going to be the week that sets Walmart in motion to get back towards that level?
I do think so, Scott, and I think so because I think both Walmart and Target, who's reporting, I think they're just positioned so well coming out of the pandemic, going into the pandemic, of course, because of the essentials, but coming out of it as well. And just like I talk about with Target, I think there's a certain stickiness there, Scott. I think all of the new subscribers to all the different types of shopping that people are doing, I think that's going to be sticky for Walmart. The only issue, of course, is the fact that they have so much on the grocery side that does affect their margins. But other than that, I think it's going to be a pretty big quarter once again for Walmart.
Now, without telling me that Brian Cornell is the greatest human being on planet Earth, Pete, which I don't want you to do.
Look at the stock, man.
I don't want you to do.
Okay.
Don't do it.
All
I
right.
want you to tell me.
Don't do it.
I want you to tell me why Target has so dramatically outpaced Walmart from a share price perspective, okay? Over a year, 76%
really
for Target, 13% for Walmart. Over 1 month, 3 month, and year to date, Target's in the green, handsomely so. Walmart hasn't done anything, and it's negative. Why?
Right. Well, I think it does come down to the fact that Walmart did make that move and then it paused, right? And meanwhile, Target, because of the stickiness that I'm talking about here, and I'm talking about all these digital sales, all the different things that Target's been doing that everybody's been trying to do as well. But the execution that they've done there, Scott, I think when you look at it, and I've always brought this up, and there's twofold really right now what we're looking at. Target still today trades at a cheaper valuation than Walmart, just so everybody understands. So it's still less expensive despite the fact that it's made the move that you've talked about. So when you look at this and you look also at margins and Target's margins versus Walmart, it's not even close because it's only 20% of their business model is in the grocery section. So they just continue to do these partnerships. They continue to do the right thing. And when you look at it and from almost every perspective and you put one against the other, you can understand why Target's outperformed. And they still have room to outperform, I think, going forward.
All right. Now to the deflector, otherwise known as Rich Saperstein. What about Home Depot? Because, Rich, this is a week in which we saw the ITB, the XHB, a lot of the home builder names pull back somewhat dramatically. What's up with this trade now?
Look, we like Home Depot. 2% yield, 25 times earnings is a bit expensive, but we have a 5.5% free cash flow yield, so we like that. Now, why do we own the stock? We have this urban to suburban flight. There's incredible demand going on now in these stores. You can hardly get in there on the weekends. There's high consumer savings rate, stim checks, increasing demand for homes in the suburban and the rural areas, and high savings rates. So we think earnings are going to be very strong. I think supply chain disruptions are a problem. I'm trying to buy a plastic resin shed for my garden. I can't find it anywhere. So I think the supply chain is really going to be the key to Home Depot managing that going forward.
All right, we'll see. All right, Ask Halftime is next. You can send your questions by video. We'll play them on the air. Email us, askhalftime@cnbc.com. We'll be right back. It is time for Ask Halftime, and Shannon, you are up first with a video question.
Hey, CNBC, Logan Schreier here, recent grad from University of Alabama, Roll Tide. Was just wondering on your thoughts on JD, the China stock.
All right, Shannon, what do you think?
Well, thanks. So JD as a competitor of Alibaba, which we own, and we think about, the potential for what Pete talked about earlier, which is transactions being done digitally. That's going to continue for the Chinese consumer as well. There is going to be likely some overhang as it relates to China-U.S. relations on Chinese stocks over the next couple of quarters, but JD might actually outperform Alibaba in the short term, given the spend that Alibaba is making.
Okay, thank you. Liz Young to you from Daryl. Have I missed the window to own airline stocks? What do you think?
Hi, Daryl. I don't think you've missed it. There are two sets of airline passengers. The first set is the leisure passenger, who is price sensitive. The second set is the business traveler, who is not as price sensitive, a higher margin passenger. That hasn't come back yet. More money to be made.
Okay, thank you. Pete, video question. Let's watch.
Hi, this is Trey from Pete's home state of Minnesota. I wanted to get Pete's thoughts on CELH, Celsius Holdings.
All right, what do you think, Pete? Celsius Holdings.
Well,
it's up 706% in the last year.
Yeah, it's a name that I bought a while back, and I love it. My daughter talked me into it, and I think it's a great company. They just had earnings the other day, and you take a look at those numbers, and you can understand why I like it. They're also starting to steal a little bit of the market share from Red Bull, from Monster, and I think that's going to continue. So I love the name, and I think it's going a lot higher.
Okay, Degas, roll the video.
Hi, I'm Julian from Germany, and I am a young investor. Pfizer, BioNTech, and Moderna are delivering hundreds of millions of vaccine doses and will make billions in additional earnings. So why are these stocks going down? Is something fundamentally wrong now with vaccine stocks, or is this a buying opportunity? Thanks, and love the show.
All right, we appreciate that and appreciate the question. What do you think, Degas? Maybe it's about the talk about sharing the IP. I don't know. You tell me.
Yeah, Julian, first of all, this is a great question by a young investor. What we like, and we own Pfizer because of the deep pipeline. What's occurring with the this particular with the vaccine, that's been very positive. But what's happened with the pandemic, there's been less doctor's visits, and so there's less prescriptions being written by doctors, and that's impacting revenues. But so we like Pfizer. Out of those three, less volatile, deeper pipeline, go with Pfizer.
Okay, thank you. Lastly, Rich Saperstein to the video.
Hi, this is Ryan from Ohio. Just got my tax returns back and I'm ready to buy. Should I invest in GM or Ally? Thank you.
All right, it's got some cash in his pocket, looking to buy a stock. What do you think?
I'd go with GM, which is the comeback kid, especially if you looked at that mid-engine Corvette, which Scott's probably going to go buy at the end of the show. They've got exciting innovation, design. They got a great partnership with Cruise and Lyft. So I'd be owning GM here.
Trying to get back in my good graces. I know exactly what you're doing. All right, we'll take a quick break. We'll come back. We'll do final trades next.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
All right, let's do finals. Liz Young, start us off, please.
I am looking at consumer staples. I think no masks means more parties, and that means people are going to buy food and beverages, even if the prices go up.
All right, sounds good to me. Shan?
Salesforce, you've probably heard it was down this week. That's great. Huge total addressable market and a flexible platform that can be used for a lot of different types of businesses.
Mr. Wright.
Yeah, so we added to EOG Resources, one of the largest independent oil and natural gas providers. And we like the fact dividend yield of 2%, plus the management bonuses are going to be tied to transition carbon emissions. Outstanding company.
Okay. My man Pete, what do you have?
I'm seeing a lot of stuff that's connected to the whole reopen trade, Scott. One of the areas is the casinos. I see a lot of activity in there. It seems like almost every single name is hitting, but I'm going to give you a Las Vegas Sands. They keep buying and keep buying and keep buying in the options world. I think it's going higher.
I got only 30 seconds, Rich Saperstein, but you bought Mercado Libre, Nextera Energy, and Zoetis, and you sold Merck. You want to give me a quickie? Less like 10 seconds?
I like Zoetis because pet ownership has increased, and they sell into the pet market. Nextera Energy is a green play and an urban to suburban flight to Florida.
Okay.
And I would really focus on that as a kind of a high price utility,
right.
but both those companies are going to have rising cash flows.
All right, good stuff. Great weekend, everybody. The exchanges now.
Thanks, Scott. I'm John Fort, and here is what's ahead. As the CDC changes its guidance on masks for the vaccinated, the reopening names are taken off. So is the lockdown trade dead? Jim Cramer thinks so. We'll explore what's next for these markets. Plus, digital nomads. If you can work for anywhere, you can make big bucks. We'll look at the cities that are paying folks bounties to move there. And investors are feeling good about GoodRx's acquisition announcement, sending the stock higher. But should investors worry about increased competition from Amazon? The co-CEO joins us us in an exclusive ahead. But we begin with the markets and what's been a wild week, and Dom Chu has the numbers.
It's still going to be down for the week, but it's all because of the beginning. The last couple of days have been very solid, and it's not just the reopening trades, broad-based for the most part in terms of the rise off of the lows that we saw earlier on this week. The Dow Industrial is currently up 340 points, 34,362, 4171 the last trade for the S&P, up 1.5%, an outperformance of the NASDAQ Composite, up by over 2%, 13,397 the last trade there. It is a Friday, so let's take a look at the sector action over the last week. In that time, it's been the consumer staple stocks. That sector is the only positive sector in the entire S&P 500 so far on a one-week basis. Meanwhile, technology and consumer discretionary, the biggest laggards. We know about that tech story. Amazon and Tesla, remember, are consumer discretionary stocks as categorized by S&P Dow Jones indices. They drove a lot of that underperformance in technology and consumer discretionary. That's the sector checkup. Usually I show you some stocks. I'm not going to show you stocks today. I'm going to show you commodities. Why? Because lumber, copper, and corn. Look at those losses that we're seeing right there. Corn is down 10% over the course of the last week. Copper is now down 2%. Lumber down 7.5% as well. Remember, all of these commodities surged on some of those inflation fears, supply constraints, growing demand, and whatnot, but they're now falling. So, yes, still very much near elevated levels. Huge gains that we've seen over the last year, but we're pulling back a bit. Could this be the top? Some traders are contemplating that right now, John. And the other question is, are these rising prices for commodities transitory or not? Back over to you.
Yes, that is a big question this week, Dom. Thanks. Markets are moving past, apparently, those inflation concerns and weak economic data today anyway, focusing on optimism about the reopening trade following those new CDC guidelines. That's why the NASDAQ, I guess, is up 2%. So what does the combination of all these factors mean for stocks? Joining me now is Hugh Johnson, Chairman and Head of Investment Strategy at Hugh Johnson Advisors. Hugh, what do you think? Is this inflation thing transitory or not?
Yeah, I definitely think it is. I do a lot of number crunching, Jonathan, and I do a lot of crunching on the inflation numbers, and we're going to have some troubling numbers, not only for the second quarter, not only for the month of April like we saw this week, but for the coming months. But when we get past 2021, when we start into 2022, you're going to see much better numbers. Now, what do I mean? I really mean we're talking 3 to 4% year-over-year numbers for the time being, and that means, say, the next 1, 2, or 3 months. And those are pretty numbers that are going to be pretty disturbing. But when we get into late 2021 and 2022, the year-over-year numbers are going to come to 2.2%. That just simply says that this is all transitory. Hard to believe now, but all my numbers point to that very outcome. So I'd be optimistic on it. There's a lot of stocks that have been really hit hard because of concerns about higher inflation and higher interest rates. And those are the ones that have been hit so hard. Dominic referred to them. He talked about consumer discretionary. He talked about technology. That's where you can find some real value right now, and you won't have this value for very long.
Well, Disney's taken a little bit of a hit year to date, and it's down another 2+% today, but you like it. Why?
You know, it's obviously everybody's troubled by the numbers and the streaming numbers. The number of new subscribers was a little bit disappointing. That was bad news. Of course, the other news, theme parks, movies, that also was not good, primarily because of the long-term lockdowns and problems we've had with the U.S. economy. You know, in time, and this is the important thing, in time, we're going to see the economy recovering. It's going to be uneven, not the same, not even month to month, but we're going to be seeing a recovery through the remainder of 2021 and 2022. And as we see that, it's going to show up in the numbers of Disney, and it's certainly going to show up in their earnings. So this is an opportunity, in my judgment. It's a little risky. I understand that. I understand the concerns about valuation. So maybe you take half a position now and wait a little bit for the other half of the position. But in my judgment, opportunities in technology, consumer discretionary, and a company like Disney don't come along every day. And when they do come along, you've got to have a little bit of courage and step up and maybe start to build your positions.
Yeah, Hugh, that's what I always wonder about is the entry points, right? Because too often investors make the mistake of thinking, well, things are fairly valued the moment I start looking at it. I mean, but Apple's another one you like. It's still over a $2 trillion market cap. It had a nice run over the last year. Why is now a good time to buy it?
Well, you know, I wish I had a nickel for every time somebody said, or I told somebody I wanted to buy Apple or add to my positions in Apple, and they said, no, you shouldn't do it. Look at the big run we've had in the company. Believe me, I honestly, I've been adding to my positions in Apple continuously for about 4 years. Given the, I mean, there's not much you can say. The cash position of the company, the cash flow in the company, the success of all of their products, which keeps getting better and better. It's hard to bet against Apple. And again, here's another case in point. In the case of Apple, you get opportunities. When the opportunities come along, my experience over the last 2 or 3 years is you take advantage of that opportunity and add your position. Now, if you feel a little uncomfortable, whether we're talking about Disney or we're talking about Apple, staging in is always a good idea for an investor, which really means buy a third of your intended position now, maybe wait a month for another third and a month for another third. Stage it in or dollar cost average your way into the position if you feel uncomfortable. But believe me, we don't get these opportunities very often in an ongoing bull market. And the case for an ongoing bull market now is extremely strong.
Well, speaking of adding to positions, we're going to add to our position on experts. Joining us now is Gautam Khanna, the senior portfolio manager at Insight Investment. Well, let's talk again about inflation and interest rates. You also think that this environment that we've been seeing is transitory, but something interesting happening in fixed income here. Now it makes more sense again, you say.
Yeah, absolutely. We're very much in the same camp as the Fed. Inflation is transitory. What has changed structurally in the US economy? I mean, we spent the last decade with QE trying to prop up inflation, and we have COVID. Now, post-COVID, are we likely to see inflation that's materially above? Perhaps not. I would caution viewers to not extrapolate from short-term prints and make long-term decisions. And to your point earlier about fixed income, the fact that, if you remember the word TINA, the term TINA, well, now perhaps there is an alternative to equities. Certainly prior to February, the 10-year yield was below the dividend yield of the S&P 500. Now it's well above that.
All right. Always good to have options, as opposed to when there is no alternative. Gautam Khanna and Hugh Johnson, thank you.
You're welcome.
And now over to the municipal bond market, where investors have poured $39 billion into muni debt funds so far this year, the most over the same period since 2008. And in fact, muni returns have beaten those of corporate bonds and treasuries. My next guest points out that there is yet more money, nearly $1 trillion, to be distributed to state and local governments, which is going to ring in something of a golden age for public finance. Let's bring in Tom Kozlik, head of credit and strategy for Hilltop Securities. Tom, this is a lot different than what a lot of people were looking at a year ago when we saw all the business shutdowns, the concerns about local tax revenue, and the idea that even munis weren't safe. Is it stimulus that's really turned all that around?
So it's a combination of stimulus, but even though there are many people who were expecting the worst, and there were a lot of forecasts through the end of last summer, even into the fall, that were pretty negative, for the most part, overall revenues didn't really drop as much as many of us thought. But I think that, so really, the demand is really up because credit quality as a result is assumed to be strong, but also, that tax advantage from municipals is something that folks are really considering also.
Now, even in Illinois, right, we're seeing 3-year bonds sold at yields near 1%. Illinois has got issues. So that makes me wonder if, the embrace of munis on this side of it now, a year later, might be overdone.
In the near term, near term meaning next year or two, maybe 3, one of the things that we're expecting is, something like a golden age for public finance. There was 350 billion. Well, I should say there is starting to be 350 billion of federal relief that's going to flow through to state and local governments. And then there's another at least 300 billion that's going to flow through to other sectors like to school districts and higher education. Illinois is going to get a decent chunk of that 350 billion, and then they're going to get an advantage from some of the higher education money, K through 12 money. So I think that in the near term, this is one of the reasons why a lot of folks are expecting that credit quality overall is going to be pretty good in the munis.
So is this a golden age, or is it a golden moment? I mean, how long is this going to last? What should investors kind of think about or worry about as they examine munis right now?
That's a good question. From my perspective, I think that for the next year or two, we're not expecting downgrades to outpace upgrades. I'm expecting that upgrades are going to be outpacing downgrades for the next year or two. That being said, investors need to remember that there were several I shouldn't say several. There were a handful of meaningful states and some cities that were structurally imbalanced before COVID. I am not certain that this is going to be enough for them to be able to correct those structural imbalances that are, years, in some cases, maybe even decades in the making. And so, but in the near term, I think that overall upgrades are going to outpace downgrades.
So very often there's a political backdrop to this. Are there particular triggers, signals, elections that you would be watching, balance of power to determine when this golden moment might be over?
I think that it's a lot. That couple of year period is locked in right now. The runoff elections in Georgia really helped decide that. And I think that it's going to be up to how it is that state and local governments and other entities plan and then spend this relief money and make decisions going forward that's going to really help determine that.
All right. Tom Kozlik from Hilltop Securities, thank you.
Thanks very much.
Now coming up, cities across the country paying people to move to their state, some giving up to $20,000. We're going to look at where, why, and who is eligible. Plus, businesses are responding to the CDC's new mask guidelines in very different ways. We've got details. The Exchange is back in 2.
This is The Exchange on CNBC.
Welcome back to The Exchange. Dozens of cities are offering cash incentives to workers who are willing to relocate while they continue to work remotely. Diana Olick joins me now with more on these so-called digital nomads. Diana.
Yeah, John, there were a few of these programs before the pandemic, but it is now suddenly taking off, and demand is off the charts. Almost exactly a year ago, when COVID was at its worst, Lindsay Marvel packed up her Brooklyn apartment, bought a car online, and drove to Tulsa, Oklahoma.
You're just in this survival mode, and I just was terrified.
A Tulsa nonprofit offers remote workers $10,000 to move in. A year later,
it's been a blessing. I wouldn't want it any other way during a pandemic or any other time.
Lindsay recently bought this home thanks to the $10,000 and to the fact that Tulsa is much cheaper than New York. She's also met a large network of so-called digital nomads like herself through the program.
I think I've made more friends in this year during a pandemic than I ever have in college or any other time you're supposed to be connected with many people.
Tulsa is one of a growing number of cities offering cash incentives to remote workers. A new program in West Virginia is offering up to $20,000.
West Virginia is the house that built me.
The $25 million program is funded by executive chairman of Intuit and state native Brad Smith. He says he's capitalizing on two new trends.
The first is a shift towards remote work, and the second is a shift in geographic preference to more rural settings. And those happen to intersect perfectly with West Virginia's most valued assets, which are our welcoming communities and our outdoor recreational amenities.
Those communities and amenities are in big demand. The new program will open with 50 slots, but has already received over 7,000 applications. The goal over 7 years is to attract 1,000 new residents who will bring their purchasing power while not taking up local jobs. The same strategy behind Tulsa's program.
Because we are from cities like Brooklyn, Seattle, we don't really have a sense of what we're supposed to pay for something. And so people are willing to pay a little more.
Because the return can be invaluable.
I know I've made the right decision.
Now, since moving to a small town might be scary for some people, these programs are trying to ease those fears. They're advertising things like average wireless speed, median home price, distances to a major airport, shopping center, even the distance to the local tractor supply, because, John, you never know at the last minute when you might need a tractor.
It's almost like attracting businesses, except not with tax incentives. But I wonder, Diana, is this easy come, easy go? Are these people going to stay, or is there a cohort of the digital nomad that might go chasing incentive to incentive, moving from Tulsa to West Virginia, and then so on?
Well, actually, a lot of the programs say you must be a resident for a certain amount of time. It varies program to program. But if you look at someone like Lindsay, she bought a house. She intends to stay there for the long term. And she's seeing a lot of the people that she met through the program who are also buying homes. They may use it perhaps as their primary home and then have a second home somewhere else. But they do like the idea of staying. And that's the point of these programs, is to get people to stay.
Yeah, community, doubtless a big part of that. Diana Olick, thank you. And now coming up, it wasn't looking so good before the open, but shares of GoodRx rallying on acquisition news. We're going to speak with the co-CEO about that and the threat coming from Amazon. The Exchange is back after this. Welcome back to the exchange. Markets right now higher across the board. You can see the Dow up 350 points, S&P up almost 1.5%, and the Nasdaq leading that up 2%. Here are some of the individual movers this hour. DoorDash leading the flexible economy stocks higher, and it's on pace for its best day ever. Despite posted a wider than expected loss in its most recent quarter, revenue was strong. The company delivered guidance for 2021 after revenue tripled from the previous year. Shares of Zoom Video also heading higher. That stock is leading the NASDAQ 100 today, on pace for its best week since February as it tries to break a 3-week losing streak. And AMC, the movies, on pace for its 6th straight day in the green as the reopening trade gains steam. A move higher today would be its longest daily winning streak since the summer of 2019. Now to Rahel Solomon for CNBC News Update. Rahel?
Hi, John. Hello, everyone. The city of Columbus, Ohio, will pay a $10 million settlement to the family of Andre Hill. He's the black man shot to death by a white police officer last December. Hill was coming out of a garage holding a cell phone. It's the largest settlement of its kind in the city's history. The police officer, meantime, has pleaded not guilty to murder charges. A National Security Council spokesman had nothing to say when CNBC asked him today if the U.S. government is responsible for forcing the dark side hackers to close down their operations. Today, the criminal group said that they had lost access to their digital infrastructure, including the ability to accept payments. DarkSide is the group believed to be responsible for that cyber attack on the Colonial Pipeline. In testimony on Capitol Hill today, the U.S. Cyber Command Chief telling lawmakers that cybersecurity is national security. He says that the government needs to do more as attackers become more sophisticated. And tonight on the news, with Shepard Smith, a look at how the Colonial Pipeline attack has highlighted vulnerabilities in the nation's supply chains. You're now up to date, John. I'll send it back to you.
Yeah, it certainly has, Rahel. Thanks. And now coming up, a check on check-ins, unmasking new business policies, Musk's influence on crypto prices, and Target pulls Pokemon cards for safety reasons. That's all ahead in Rapid Fire. But first, it's a Friday, and that means it's time to look ahead to what's in store for your money next week. Here's your Friday Fast Forward.
Retail ramps up with a big week for earnings, with Walmart, Macy's, TJX, L Brands, Kohl's, and Foot Locker reporting. The sector's up 37% so far in 2021. Can the run continue? Lordstown Motors releases first quarter results on Monday. All eyes will be on its electric pickup orders, with shares down 60% since it went public. Meanwhile, Ford is set to unveil the Lightning, its all-electric F-150 pickup. The Street will be watching the Fed meetings on Wednesday for any change in its view on inflation. McDonald's holds its annual shareholders meeting, and there are 2 big names set to go public. Website building company Squarespace will begin trading via direct listing on the New York Stock Exchange on Wednesday, while Oatly's NASDAQ IPO is Thursday. Plus, we'll get a read on housing with the National Association of Home Builders survey. Housing starts in existing home sales for April. That's your Friday Fast Forward.
Catch you up on a few stories that should be on your radar. It is time for Rapid Fire. Here to break down the headlines, Bob Pisani, Deirdre Bosa, and Casey Newton, platformer editor and a CNBC contributor. First topic, shares of Airbnb. They're higher after beating first quarter estimates and an upgrade at Wells Fargo. The bank lifting shares to overweight, saying Airbnb is the strongest play on the future of remote and hybrid work. CEO Brian Chesky told Deirdre Bosa he expects demand for longer-term stays to keep increasing post-pandemic.
Fewer and fewer people are being tethered to one city to live and work. And so as people become more flexible, more and more people decide that staying in Airbnb is actually a great option for a week at a time, a month at a time, or a few months at a time.
Chesky also said he expects a travel rebound unlike anything we've seen before. Deirdre, is his gauge good this time? Because, I mean, a year ago, they were laying off people thinking it was, winter was here, but they've seen quite a snapback.
Yeah, they have. But you know what? They laid off people in the corporate office. We've seen in their financial results that hosts have actually stayed pretty steady on the platform, despite them seeing, a huge leg down in the early days of the pandemic. It did bounce back quickly, at least domestic travel. So, he says that they are ready for a hot vac summer and they have enough supply online even as their competitors try to poach some of their super hosts. And John, we talked about this in Tech Check, that whole idea of living somewhere in an Airbnb for the longer term, more than 28 days, that made up nearly a quarter of bookings in the first quarter. And that to me was sort of the most remarkable piece of this. What kind of opportunities does that open up for Airbnb in the future? And that's what I think that note was talking about as well and referring to, the longer term opportunity here.
Well, I mean, if you can do the Diana Olick thing and get the city to pay you for moving there and then use it to pay your Airbnb, I don't know, that could be a good hustle. But Bob Pisani, it seems like we're in between narratives here, perhaps, because it seems like the reopening trade is working, so people think that the pandemic trade isn't. But look at DoorDash. I mean, up 20%.
Yeah, look, I love Airbnb. I'm a user of Airbnb, but look what's happened to it. What was it, 220, 230 in February? What's it, 140 now? It's lost 30% of its value, and for good reason. When interest rates go up, these companies that don't make any money get clobbered. So you're talking about, John, I think it's an $85 billion market cap. There's only like 80 companies that have a bigger market cap, and they make $5 billion a year, and they're not going to make any money for several years. I mean, maybe next year they'll make 8 cents or 9 cents. So do the math here. We've got a PE of 1,000 or something on this. When interest, I'm not joking, it's 1,000 PE. When interest rates go up, inflation goes up, these kinds of growth companies get clobbered, and it's a wonder it's not even down more, as much as I love the product.
Well, when the E is small, you end up with those massive PEs, right. Casey. I guess the question is, I mean, you're at Platformer, so let's talk platforms. Is Airbnb going to have the sort of valuable platform that allows it to just make huge amounts of money in the future, like we've seen the likes of Amazon do?
Look, I think there is a lot of room for optimism here. You saw it in their first quarter numbers. A lot of people are already living this lifestyle. They didn't wait to get vaccinated. They just got on the road and started working remotely. A lot of American employers have said you're going to have the rest of this year and not have to come back to the office. And I think long term, these sort of hybrid roles are going to be very, very common. And if you're a white collar Silicon Valley worker, it's going to be really exciting to you to go work from 6 or 7 different cities a year. So I don't think it's wrong to bet on the future here.
Deirdre, another thing about this is that the costs at Airbnb, particularly marketing costs, have come way down during this time. When we talk so much about how much companies have to pay in tolls to get through Google, et cetera, the fact that they don't have to pay so much is a big deal, right?
Yeah, and their competitors are spending more. So, every time I talk to Brian Chesky, I ask him, do you still feel comfortable with where your marketing costs are? And again, this quarter, he said, yes, we think we have a pretty good thing going. They get 90% of their traffic organically. He talks about how he's turning guests into hosts, and how this next evolution of supply and demand is really interesting. He says that because of their discovery features and the data that they have, they're able to actually direct people to where there is supply. So say someone wants to travel to Paris in September, they could say, oh, look, there's actually better prices in October. And I think that's sort of the value of what they've built over the last more than decade that separates them from some of the competition.
And for all those people with flexible vacation days, I guess, that works. All right, next, some companies are unmasking new policies in the wake of new guidance from the CDC. Wynn Las Vegas saying fully vaccinated guests and employees can stop wearing masks. However, it did note to CNBC that it's going to still require non-vaccinated guests to mask up. On the flip side, Delta Airlines doubling down, mandating all new hires be vaccinated before starting work and adding it will likely bar current staff refusing the vaccine from boarding international flights. So we should note the CDC still recommends masks for anybody entering airplanes, public transit, or healthcare facilities. Bob, this is complicated because it gets into, the whole issue of should people be required to show proof of vaccination, whether it's in public places where certainly that's not being done, or even in private places. Is going to cause the same kind of dust up that we saw in stores over masks in the first place.
Well, I agree with you. I'm baffled why the CDC made this announcement, which I support, obviously, but didn't say that there should be a requirement of proof of vaccination. They didn't. I don't understand why. I work at the New York Stock Exchange. I had to show them proof of vaccination, the card, to go work there. I went back on Monday, and that was one of the requirements I had to do. I gladly did that. That made a lot of sense to me. So I think that we need to do that in the future, and most companies are going to require that. One thing that's interesting, John, is just mentally on the street, you can see some people are now starting not to wear masks. I get a few dirty looks because I walking around recently without a mask. There's a lot of mental adjustment that's going to have to be made, and there are some people that, mentally they want to stay masked for a long time, if not physically, and so there's a real kind of mental adjustment that's starting to occur now.
Casey, are you in California right now? Yeah. So the dirty look that you get in California is if you're not wearing a mask, but there are other places in the country, if you're in a Reds, you get a dirty look for wearing a mask outside. So you sort of have to pick your poison, right?
Yeah.
Yeah, it's become a culture where obviously people have very deep, like almost religious feelings about this stuff. I was talking to a source at Amazon yesterday. There's some concern there because Amazon has started asking, are you vaccinated or not? Some employees don't want to give up that information. But as we can see, companies can mandate essentially that they share it. So I think there's going to just be a ton of anxiety that comes out of this. But look, it's coming out of a massive 14-month trauma that we've just all gone through together. I think it's very understandable. People are going to have sort of strange and mixed feelings about sort of coming out the other side of it.
Deirdre, curveball here. You probably didn't ask this, but I wonder to what degree companies, even like Airbnb, are either recommending or not recommending that hosts ask about the vaccination of potential guests, what they're doing corporate policy-wise. I mean, I suppose this plays into those platforms as well.
John, it's a good question because we've seen tech companies come out on social issues, not just tech companies, but a lot of corporate America. So why can't they come out on this vaccine mandate and, not just ask, but require their employees and potentially even customers to show proof of vaccination? And I know this is such a tricky topic, but if they take stances on things like voting rights and other things, they have to consider where does a vaccine or mask mandate fit into the social welfare of society? I'm not making a statement on that. Let me be clear. But it's a good question to ask, especially when you have sort of progressive companies, especially in Silicon Valley.
Well, so everybody don't come for Dee. She wasn't making a statement. But here's a tip. If you decide to make a statement, do on the other hand and do the other side, and then people won't know which way you're really coming down. Okay, next. Another day, another tweet from Elon Musk moving the crypto market. The price of Dogecoin surging more than 40% after he revealed he's working with the token's developers, whoever they are, to improve transaction efficiency, and it looks potentially promising. But Dogecoin still negative for the week, reeling along with Bitcoin after Musk's last Twitter bomb 2 days ago, saying Tesla would no longer accept Bitcoin as payment due to the, quote, insane environmental impact of mining it. And Casey, I would add that he called Doge a hustle, on SNL, and it tanked over the weekend. So, I mean, here's a guy who's just moving crypto all over the place. What a store of value.
Yeah, I mean, I think it's pretty clear at this point that if you've made a huge bet on Doge, it is just pure gambling. There are no fundamentals here to discuss to make a theory of the case. But look, the one thing we have learned over the past few months is that there are a lot of Americans who love to gamble in this way. and the risk of losing is, something that can be accounted for by the potential thrill of winning. So as long as there's people still see a huge upside in Doge and these other meme stocks, I think we're going to see a lot more of them.
All right, and finally, Target is halting sales of Pokemon and sports trading cards in stores due to safety concerns. It comes after a Target in Wisconsin was forced to go on lockdown after a fight in the parking lot over trading cards. The value of collectible cards has soared during the pandemic. A rare Charizard Pokemon card sold for more than $300,000 at auction, while a Michael Jordan rookie card, which is even better than a Charizard, recently sold for more than $700,000. Bob, they're taking a cue from my kids' elementary school, which also banned Pokemon cards. But these are adults fighting in the parking lot over Pokemon cards, which makes me wonder, is the NFT craze crossing over into the physical world? Are people with crypto bucks perhaps? I mean, I don't know, but it seems like no matter whether you're talking about digital markets or physical, people just need to grow up.
Well, desire for collectibles. There's a couple of cross currents here. Number one, there's really three trends here. First is people got money because they're staying at home. Number two, there's growing influence of social media influencers. Number three, there's growing desire in general for people to have collectibles, to own physical objects. NFT is separate, but it overlaps a little bit. And we're seeing this in comic books. We're seeing this in baseball cards. I collect old 60s rock posters. Those posters have gotten more expensive, too. Not like Pokemon, but you get the idea. People want to own some physical object. There is some obsessive aspect of Pokemon, obviously, because there's games that are involved. It's more than just a collectible. There's gaming elements associated with this. But I'm very agnostic on pricing. You might say, what kind of idiot is going to go out and spend this much on Pokemon? Well, who's going to do it on NFTs? Who's going to do it for comic books? Somebody paid $3 million for the first Superman the other day. I mean, you have to be agnostic about the pricing and acknowledge the psychology of what's going on. That's the way to do it. Otherwise, you'll go crazy screaming at people.
Dee, what do you think would happen if Elon Musk tweeted about his favorite Pokemon? Huh? Work with me here.
My goodness, I don't even want to think about that. I mean, you'd probably get a rush. Whatever exchange he was listing it on would probably crash, but it really speaks to sort of the speculative nature that we're living in right now, and that collectibles are also seen as investments, and that's why people get so heated. John, before you go, though, I do just want to mention one thing. I'm looking at Casey's background. He promised he would upgrade it. Casey, you got 5 out of 10 from Room Raider. Where's the orchid? Where's the books?
There's another bottle back there.
I gotta call you out.
Like, I mean, are you drinking a new beer, or was that always there?
You know, if CNBC could just send people to my house to fix this, I will pay any price. Somebody solve this nightmare for me.
Trust me, you don't want CNBC sending people to your house, Casey. That's not the move. So, take that back.
You need some collectibles, Casey. Get some collectibles behind you. Get some Pokemon cards. Your Room Raider will go to 10.
Or see if you can bum one
Bob,
of those classic rock posters off of Bob. That's a good look. That's a good look.
Look at my Room Raider.
All right. Excellent rapid fire. Have a great weekend, everybody. Bob Pisani, Deirdre Bosa, and Casey Newton. Okay. And now coming up, this fintech stock is up 75% over the last year. The name and what's driving the gains next. The CEO is going to join us live. And don't forget, you can watch us live using the CNBC app. The Exchange will be right back. welcome back. Cloud software's cloud is real, particularly as small and medium-sized businesses look to optimize how they manage their operations. More companies adopting services like Bill.com. That stock is on Cloud 9, up nearly 75% in the past year. And joining us now is founder and CEO of Bill.com, Renee Lacerte. Renee, good to see you, and I'm particularly interested in getting insight from you following this latest CDC news, because so many small businesses have been under such distress over the past year, and this opening up presents a lot of possibilities. What are you seeing in the differences in small business performance, depending on how open different areas of the country are?
Well, thank you, John, for having me, and it's great to see you again as well. You know, the SMBs, you know, for them, every month is Small Business Month. This May is the SMB month. But really, when you're an SMB, and I grew up around SMBs, every day you kind of live and breathe it. You kind of work hard to actually make a difference in the world, and you work hard to actually bring your service and products to customers. And so what we've seen over the last 3 quarters is that they're getting back to work. Some examples here is the year-over-year growth in our transaction volume. 3 quarters ago was 10%, then it was 16%, then it was 19% this past quarter. So businesses are doing more transactions. The total dollars moving on our platform was up over 44% year over year. And this kind of gels exactly with some data that we've used and gotten from a research that we did with Wakefield to over 1,000 SMBs across the country that said that they were focused on driving new products. 75% wanted to focus on new products. 80% said they wanted to focus on digitizing their back office solutions as a result of COVID. And then there was 85% that were just very focused on, you know, on revenue addition. This is so different than a year ago. A year ago, we did a similar survey and we got everybody focused on cost cutting. And so what you see and what we're seeing across our base is that business is getting back to work. They're excited, they're ready to open back up, and businesses are actually making a difference and making it so that, you know, the economy can keep on going.
And cost management is still important, though, I imagine, and that's why you guys are buying Divvy for more than $2 billion. Tell me where that fits into your technology portfolio, what you hope it provides to customers, and how that's going to expand your revenue possibilities.
Yeah, it's a great question. It's something we're super excited about. So, you know, when we look at overall B2B spend, AP and the platform that we have on the AP side probably constitutes around 70% of the, you know, the B2B spend. But that remaining 25 to 30% up there that is B2B spend, a lot of that's on corporate cards. And this is a, you know, spending program solution that's super elegant, super modern, that just really helps businesses manage all of their spend across their T&E. So not as much in the past year, but definitely gearing up. But also people are using corporate spending cards to really manage other expenses that are recurring. That might be digital ad spend that they're doing in marketing. It might be other services like that. And so what we see with Divvy is a simple, elegant solution that customers love. And we're fortunate because with 115,000 customers on the platform, we're able to go talk to them and understand what they're doing. We're able to see the data and transactions on our platform about which corporate cards they're using. And what we found is that a lot of them were using Divvy. And when we talked to them, we found out how happy they were. So knowing that customers were asking for it and knowing the success, that's why we did it, and we're excited.
It sounds like you had a decent amount of overlap then between your existing customer base and Divvy, and that's part of what drove this. How is this rationale going to work then? Is it bigger share of wallet, or is there also a significant portion either of your customers who aren't on Divvy that you think you're going to be able to cross over, and then vice versa?
It's a great question. So if we just step back, still the dominant form of how people manage their financial operations is paper. So we have 115,000 customers. There's 6 million businesses. You know, we are champions for all of them. We want all of them to have as simple financial life as they can get. And so what we see is that, you know, there are, you know, we have, you know, thousands of customers that are using spend management out of the 115,000. And so our focus is really, how do we get all of them in one solution? And what we hear from customers is that they want a one-stop shop. They want the ability to be able to manage all of their B2B spend in one place. They want to be able to do it from their phone. I've said oftentimes that we take the back office and put it in the back pocket. And so the cross-sell opportunity is real. We think that there are plenty of customers on our platform that will want the solution that Divvy has. And we think there are customers on Divvy's platform that will want what we have. And that's because what we both hear from our customers is they want this one-stop shop. They want one solution. They don't want a ton. They want one.
Well, that cloud and mobile part of the digital transformation for small and medium business, I think, really got pushed during the pandemic when businesses realized that they need efficiency like never before. Renee Lacerte, founder CEO of Bill.com. Thank you.
Thank you, John.
Coming up, shares of GoodRx higher right now. The stock has had a rough year so far, down 25%. We're going to ask the co-CEO what's been holding it back. Is it earnings? Is it merger news? There's a threat from Amazon. The exchange is back in 2. Welcome back. GoodRx out with first quarter earnings. Revenue grew 20% year over year with 5.7 million monthly active consumers in the quarter. The company also announcing the acquisition of discount drug company RxSaver. The stock up about 8.33% right now, but down nearly 40% over the past year, a year where Amazon's moved deeper into the healthcare space. Let's talk about all of it with Doug Hirsch, GoodRx co-founder and co-CEO. Doug, good to see you again. Now, you're experiencing kind of the flip side of really high valuations that the market was giving you, even though these results have also been coming in pretty strong. Tell me first about RxSaver and where that fits into the portfolio of offerings that you have across prescription and telehealth.
Sure. We actually had a fantastic quarter. We've been delivering across all fronts. And one of the things we did in the quarter was we acquired 2 companies, actually. We acquired RxSaver, the company you mentioned, as well as a company called Healthy Nation. Healthy Nation is focused on video content, spectacular video content created by doctors and healthcare professionals. RxSaver is a complementary business to ours, which has some great talent, some really amazing people we brought on board, and some great marketing advantages for us. And so, again, it helps us get to our mission of helping people get the care they need at a price they can afford. Great opportunity, and we took advantage of it.
Is Healthy Nation sort of an expert answer for WebMD? You know, for people who shouldn't just be paranoid figuring out their own thing, but actually going to sourced content from doctors?
Yeah, so GoodRx has been producing amazing content for years. We have incredible PhDs and pharmacists and doctors who are producing amazing content, but it's all written, and a lot of consumers like to watch video. And this video content is just incredible. And more importantly, or not more importantly, but just as importantly, we have lots of manufacturers who would very much like to talk to consumers, and we would like to be able to give manufacturers the opportunity to put their brand in front of consumers. We have just incredible inbound interest from them. And so we can combine great content with an advertising platform. It's a win-win for everybody. And we're really, really excited to get that content in front of more people.
It sounds to me like you're moving in a direction of diversification as you address the healthcare customer, because you've got prescription, you've got telehealth, now you've got more content and advertising platform. Talk to me about how that's playing out as we see an economy that appears to be shifting toward reopening, and maybe not so much telehealth, but perhaps more prescription as people go back face to face with their doctors.
Yeah, you nailed it. I mean, we are seeing a transition from, the COVID era, of course, back to a reopening of the economy. The CDC just yesterday said everyone doesn't have to wear masks anymore if you're vaccinated. And so we're transitioning from the COVID crisis into the other healthcare crisis, which is that people just simply can't afford their care. And we're going to meet them with incredible products and services. GoodRx Gold and the KrogerRx Savings Club. We have almost 1 million subscribers now who are paying us on a monthly basis to get incredible prices, not just for prescriptions, but for telemedicine and for mail delivery. So we're feeling really, really confident that we've got a wide variety of solutions for both consumers, for brands, for healthcare professionals even, that can really just meet this new world as we all emerge from the pandemic.
How predictable are you finding your results to be? I mean, if people look at your stock chart, they would think the story is one thing, but as we know, the markets have been all over the place lately. What kind of stability are you seeing?
Yeah, I mean, put the markets aside, because our business is both durable and highly predictable, right? When consumers are using GoodRx, we know their behavior. We know what it takes to bring them back into the pharmacy. We're really, really proud of our results. And we know this behavior. We know consumers, look, most of the people who use GoodRx have chronic conditions. And so they're taking prescriptions on an ongoing basis. They're showing up at that pharmacy every month. We have a very reliable revenue stream. And again, we're opening up new revenue streams and new ways to communicate with consumers as well. So we feel like our business is rock solid and just getting better. We're super, super excited about 2021.
Yeah, some interesting additions to it with Healthy Nation, video information from doctors, and then, RX adding more on the prescription side. Doug Hirsch, co-founder, co-CEO, thank you.
Thank you.
Have a great weekend. And that will do it for the exchange. But coming up on Power Lunch, millions are still unemployed, but businesses say they can't find workers. So what is the disconnect? That is ahead after this quick break.
and welcome to Power Lunch. I'm Melissa Lee. Tyler Matheson will join me in just a moment. The great jobs debate. There are millions of openings. Employers can't say they can't find enough workers, but millions of people are on unemployment. We'll discuss the real reasons for this disconnect and how to fix the problem. Plus, Dogecoin to the moon. Coinbase scrambles to add the meme coin to its platform, and Bitcoin rebounds above 50K. And grape expectations. A wine company going public via SPAC. Another sign of peak SPAC, or maybe an opportunity for investors to buy what you know. Power Lunch starts right now.
And good afternoon, everybody, and welcome to Power Lunch. I'm Tyler Matheson, and we begin today with the markets because stocks are rebounding yet again today. The Dow adding about 250 points. There you see the S&P up 59. NASDAQ 2% higher, but this up and down trade could be around for a while until we figure out whether inflation is, in fact, here's that word you're going to hear a lot, transitory. Let's go to Bob Pisani now. Hey, Bob.
Hello there, Tyler. 3 down, 2 up, but we're still down about 1.5% for the week. Very defensive tone overall for the week, but we are getting a bounce back in the key growth areas like technology. So I just want to show you some of the, I call them thematic tech, speculative technology parts of the market bouncing nicely today. I'm talking about the Zooms and the Rokus, Shopifys, the Zillows, the Spotify, all bouncing nicely, but still notably down for the week. When I say a defensive tone, if you look at the new high list, there's really very defensive. It's consumer companies are mostly it. A lot of food companies, Kraft, Mondelez, Hershey, Tyson Foods hitting 52-week highs. But that's about it. Given the declines we've seen in the growth areas of the market, that's not terribly surprising. It's been a pretty crazy week. Remember, we're down about 1.5%, even with 2 days of bounces. And you can see here, consumer staples, for example, are actually up for the week. Financials are up for the week. Industrials are basically flat. But you see the real damage is in the growth areas of the market. So technology down more than 2%. Semiconductors are down 3.5%. A consumer discretionary, which has a lot of the other growth stocks that are out there, is also down about 4% for the week. So where are we? What's going on? I'm saying down is the new up, used to say. Well, I say flat is the new up right now. So the market's got to learn to live with this inflation uncertainty. And we're not going to say, oh, we know Tuesday what's going on with inflation. This is going to take months to figure out if the Fed is right, if inflation is either transitory or it's really not going to go up that much. We don't know the answer to this, and we won't know for many, many months. So where does that leave us? Well, it's basically stalemate. It's very hard to argue, let's go to new highs, unless we have a clear indication about whether inflation is going to be a serious problem or not. If we go from 2 to 2.5%, I don't think the market's going to care. If we go from 2 to 4 or 5%, well, guys, the market's going to care a lot. And unfortunately, we don't have an answer to that question right now. That's the main market risk. Back to you.
All right, Robert, thank you very much. As Bob mentioned, despite today's gains, those inflation fears have hit sentiment, and the major averages are still on track, as he pointed out, for losses on the week. So as Wall Street does try to figure out whether this inflation is transitory or not, what should you as an investor do? Let's bring in Ron Insana. He's a CNBC senior analyst and commentator, as well as a senior advisor to Schroders North America. Michael Farr, also a CNBC contributor, president and CEO of Farr, Miller & Washington. Gentlemen, as always, welcome. Good to have both of you. You heard what Bob said, that the market is sort of in stalemate position, awaiting some determination of how high, how fast, and how enduring inflation is going to be. And that is basically the governor on making new highs. Do you see it that way, Ron?
Yeah, to an extent. And I think, we've gotten some choppy economic data, which is, given a new lease on life to the lower for longer interest rate policy scenario, given the flatness of retail sales, even though it was a relatively good report, given the dip in consumer confidence. Now, there was a rise in inflation expectations in the consumer confidence data. If that gets sticky, it becomes problematic. But Tyler, I would say it's still way too early to know. We're coming off such easy comps, if you will, from an inflation perspective last year, as we are with most other economic numbers, that it's hard to determine whether there's a real acceleration in the rate of inflation, and there is in some areas, obviously, or whether we're still adjusting for what happened last year.
Michael, we had a very interesting conversation yesterday, one of our CNBC events called the CFO Council. And I'm going to cite 3 CFOs by company, not by name: PepsiCo, Whirlpool, and J.M. Smucker. And all of them, especially Whirlpool, are seeing the signs of what they think is higher inflation and potentially enduring inflation. And in the case of Whirlpool, it goes from everything from input costs, metal and chips, to transportation and shipping charges, freight charges. And they see it as running at roughly 5% a year. Good for them, said the CFO. They've been able to raise their prices about 6%. What are you seeing?
I think the key here, well, I think everybody's seeing that, Tyler. We're seeing the higher prices across sectors. The consumer is seeing them at the checkout counter, at the pump, the price of milk, the price of bread, the price of lumber. The price of steel is less expensive. It's less expensive to build with steel right now in the U.S. than it is with lumber. I mean, that's kind of crazy. So we're, I think, all focused on the meaning of this word transitory. We're seeing the inflation. The Fed said they were going to let it run hot. So you get these higher prices. Does transitory, Tyler, mean that it goes up and then it comes back down? Or does it just stay up and then sort of, as I think that's what it means, and then we get back to this sort of 2% or sub 2% GDP growth going forward? I sense that that's what's happening. But the Fed is calling for a very precise result from a very imprecise and messy economic process that's evolving. So, you know, this is where we're all on stage. You know that dream where you go on stage and you don't have your script and you don't have the lines? That's where we are with what the Fed is doing, how the economy's unfolding, and we're waiting to see what's going to happen to inflation. All of that aside, we've got great tailwinds of lots of liquidity, an economy that's reopening, a population that's getting vaccinated, and consumers with cash who are spending. So it's a tough environment in which you bet against stocks.
You know, this inflation experiment, Ron, seems, you know, logical in a theoretical and intellectual way, but from the consumer standpoint, as Michael pointed out, they are feeling it right now. And I don't usually plow through the University of Michigan Consumer Sentiment Survey, but today it was very interesting because 43% surveyed said they expect inflation prices to rise 5% over the next year. And that in and of itself, I would think, could cause an inflationary psychology. The psychology of the consumer could change, which then could change the contours of the recovery.
Yeah, absolutely. And but Melissa, they also have a 15% savings rate, which someone on CNBC remarked this morning was $6 trillion. So to a certain extent, some of those price increases could be accommodated by both the very loose monetary policy and the very loose fiscal policies that we have right now. And people might be willing to live with it for a period of time and then start to dial back their purchases if it becomes sticky. And so it's hard to tell. When you look at all the inflation break-evens, they're well above where they were, even just a couple months ago, both in 5-year and 10-year duration. So, yeah, I'm more concerned about it. I'm not in the modern monetary theory camp that, believes you can run this really, really hot forever, spend a ton of money, and then use tax policy to fix inflation. I think at some point, the Fed has to make a choice, given how loose fiscal policy is, to start thinking about dialing it back a little in some form or another to kind of reduce what might become embedded inflationary psychology.
Michael, I don't know that anybody heard this. I think they cut my mic, which may be merciful here. But I have that same dream that you were describing where you go on stage without your script. But in my dream, it's not merely my script that I'm missing. I'll just leave it there, and that's too much information.
You know that joke,
but at any rate, yeah, you know that joke. At any rate, Michael, and for that matter, you, Ron, but I'll start with Michael. Are there kinds of stocks or individual stocks, whether domestic or emerging market or value or finance, that stand to benefit in an era of, as Melissa pointed out, a rising sort of inflationary consciousness?
Well, what we know in an inflationary environment is that asset prices go up. You've seen this in your neighborhoods. You've seen your houses and your neighbors' houses go up. Same thing's happening with stock prices. So, but this is the time to own quality. This is the time when you want to own good, solid balance sheets. The stocks that are betting on the come, that are just saying, well, we've got a really huge growth rate and we've got great sales. If you don't have earnings, if you don't have a solid balance sheet, you could be left behind, and those future earnings growth are worth less than they would have been in a lower rate environment. So as rates are rising, I like some of these stocks on sale. I love Disney today. I love Facebook today. They had a great quarter at Facebook. This is an amazing powerhouse of a company, growing huge market share, control, advertising revenues, continuing to execute. So yes, you need to own some of these assets that are going to be inflated. Holding cash in an inflationary environment is a lose position.
All right, gentlemen, we have to leave it there. Have a good weekend.
Hey,
Ron
Tyler,
and
can I make
Sana,
a
Michael
quick
Farr.
comment?
Great to see you both. Certainly, of course.
Thank
Yeah,
you.
listen, I just did my first cross-country trip in 15 months, and I know there's reduced capacity in airlines. Both planes to and from Los Angeles, packed. Airports, packed. Restaurants, packed. The recovery trade is still on.
Yeah, and both of you agree on that, and I see it too in my little neck of the woods. Gentlemen, thank you. Have a great weekend. Melissa.
All right, Ty. Retail sales coming in short of expectations, stalling as stimulus checks start to fade. But this just before racks and racks of companies set to report next week. Home Depot, Walmart, Target, Macy's, and many others. What are the key themes we will see from these results? Courtney Reagan has the details. Court.
Hi, Melissa. So the key phrase that investors will listen for is something like pre-pandemic levels or words like normalize. Remember, this time last year and those year-over-year comparisons are going to be really messy for retail because many of the retailers this time last year were forced to close their stores. So during the comparable quarter, that's going to look kind of like a mess when you've got others that were open and putting up record results. So essential staple players like Walmart and Target have been putting up some of the strongest comparable sales results ever. That isn't expected to continue forever, but investors still want to see growth. Non-essential players like Macy's, Kohl's, they're just trying to hang on to what they can in the discretionary categories in which they sell. But shares of both are sharply higher today. Shareholders are betting that shoppers are back to buying things like dresses and non-stretchy pants. In fact, ThredUp CEO James Reinhart said Thursday that mini dresses are up more than 20% as a percent of sales since March. Formal dresses up 15% as a percent of sales since March. And on Thursday, Canada Goose CEO Danny Reese told me his company shifted from recovery to growth beyond pre-pandemic levels. So the key is seeing demand normalize as the world gets back to work and life in a more pre-2020, more like a 2019 kind of way. Tyler?
Courtney, what a lovely spot you're in. It has got all the spring greenery behind you. Beautiful. Court, have a great weekend. And coming up, used cars and cryptocurrencies. Anything with a car or a car sound in the name seems to be doing well today. We will check in on those stocks. Vroom, there's one for you, up 10%. Big day also for cryptos. Bitcoin back above 50 grand. Dogecoin soaring as well. Coinbase reporting its first results as a public company. All that and more coming up on Power Lunch.
Welcome back to Power Lunch. We are tracking notable moves in some stocks tied to the used car market, led by gains in online-focused players like Vroom and Carvana as well, up big in today's trade. But those stocks have had a choppy year so far, both sitting near break even, with Vroom nearly 50% off its recent September high. CarMax, on the other hand, has been a relative outperformer this year, though it has not been able to escape the recent volatility and is currently on pace for its first monthly decline since October. Keep an eye on those used car stocks. Mel, I'll send things back over to you.
All right, Dom, thank you. Shares of Coinbase down today after its first earnings report as a public company, results coming short of expectations on earnings and revenue. The stock has underperformed, now down about 20% in a month. It peaked after its mid-April IPO, but our next guest sees big upside from here. Piper Sandler's Richard Burpetto initiating coverage of Coinbase with a buy rating, a price target of $335. He joins us now. Rich, great to see you.
Great to see you, Melissa.
You know, you make a point in your note that you've covered companies through the internet bubble, and I'm wondering why you think Coinbase deserves more of a techie valuation as opposed to a traditional brokerage valuation.
Yeah, because Coinbase's business is really cryptocurrencies, and underlying that is the blockchain technology. So we often get questions about the currency, but it's really about a technology change as well. And not to date myself, but like I would compare it to the internet technology impact. You know, it could be the same or even greater. That's what's at stake and what Coinbase represents in the crypto space.
Does it represent this change in terms of how revolutionary blockchain could be to the world of finance and all sorts of other industries? Or is there an actual component of technology to Coinbase that makes it unique, that gives it a moat that traditional brokerages and banks cannot breach?
Well, I would say the moat that it has right now, it's the most recognizable brand, the early mover. And what we did find back, you know, again, not to date myself, but I was there, in the internet age, the early movers that were that established their brand and were willing to spend and invest on it up and down cycles. And Coinbase is. Coinbase will spend $1 billion in marketing or close to it this year, 12 to 15% in revenues. So the moat that they're building is actually their scale and their recognition. Like when people think of crypto, they normally think of Coinbase. And Coinbase is doing a lot more. They'll be trading, but they're getting into all aspects, trying to solicit and get the institutions to trade with them and custodian their assets with them as well. So it's more than just you know, up and down about the price of Bitcoin every day.
You know, Richard, you're making the case that it's this is an industry in its infancy, that it has the potential perhaps to be as powerful or even more than the internet with respect to finance. I wonder if there is is there a comparison company? Could Coinbase be the Walmart of this field, or the Amazon of this field, or is it going to be too competitive and there won't be one dominant player? Or not that either of them are all that dominant, but you get my point.
Yeah, Tyler, that's a perfect question. That's the question, the point I'm trying to make. If you look back, you know, you look back at Amazon, you know, they were selling books, and I can remember thinking, you know, great, but you know, could I ever see how powerful they are? But they kept investing, they kept expanding, and they are the retail powerhouse of e-commerce. That's exactly what Coinbase is trying to establish in the crypto space. Again, they're going to spend $1 billion, and they warn investors this is going to be up and down cycles. You know, right now there's plenty of trading, but they've gone through what they refer to as crypto winters, where maybe the price of Bitcoin drops, but it's come back, you know, even stronger, you know, through the next cycle. But they're going to continue to invest and spend, and people will know and recognize, and they'll expand their products and services. They are, you know, lack of a better word, the 800-pound gorilla in the crypto space right now.
There are competitors out there, Rich, and granted, they don't have the brand name that Coinbase has. There's Webull, there's Binance, Robinhood. You can trade crypto, and I'm wondering, you know, if you just assumed that they made zero money on the retail side of it. In other words, that it is in fact a race to the bottom, which we've seen on the retail equity side of things, then what does that do to their business in terms of the other side? What kind of pressure does that put on the other side of the business to grow?
Yeah, the majority of their revenue is transaction related, and the majority is retail right now. But you bring up a good point about the race to zero commissions. I can tell you by covering the e-broker space, that race, there was zero commissions right off the bat. It took 20 years to get to zero. I think people are more interested right now in trying to understand which coins and have that availability and to trade the coins that they want and get the other services, whether it be interest on their coins or having a custodian. The pricing is not going to be, at least in my opinion, the most upfront thing right off the bat. And again, Coinbase is, when you think about, they look at competitors or peers like Webull or Robinhood as actually, funnels that are bringing more people into the crypto space. And as they trade crypto, when they get more advanced, they'll certainly, are likely take a look at what Coinbase has to offer, the advanced tools in trading the different coins, et cetera.
And shortly Doge. Rich, good to see you. Thank you. Rich Repetto.
Take care.
All right, markets are bouncing back today after a week of volatility. Which of those laggards could have the biggest comeback? We'll explore that, plus America's labor crisis. Job openings leaping above 8 million to a record high. Some employers argue that expanded unemployment benefits are creating a shortage. But could the issue be with wages, and why big tech is sitting on millions of dollars worth of unused real estate? Power Lunch will be right back.
Welcome back. I'm Rahel Solomon, and here's your CNBC COVID update at this hour. UK Prime Minister Boris Johnson says that the COVID variant first discovered in India has the potential to derail lockdown easings in England. Johnson says that the variant from India looks to be more transmissible than other variants, but also cautioned that it's not clear by how much. Meanwhile, Reuters is reporting that the new mask guidance from the CDC means that fully vaccinated people no longer need to wear a mask in federal buildings. That's now just over 2 months away, and opposition to the games is growing. Anti-Olympics protesters submitting a petition with more than 350,000 signatures to the Tokyo government calling for the games to be canceled. You're now up to date, Melissa. I'll send it back to you.
Thank you, Rahel. We've got some new developments in the Colonial Pipeline hack. Let's get to Eamon Javers with the latest. Eamon.
Yeah, Melissa, yesterday we saw President Biden suggest the U.S. government was going to respond to DarkSide, which is the entity that hacked the Colonial Pipeline. Today we are seeing some disruption now of the DarkSide websites on the dark web. Take a look at what we're hearing now from two cybersecurity companies. Mandiant says that dark web posts claim that DarkSide has now lost access to its infrastructure, including its blog, its payment systems, and servers, and has told affiliates they will be closing their service. Mandiant also says that online posts claim that the decryptors will be provided for companies who have not paid. That is, if you have been hacked by DarkSide, this report anyway claims that you will be let off the hook and you'll get the decryption keys to that as well. Also, we've got Intel 471. They're posting some information saying that the posts on the dark web claim that DarkSide has promised to compensate its outstanding financial obligations by May 23rd. That means DarkSide is paying up to its other criminal affiliates. This is bad guys paying other bad guys here and telling them when they're going to do it. Intel 471 also said that posts claim that funds from DarkSide cryptocurrency wallets were exfiltrated. That means that their cryptocurrency wallets were full. Now they're empty. That, according to Intel 471, not clear who took that money or where it went. Also, the cryptocurrency mixing service BitMix has reportedly been inaccessible this week. That's important because that cryptocurrency mixing, we're told, is one of the key ways in which these bad guy groups are able to launder their cryptocurrency and actually hide the source of it. So you get paid in Bitcoin, you launder it, you mix it with some other things, you cash out those pieces of cryptocurrency into other assets of other kinds on the other end of that transaction. This would be an indication that someone has stepped in and tried to stop that process. We don't know who's doing this. It could be the U.S. government. That's one possibility, but other possibilities include private cybersecurity companies could be doing this. Other criminal gangs could be piling on, noticing that DarkSide is in extremis here. The Putin government could be cracking down on them. I asked the National Security Agency for comment on that. They referred me to the National Security Council at the White House. The National Security Council says it has no comment at this time. Melissa, back over to you.
This would be such a great Netflix series. Eamon, thank you. Eamon Javers in Washington. Ahead on Power Lunch, the growing debate over the jobs market. Companies say people don't want to work. Workers say they aren't being paid enough. Is there a way to bridge this divide? Plus, is there truth and profit in wine? We'll speak to one vineyard company going public via SPAC. Power Lunch, be right back. Let's take a check in the markets right now. We are just off of session highs. Right now, the Dow is up by more than 1%, near the highs of the day, as I mentioned, of up 400 points. The S&P 500 is booking a 1.6% gain to close out the week, and we're just a couple of points off of the intraday highs here. The Nasdaq Composite is up by more than 2%. The oil market, meantime, closing for the day. Let's get to Dom Chu at the CNBC Commodity Desk. Dom.
Upside moves here in the end here. Crude oil prices did trade within a relatively modest range, Melissa, given the hacking of the Colonial Pipeline and COVID-related catalysts. Oil prices, though, closing out the week on a high note. U.S. benchmark West Texas Intermediate crude, or WTI, $65.35, 2.5% gains there. World benchmark Brent crude, $68.69, similar percentage gain. Now, for WTI since last Friday, prices have been as high as $66.63, as low as $63.09, but the general uptrend remains intact for oil prices. Now, earlier this afternoon, oil services firm Baker Hughes reported that the number of active U.S. oil rigs increased by 8 to 352. That's the highest count since April of last year. Higher prices, of course, could incentivize more oil producers to ramp up drilling activity in the coming weeks and months. Now, by the way, guys, according to AAA, the average price of gasoline right now stands at $3.04. This same time, 1 year ago, it was, Tyler, Melissa, $1.87 per gallon. We've come a long way. Back over to you guys.
Wow, yeah, and you really do see it and feel it when you fill up. Well, I have an SUV, and that's the gas eater. Anyhow, Dom, thank you very much. To the bond market now, and Rick Santelli, who is at the CME. Hi, Rick.
Hi, Tyler. You know, this morning we had data and retail sales a bit disappointing. Real quickly, the one-year inflation outlook on the preliminary University of Michigan sentiment of 4.6. You'd have to go back all the way to 2008 to find a higher level than 4.6, another hot number with regard to inflation. Look at a 1 week of 10s and 30s. As we sit, we're down on the session in 10s and 30s, but up 6 for 10s on the week, up 8 for 30s on the week. And if you look at the UK and Europe in general, 10s, their 10-year sector closed at 2-year highs going back to May of 2019. 10s minus boons. The distance between our yields and Europe yields has gotten the closest together in 2.5 months. You want to pay attention to that. And finally, the dollar index. It's having a rare up week. However, as this 3-year chart shows, you know, we're just about a penny away, a penny above levels we haven't traded in 3 years. Melissa Lee, back to you.
Rick Santelli, thank you. A shortage of labor is leading to a massive debate over jobs in America. More and more Republican governors say they are opting out of the enhanced federal unemployment benefits, arguing it is creating a worker shortage. But can states refuse a federal program? Rahel Solomon has that story. Rahel.
Hi, Melissa. Yeah, so the number of states currently opting out stands at least 14, all with Republican governors. Now, officials there say that the federal benefits are encouraging people to not return to work. But according to a report from the Century Foundation, cutting off these benefits could impact more than 1 million people within weeks. That's about 1 in 9 of those currently unemployed. Now, one group sounding the alarm that opting out of at least part of the program may not be legal. The National Employment Law Project sending a memo to the Federal Department of Labor outlining that the pandemic unemployment assistance is mandatory.
So the language in the law says that the secretary shall provide benefits to those who are in the pandemic unemployment assistance program. It is more discretionary for the other programs, so that seems more optional on the state's end.
So NELP is suggesting either the DOL force states to continue offering PUA or it can recruit states willing to administer the benefits. We have seen states do that before after natural disasters. DOL, meantime, only saying that it has received the memo, and also one from Senator Bernie Sanders urging the DOL to step in and intervene and try to make sure that people who are entitled to those benefits receive them, Melissa.
All right, Rahel, thank you. Rahel Solomon. Tyler.
All right, thank you, folks. A key data point in this unemployment debate is that lagging labor force participation. American adults in the workforce steadily declining since the 2008 financial crisis, as you see right there, for men, women, and overall. Pandemic declines have yet to really bounce back. You see that big EKG fall off there, with female workers most especially impacted. So what is standing in the way of growth in the labor force? Joining us now, Lily Roberts, Managing Director of Economic Policy at the Center for American Progress, and James Pethokoukis, Fellow at the American Enterprise Institute and a CNBC contributor. Lily, let me ask you to wade in quickly before we get to the heart of this discussion on that question that Rahel was just examining. multiple state governors, and more are sort of leaning this way, are saying we are not going to take part in a federal program to pay a $300 a week supplement to unemployment insurance. Can they do that?
Well, I think it's up for the lawyers at the Department of Labor to decide, but I certainly think that, the CARES Act does specifically say, just as that last piece was speaking to, that, this is free money from the federal government on the table that governors are refusing, and they may not be within their rights to be able to refuse that money.
So, James Pethokoukis, there are lots of reasons why people decide not to go back to the workforce. It is intuitively sensible that one of those reasons may be that it pays them more to stay home and not go back to most usually a low-paying job. Is it really as clear as that? And is that the governing conclusion that we must draw from this?
I think it's reasonable to conclude that that's a factor. If you're making more not working, which is the case, and it's about half the time that's the case right now, then working, again, it's reasonable to conclude that might affect how hard you're looking for a job. It doesn't have to be, well, I'm not going to look for a job at all. It might be, maybe I look for a job 10% less than I would otherwise. So I think to call it a factor, along with probably still fear of the pandemic, a lack of childcare, and of course, a lot of these things affect each other. If those same people who aren't looking for a job are also your potential childcare workers, it all kind of works together. Now, hopefully, all these factors will begin to fade, by the fall, and these, extended unemployment benefits they'll be fading in early September. So this won't be an issue. But I think it's really important. Honestly, I think the Biden administration recognizes this risk as well, that this could be a factor, and that we don't then extend these benefits past early September.
So, Lily, as Jim points out, there are lots of reasons that work together in explaining this. And how do you, including inability to get childcare, the fact that kids are not fully back to school as they're not in my town, or fear of the pandemic, people who used to work in food service, even if they are vaccinated, they may not want to go back and work in close quarters with others who aren't. How do you rank in order the factors that are contributing to a lower labor participation rate and so many jobs going unfilled?
Well, if unemployment insurance was at the top of that ranking, I would expect that sectors like restaurants and hospitality wouldn't be able to hire anybody. And that's just not the case. We saw job gains in April. We just got the job numbers last Friday. Job gains were actually concentrated in very low wage sectors like restaurants and hospitality. And, Indeed does great analysis around sort of what the job market looks like at any given time. And they showed that gains were concentrated in in-person work. So I just don't think that, unemployment insurance could be possibly at the top of that list of reasons. I think it's much more likely, when you talk to workers over and over again, they're saying, I don't have reliable or affordable childcare. My kids are in hybrid school. Maybe they're only back in person for a couple of days a week. Maybe their aftercare or before care is still really limited. And it's really limiting people's ability to take jobs. And that's what we saw in those jobs numbers last week. We saw an additional 165,000 women forced to drop out of the labor force. And that just, to me, shows that this is a caregiving question, not a question of unemployment insurance. It may be the case that unemployment insurance is making it plausible that those people can stay home, but I think they'd be staying home anyway. It may just not make any financial sense to work a shift if you have to pay more than you're going to make for someone to watch your child.
And this all, of course, gets tied up not only in unemployment benefits, but the level of minimum wage and tip credit and so on and so forth. Lily, thank you very much. Jim, great to see you as always. Sorry we don't have more time to discuss this important topic. Melissa.
Ahead on Power Lunch, the comeback kids, Tesla, Under Armour, and Micron all down for the week as the worst over. Plus, a wine of the times, the Vineyard cashing in on the SPAC craze, and big tech's office space problem. We'll be right back.
Welcome back to Power Lunch, everybody. We're on the hunt now for comeback candidates after a bumpy week for stocks. Tesla, JD.com, Micron, Under Armour, and Disney among the worst performers for this week. As you see there, Tesla down a big 13%. Let's bring in your Trading Nation team. Craig Johnson of Piper Sandler and Danielle Shea of Simpler Trading for their perspectives on these stocks or others. Craig, why don't you go first? Are the sell-offs in these stocks a time to start picking them up?
Well, Tyler, I think it is a time to pick up some of these names. And selectively, Tyler, I would point out the chart of Under Armour, ticker UAA. This is a sort of a comeback kid story here. This is a stock that has been out of favor for a while, starting to really show signs of turning around. And the most recent price action on this stock has pulled back right to a key breakout level around $22. And I think on this little pullback here, we definitely should be buying this stock. And not only does it look good technically, but also fundamentally, our own Erin Murphy here at Piper Sandler follows the stock, overweight rated, $31 price target. She's thinking 37% upside, Tyler. So from my perspective, this is the comeback kid to be buying on this little dip in here.
Interesting perspective there. Danielle, how about you? Do you see any bargains in this barrel?
Yes, Tyler, I do. I actually love Tesla here. You know, Tesla had a crazy run up last year between all the retail traders and meme traders, but you know what? They've all moved on to Dogecoin. So at this point, I think Tesla's looking amazing. People who bought into this at 750, 800, it looks to me like they've gotten flushed out. Down here on the 200 simple, this looks like a great entry point in Tesla to either sell puts around the 550 price point or buy the long-term shares for a long-term investor. Overall, on the weekly chart, you have some great consolidation, and ultimately, I'm targeting $1,000.
You know, folks, thank you. Danielle, I think we're just going to spend the next 13 minutes meditating while we look at your aquarium behind you. How does that sound? We'll just stay there.
It is very calming.
Quite beautiful. Thank you. Yeah, very calming. I'm all for it as we go into Friday afternoon. Danielle, Craig, thanks. Melissa.
Que sera, sera, Ty. Vintage Wine Estates going public via SPAC. Could this be uncorking a new opportunity for investors in the wine industry? The president will join us next.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
A common mistake that some investors make is searching for stocks with the highest dividend yield. But this can be a dangerous strategy because a high dividend yield could mean that the stock price has come down sharply or that the dividend itself is at risk of being cut. So before you reach for yield, be sure that the stock is also fundamentally sound. I'm Joanna Payne, and Schwab is the better place for traders.
Vintage Wine Estates, one of the top 15 wine producers in the U.S., is set to make its public debut in June, going public via SPAC through a deal with London-based Bespoke Capital. Joining us now to discuss this is Vintage Wine Estates President Terry Wheatley. Terry, great to have you with us.
Great to be here. Thank you.
It sounds like most of the proceeds are going to position you for a lot of acquisitions. The CEO of Bespoke has said $1 billion will be on the balance sheet effectively for acquisitions. So what's the vision there? What's the plan?
Well, the plan with all the money coming in from the SPAC is to really look at expanding. We've done 20 acquisitions in the last 10 years very successfully. And now with the pandemic, it's really opened up an opportunity to look at more companies in California, more companies in Oregon and Washington, and really expand the portfolio. I think you probably know we have over right now 50 brands in our overall company, and this really will, the SPAC proceeds will really allow us to grow the overall portfolio.
Right. And a lot of your brands can be found in outlets like a Costco and a Kroger. I mean, I'm sure consumers are familiar with them. But Terry, what struck me as interesting is you said because of the pandemic, you can start looking at all these companies. What has changed? Are these vineyards under distress? Did they have a difficult time getting through the pandemic?
Well, I think if you look at our business model, 30% of our net revenue is done in the direct-to-consumer channel, and that's where people really struggled during the pandemic. Their tasting rooms were closed, and when tasting rooms are closed, that's where you really get wine club members. So a lot of those folks close the on-premise, so restaurants, bars across the country. So if people really focused, if their business model was done primarily in that area, those wineries struggled. So I wouldn't say distressed. I would say their business model is different from ours because ours really is a third is done in direct to consumer. About 41% is done in our traditional wholesale. And then we have a really great B2B business. So a diversified portfolio has really made us come out on top after the pandemic, and really we are poised to grow.
I also noticed that you're the chairwoman of the board for CannaCraft, which is California's second largest cannabis company. Any potential overlaps there? I mean, when your wine company is looking for an acquisition, could there be some opportunities?
Upon federal legalization, I stress that we would never impact our federal bond, but we are looking at cannabis-infused beverages. In fact, we have 2 formulations ready to go when there is federal legalization. So that's a very important component of that. So yes, I think there could be an opportunity.
Okay, Terry, great to speak with you. Thank you. Terry Wheatley.
Great. Thank you.
Tyler.
Thank you, Melissa. Up next, as big tech shifts toward a hybrid work model, companies are finding themselves sitting on tons of real estate, and it's costing them millions of dollars. More Power Lunch ahead.
Welcome back to Power Lunch. The Dow is up 420 points. The Nasdaq adding more than 2% right now. Take a check on shares of Marathon Petroleum plunging in just the past few minutes as the FTC says it believes Marathon's sale of Speedway to 7-Eleven is illegal and raises significant antitrust concerns. The FTC saying it is extremely troubled that the companies closed the transaction while it was still investigating the deal. We got Marathon up actually 0.9%. Ty.
Well, very interesting. We'll see how that eventuates. All right, big tech has an office issue. San Francisco companies are sitting on records amounts of empty space and offering perks to lure tenants. CNBC.com and tech reporter Ari Levy joins us to discuss. Ari, what are you finding?
Yeah, Tyler. So what's interesting here is that what's happened over the last decade and a half is that all of these tech companies, Salesforce, Dropbox, Airbnb, Zendesk, Cloudera, they've snapped up huge amounts of real estate in San Francisco. These record leases, the Dropbox lease for its headquarters in 2017 was the biggest lease ever at the time. And obviously what they weren't expecting was that a few years down the road, there would be a pandemic and their people wouldn't need to come into the office. And also that the sublessees, the tenants that they had, that they were renting space out to, they wouldn't need to come into the office. And so now these massive employers find themselves with space that they can't get rid of. They don't know what to do with. They're having to take big markdowns on. And so now we're sort of waiting for, what's the next step? The market, is poised to rebound to some degree. Some of them are dropping the price of this real estate to get tenants in at a discount. Others are sitting on it and waiting to see what happens. So really the issue here is over the next year, how many companies start to come back and are they able to start to fill up this space?
What are the owners of these buildings doing? We're talking now about companies that probably don't own the buildings. I think of the Salesforce Tower, they probably do own that one, but which is the tallest building in San Francisco, as I recall. But what are the owners doing and how are they working with these tenants and then the subtenants?
Yeah, the owners are in reasonably good shape because these leases are very long leases. So it's really on the major tenant. Like Dropbox is responsible for filling that building. It has this 15-year lease. So the buildings still have tremendous value. The burden is on the companies themselves if they want to avoid future write-downs. That's really where kind of the pain point is in the market.
Ari, thank you so much. We appreciate your time today and your insights. Melissa, great to be with you. Thanks, everybody, for watching Power Lunch. And we're going to toss it over to Closing Bell. What's the Dow doing? It's up 407. Have a good weekend, everyone. Closing Bell right now.
Tyler and Melissa, have a great weekend yourselves. Welcome to the Closing Bell. I'm Wilfred Frost, along with Sarah Eisen at the New York Stock Exchange. Stocks looking to finish off a roller coaster week on a high note. The major averages in the green, near session highs, but still pacing for modest declines on the week. Let's have a look at what is driving the action this afternoon. Reopening names are winning today on the back of the CDC's new mask guidance. Airlines and cruises are higher, and the TSA said yesterday it screened the most amount of passengers since the start of the pandemic. Data is front and center once again. Retail sales coming in flat for April, missing estimates of a gain of 0.8%. Consumer sentiment also coming in below estimates. And crypto is seeing a strong rebound after Bitcoin's tumble on Thursday. Dogecoin is leading the gains after headlines from Elon Musk and Coinbase. We will discuss that in much more detail later in the show. 59 minutes left in the session. The Nasdaq is up 2.5%, Sarah.
Near session highs for the Dow. Coming up on today's show, we'll dive into that weaker retail sales number with the president of e-commerce platform Shopify. And we'll ask whether today's number matches what he's seeing from the consumer. Plus, should you buy the dip in Disney? We'll break down the company's disappointing quarter with an analyst who says there's a lot to like in this report. The stock off its lows, down 2.2%. Let's get straight, though, to the big stories we are watching. 1 hour left of trade. Mike Santoli tracking the market action as always. And joining us to talk about today's retail sales miss is Morgan Stanley chief U.S. economist Ellen Zentner. But, Mike, start us off with this market. Big comeback for the Nasdaq and for the broader market.
Yeah, actually very broad comeback today, Sarah. Really a levitation. Yesterday was kind of an imperfect bounce. A lot of times the market's under a little bit of stress. The indexes go up. There's a lot of waffling back and forth. And then came in today, and it seems like they just clicked on the machines and said volatility's coming down. Sentiment got a little bit too nervous given the degree of the decline, and we're just going to buy them up. Actually kind of closing a gap that we saw in the index down from Monday's high right now. hit 41.78. You see this looks a lot like these other little dips that we had along the way, 3 to 6%. This was 4.5, right in the middle. Doesn't mean it's over, but it's very similar in the sense that there was one focal point of the decline, whether it was the GameStop insanity, whether it was the flare-up in inflation this week, or whether it was yields going to new highs back in February. And then basically the market kind of reasserts the trend after a little while. That's so far the way it's acting. Take a look at the put-call ratio. This goes back 1 year, and you see this is coming into today. Real surge in the number of puts being bought relative to calls. So that means people are very concerned about immediate downside, hedging their risks. And this is well above what we saw actually in those other little pullbacks this year. Now, by the way, these are coming off of historic lows. So this is not a high level in absolute terms. It's just high relative to the relatively modest pullback we got in the indexes. And a similar story, if you look at the exposures of this National Association of Active Investment Managers, the weekly exposure, equity exposure index, this came down from over 100 down toward 50. So basically, they really pulled in their risk. And this is probably why people feel confident that we've reset sentiment and positioning a little bit. And we're, if you got the soft data today, it seems like maybe not as concerned about an immediate overheat if that was your concern after the inflation numbers, guys.
Treasury yields are retreating a little bit,
Yeah.
Mike. Commodities are kind of mixed. It seems like those are two places where the equity market are taking their cues on this inflation story and the growth perspective. What's your take?
Exactly. I think a lot of things across the kind of asset market front went to extremes, and they went to extremes in a way that you had to kind of pay attention to what the message was. If it was going to be an overheat or kind of there's just more friction in the economy because of bottlenecks and shortages and things like that. And so you do have a retreat a little bit, maybe a little more kind of an equilibrium coming back into play. So we don't know. We didn't get super oversold in stocks. People didn't start hating the market and panicking, but it was enough to kind of get some traction and perhaps close a little bit more of the gap that we had open up over the 3-day sell-off.
ARK Innovation ETF up 4 3/4%, still down 5% for the week. Mike, see you soon. The latest economic data showing the recovery maybe slowing down. Consumer sentiment coming in at 82.8 for the month of May, lowest reading since February. And retail sales for April holding flat compared to expectations for a little increase. The weaker data following inflation in April, seeing its biggest jump since 2008, and last week's huge April jobs miss. Let's bring in Ellen Zentner, Chief U.S. Economist and Managing Director at Morgan Stanley. Ellen, I've heard the bull case and the bear case on all of these reports, and that is the economic recovery is still very much intact and booming. Is there anything in any of these numbers that concerns you?
Well, you're going to hear a lot of takes on this because the data is all over the place. And that's really what's to be expected right now. There are so many distortions around COVID. When you're trying to get a $20 trillion economy back on track, you're going to get data all over the place. And so what do we make of it? Retail sales has been really knocked around this year by the timing of stimulus checks. So March was revised even higher to just explosive sales because that's when we got the bulk of the latest round of stimulus checks. So naturally, you would have a payback of some of that in April. The sentiment numbers were down and people were clearly worried about inflation, and that was driving that. But what do we make of the inflation data? Well, this is to be expected that we were going to have this near-term surge. The jury is out on how far we come off of that surge in the subsequent prints. And then finally, in the jobs report, you had, on the one hand, weaker than expected job gains, which for all we know could be a one-off, but then higher employment costs or labor costs because, look, employers are having to pay up to get people back to work. And we've seen other data that's corroborated that. So there are just a lot of underlying distortions here that often point in different directions, but none of this, on balance, has me concerned about the viability of the outlook.
Yeah, and retail sales, while they were unchanged at what, a level above 10%? So we're clearly above 2019 levels. The retail stocks are up today. What about that confidence number, though, Ellen? Falling on rising inflation concerns. How's the Fed likely to look at a number like that?
Yeah, so the Fed balances all inflation expectations, but one distinction that they do make, which you can also see in the market-based measures as well, is that one-year inflation expectations or short-term inflation expectations have risen much more sharply than longer term inflation expectations, because households can see what's there right in front of them and what's coming around the corner, right? As I try to get out to fly to see family this year, everyone else is going to try to do that too, and those airline prices are going to go up. And so they know that these higher prices are going to come. There's less confidence that the higher prices will stay over a longer period, but still those longer running inflation expectations have also risen. What the Fed does is they try to look at a holistic picture of inflation expectations, and they have a measure that they prefer called the Common Inflation Expectations, which has 21 different measures of inflation expectations in it. Unfortunately, Sarah, it is a quarterly measure, and as you know, markets like higher frequency. The Fed doesn't operate at a higher frequency. And so right now, that inflation expectations measure that they like to follow is showing them that longer term inflation expectations are still pretty stable. So it's not yet cause for concern.
Ellen, what are the chances that the Fed doesn't mind if it does end up being a little bit behind the curve, given that the immediate reaction might be that the market pulls back, but that the economy doesn't, and they're willing just to play that game to make sure that they don't choke off the economy in the short term?
Well, it's a great point. I mean, last year, certainly we saw the markets disengage from the economy. And this year, what you could be seeing is just the exact opposite. And you can't have a Fed that reacts to every market movement, or you would have a Fed that is making high frequency, bad decisions on monetary policy. And so, you know, when we get 1 week employment report, you know, they can't react to that. They have to wait for more. And as we heard from Vice Chair Clarida this week, he's been disappointed in the economic data, which means that they're going, or on the labor market data, which means they're going to have to wait for more prints to come in to be sure that the trend is not accelerating. And most likely that delays how they're thinking about the tapering of their own balance sheet. When do they start taking their foot off the gas pedal? On inflation, you can say the opposite. The market's getting very excited and worried about inflation, but the Fed is not yet worried about inflation because, as you noted, they want to see inflation higher. They want to see it higher and sustained higher. And so far, things are moving in the direction that the Fed wants to see. The market is extrapolating just in some sort of linear fashion and saying, whoa, inflation is here and it's only going to get worse at the same rate. And that's really gotten markets jittery.
Maybe by the time we get to the fall, inflation will tail off again. But what are the chances, Ellen, that the inflation print begins with a 4 in front of it for the next, let's say, 2 months?
Well, I think we probably absorbed most of the upside shock in the April data that came this week. So April and May, which is data that's being reported this month and next month, we're expected to show this near-term surge. And we've been warning investors, expect it to surge to the upside, however far you could imagine. And so, of course, we saw a big upside surprise even to those expectations in this latest report. What that does, though, it takes some of the steam out of the next report, which will still be high, but not as high as this latest report. And therein, we start to move out of this range of where we're comparing back to last year when we took the biggest disinflationary hit to the economy. So pushing up the numbers just from that easy year-on-year comparison will be coming out of the numbers. So there's not a whole lot of prospect on core inflation to get a 4 handle in front of it before the end of the year. Core inflation generally is a very slow-moving beast. And so I would put that at low odds. But does it remain elevated? Yes. And we remain above consensus and above the Fed on our expectations for inflation. And particularly as you look at factors like labor costs that we do believe are more sticky and will show up in the data in the way of price tolerance. Households are incredibly price tolerant right now, which means businesses will be able to pass on those higher input costs from labor and other input.
So speaking of labor, I wanted to ask you quickly about wage increases. McDonald's this week raising wages for more than 36,000 of its employees that work in the company stores, an average 10% increase. We've talked to the CEO of Denny's here on this show. What is the deal with these labor shortages at a time when there are so many millions of people still out of work?
Yeah, so it's a good question, Sarah. I think that we could probably point to many different factors, but not be able to really assign how much is owed to each of those factors. So certainly there are lingering health concerns about returning to work, despite CDC updates on it being safe when you're vaccinated, you probably still have some lingering concern there. Now, what also allows you to make the decision to hold off on going back to that job might be added benefits, unemployment benefits that allow you to financially match the decision to stay out of the labor market. You've got uneven school openings and school that hopefully will be open fully in the fall, which is keeping a lot of women with children out of the labor market. So I can point to a host of issues of why labor is not there to fill positions when there are so many millions out of work. And it may be that it's not until later in the summer, say in August, when all of those benefit programs are expiring just about all at once, September 6th. So I'm going to get out there and look for a job starting in August, because I'm pretty sure the jobs will be there.
Ellen, great to see you. Thanks for joining us.
Thanks, guys. Have a great weekend.
Ellen Zentner of Morgan Stanley. Coming up, there's plenty of green on the screen today, with one notable exception. Disney is getting hit after streaming growth missed the mark. We'll discuss whether now's a good time to buy. That's coming up next. You're watching Closing Bell on CNBC. Disney shares in the red after the company reported its Disney Plus subscriber growth slowed and missed Wall Street expectations. However, CEO Bob Chapek telling CNBC last night it's what they had expected.
We've added 30 million new households to Disney Plus just in the first 6 months of the year. So we're extremely bullish. And in fact, this quarter's numbers were exactly as we projected internally. So no disappointment here.
The slower sub growth is similar to what Netflix saw. However, Netflix average revenue per user in the US and Canada was more than $14 per month. Disney saw less than half of that. Of course, it has a lower price point. Let's bring in Jessica Ehrlich, media analyst with Bank of America Securities. She's got a buy on the stock, a $223 price target. Very good to see you. Thanks for joining us. Jessica, I guess the first question is to what extent people are starting to draw the conclusion that the rapid growth in Disney Plus subscribers was pandemic related rather than long-term sustainable structural related.
I mean, I think today's miss, the reaction of the stock seems a little overdone. It was the sub numbers were just over 1 million off of our estimates. Estimates have been all over the street. As we all just heard, Bob Chapek said it was in line with their estimates, which of course we don't know. Disney doesn't guide to sub numbers. So, they're at 103, 104 million subs in just over a year. They must have reiterated 4 or 5 times last night on their call that they still maintain their guidance of 230 to 260 million subs by fiscal year in 24, 5 years after launch. And we're right there. Our projection is 250 million. I just think, it's a slight miss versus expectations, but it's enormous growth. And this is before they really have all of their product flowing. Remember, they couldn't produce what they planned to because of COVID.
So to what extent, therefore, do you think that the share price pullback is overdone? But I guess compared to the fact that it is fairly richly valued and not all of the business lines are growing as fast as the Disney Plus subscribers are.
But that's the key to the story. If we all believe the economy is, you just had a piece on inflation, the economy is heating up. What better way is there to play, who better to invest in than Disney as the economy reopens? So pre-COVID, 50% of operating income came from the theme parks. Demand for travel and demand for Disney's parks specifically is incredibly strong. One of the things management said was that it's above 2019 levels, and that's not including international visitors who still can't come. So with capacity restrictions easing, so instead of 6 feet distance, it's 3 feet, and because they're putting new technology in the park, they can get more people in and out more efficiently. Their costs are coming down. So the bottom line is theme parks are just beginning to recover. And we will see that over the next quarters and years. And that's where the surprise will be. There's enormous leverage in the theme park business. It's largely fixed costs. And when demand is strong, which it probably will be for the foreseeable future, we'll see really strong growth. So historically, whenever there's been like a recession or some pullback in attendance, whether it was 9/11 or something, or the economy, there's a 5-year, once the parks pick up, there's a 5-year growth curve.
Do you think that's already in the stock, Jess? I know they were very happy about the fact that you don't have to wear masks at Walt Disney World in Orlando in 95-degree heat, and that could mean more capacity inside the parks ultimately. But do you think that recovery story of parks is already in the price?
I don't think people remember. Honestly, I don't think people remember how much they can surprise on the upside. There is so much leverage in this business. So they can go from under $1 billion this year to $6 billion plus in operating income in a year. And there's a 5-year growth curve. I think that the demand is really, let me give you another example. Their cruise ships obviously are not running right now, but they're going to start selling tickets for a cruise that's like a staycation. People can't get off the boat. And the demand is crazy. But that's just one of their businesses. It's a big one, which is why, of course, it's important to talk about. But all of their other businesses are just opening up. So television production, film production, and distribution, movie theaters are opening up. Broadway, Disney is a very big producer of Broadway. All of these things will be very, very positive for Disney stock. And we're talking about Disney Plus like it's a disappointment. They missed a number in one quarter. Disney Plus is a massive success. And if you put it in the scheme of where direct-to-consumer will be, I think most people in the world would think that the primary bundle will be Netflix, Amazon, Disney Plus, and the other companies you can trade around, churn in and churn out of. This is a really good story. And the Hulu and ESPN Plus numbers were also very strong.
A full-throated bullish case on Disney. Jess, thank you for joining us.
Thank you.
With the stock down 2%. Dow's up 400 points. It's one of the few red stocks in the Dow right now. Goldman Sachs is adding the most, 68 points to the Dow. Up next, the new New Yorkers. There's been much talk of an exodus out of the city, but there are actually tens of thousands of people looking to move in or buy for the first time. We'll bring you those new stats next. And as we head to break, check out some of today's top search tickers on CNBC.com. 10-year yield right on top. Yields are moving lower today, followed by Disney off the earnings move, Tesla, Coinbase, and Dogecoin. Dogecoin higher with Tesla. Coinbase, though, has given up some of its gains after a good earnings report. We'll be right back. Welcome back. Throughout the pandemic, we've been hearing stories of people rushing to leave New York. But it turns out there are tens of thousands of new New Yorkers moving in. Robert Frank has a look at what it means for the real estate market. Robert.
Well, Sarah, more than 20,000 people moved into Manhattan in the beginning of the year, many attracted by lower rental and real estate prices. April saw the highest number of new rental leases on record with over 9,000 new leases. Rental prices were down 21%, landlords giving an average of more than 2 months of free rent. We talked to Robbie LeDove. He's a new arrival who found a 2-bedroom that used to rent for $7,500 a month. He got it for only $5,500. Let's take a listen.
Kind of spent my whole life like drooling at the skyline and dreaming of the day that I'd finally be able to live here.
Now, apartment sales also recovering with over 6,000 sales contracts signed so far this year. That is the strongest start to the year in over a decade, guys. So a lot of new people finally able to afford to come to New York, starting this real estate recovery.
Robert, thank you very much for that. Let's hope the trend continues. Still to come, we'll speak with the CEO of Coinbase competitor FTX Exchange about the wild week for Bitcoin and the outside influence that Elon Musk has had on crypto prices. As we had to break, is a check on bonds. Yields a little bit lower again today after their spike earlier in the week. 1.635 on the 10-year. We're back in a couple. Thirty minutes left in the session. Let's check in on some individual market movers. Shares of Aurora Cannabis dropping today after reporting weak results yesterday after the bell. The company cites challenges in Canada due to pandemic restrictions, such as consumer access to in-store retail shopping. The stock down 7%. And Fisker has finalized a deal with Foxconn to make electric vehicles in the U.S. starting in 2023. The company says 4 states are under consideration for a new plant, and we'll ask Fisker's CEO about the partnership when he joins us on Monday in a First on CNBC interview.
Time now for a CNBC News Update with Rahel Solomon. Rahel.
Sarah, hello, everyone. As Israel continues to target Hamas sites in Gaza in response to rocket attacks, the Biden administration is trying to de-escalate the conflict. The White House says that it's trying to use its relationships in the region to find a diplomatic resolution, but it is repeating its long-held position that Israel has a right to defend itself. After 3 days, barges are moving again on the Mississippi River near Memphis. The discovery of what's being called a significant fracture in a highway bridge between Tennessee and Arkansas prompted the halt on Tuesday, but now the Coast Guard says that it is safe to travel under the bridge. Vehicle traffic over the bridge, however, still is not allowed. That will remain closed indefinitely. Some gas stations as far north as Washington, D.C. still don't have any gas, as panic buying magnifies supply problems caused by the Colonial Pipeline shutdown. Now that the energy is flowing again, the White House is assuring motorists that most affected areas will get fuel shipments over the weekend and into next week. And check out this incredible video from the Chicago Fire Department. Take a look as you see this black cat there jump 5 floors from a burning building and then just walk away, sort of hops and then walks away. The feline, now known as Hennessy, the flying cat, has not returned home. Neighbors are looking for the cat. Glad the cat's okay, but I guess that's why they say cats have 9 lives. Sarah, I'll send it back to you.
And
That's crazy. Only cats can do that.
springy legs, that's insane.
That's
I know.
Weird. Rahel, thank you.
Yeah, almost as scary as horses, which we're talking about later.
That's a weird thing for you. Wilfred's afraid of horses. We've got about
Terrified.
28 minutes left before the closing bell. Here's where we stand in the markets. The Dow's up 375 points. We're off the session highs, which were just over 400 points. Still going strong. S&P's up 1.5%. NASDAQ's up 2.3%. We are still tracking for our worst week, though, for stocks since back in February. S&P 500 looking at a decline of more than 1%. Straight ahead, as the pandemic restrictions ease, will we see more shoppers move away from e-commerce and heading back into physical stores? We'll ask Shopify President Harley Finkelstein about how his business could be impacted if consumer habits change. Next on Closing Bell. Retail sales flat in April following a surge in March. Consumer sentiment also coming in today, getting hit on inflation concerns. Let's get a closer read on the consumer now. Shopify President Harley Finkelstein joins us for an exclusive interview. The company has 107 million registered users. Harley, it's great to have you. What are you seeing from the consumer across all of the e-commerce businesses that you serve?
Hey, Sarah, great to be on the show as always. So first, let's start with the retail numbers that came out, and then let's talk about consumer preference and the big shift that happened there, because I think it's really important. So first of all, the latest retail numbers, I think they underline the importance of entrepreneurship in the retail industry's economic recovery. So while the latest numbers show no change compared to last month, we see the spending remain steady, and I think that's a positive sign. In March, we saw retail sales grow about 9.8%. That's following another round of course, stimulus checks, showing that consumers have this urge to spend as we begin to emerge from economic turmoil. But retail is really not just about big box stores. I think that it's clear to a lot of us consumers that entrepreneurship and the independent brands that we love will play a key role in economic recovery and will be a major driver of this momentum. But we don't anticipate any decline in terms of our version of retail. I think the other part of this is that consumers are increasingly voting with their wallets to support these independent brands, meaning those merchants are going to continue to play a role as we open up. And we're seeing more of these brands enter the market more than ever before. An entrepreneur is getting their first sale on Shopify every 28 seconds compared to about every minute last year. And now Shopify, our merchants are about 10% of total e-commerce sales, and we're a proxy for independent retail. So I think that's going to continue. On the consumer preference side, let's talk about that. I think we've all seen these massive shifts from COVID, and I think a lot of those preferences, those shifts will remain. The biggest one, however, is that the center of gravity is now going to be online. So modern brands, modern retailers who want to sell across to consumers, they have to sell across every single surface area. That means that consumers are going to want to shop wherever it's convenient for them. And that will also mean offline commerce. Consumers care about conscious consumerism. They want to buy from brands whose values reflect their own. And I do not think that direct to consumer is going to be a fad. I think it's going to be steady state.
So obviously, this is your business and you believe in the secular shift toward e-commerce and online spending. But no doubt the pandemic drove huge traffic gains across all of these businesses online. You don't expect any decline from these levels as the economy reopens and people can go to stores again?
So the way that we look at retail is not necessarily channel-based. We think the future of retail is retail everywhere. That's the reason why Shopify doesn't just do e-commerce. We do offline commerce. We connect to Facebook and Instagram and Pinterest, and more recently, TikTok. So we think that if a consumer, if a brand wants to sell to modern consumers, they have to sell absolutely everywhere. Now, in terms of what's going to happen, e-commerce still has massive runway. Remember that we're still sub 30% in North America. It is slightly higher in the UK, higher in China, but e-commerce as a percent of total retail still remains very low. If you look at a place like Australia or New Zealand, it is not an exact proxy for the rest of the world, but it does provide some insight because they're on the other side of the pandemic. And we have not seen any slowdown on Shopify in terms of consumers buying from our merchants. In fact, online GMV remains at elevated levels in those places.
What about new business launches, Harley? Do you think that has been a pickup has been driven by the pandemic, and could that, even if it keeps growing, just plateau a little bit as we go back to normal?
Well, you saw last year in 2020, the United States had a record amount of business registrations. We saw a record number of new merchants, new entrepreneurs enter the retail space more than ever before. So certainly the pandemic did accelerate that. It acted as a catalyst for it. But a lot of those businesses that we saw created during the pandemic are going to last long after the pandemic. Just look at, I know you're all in New York City and there's restaurants opening up now. A lot of those restaurants created either, wine shops or to-go businesses or meal kit products. That's not going away. They now know that there's an entire new sector of their business and they're going to continue to double down on it. What I think actually the retail numbers from April show is that more traditional retailers need to think about their business as retail everywhere, not simply physical or simply online, but selling to wherever the consumer desires it to be.
And Harley, do you have any idea with these people launching new businesses on your platform, whether that is their sole focus or whether people are actually giving it a little bit of a try on the side whilst they still have another job? Perhaps they'll have two jobs permanently. And is that something we should think about for the potential output and productivity of the economy long term if people are suddenly being able to do two different careers or jobs at the same time?
It's a great question, Wilfred. In the last quarter, Shopify saw Lord & Taylor, Kraft, Mizuno, the WWE, Tinder, Chex cereal launch stores on Shopify. So obviously, we see a lot of established brands. But the majority of the merchants joining Shopify are new entrepreneurs. And yes, some of them started their store, their business, because they wanted to supplement their income. They needed to replace their income if they lost their job. And a lot of them will continue long after the pandemic. The question is all of us going to be running side hustles at the same time as our full-time jobs? That remains to be seen. But the one thing that I'm certain about, I think most of us are certain about, is that this idea of entrepreneurship is becoming a lot more accessible to more people. And that, I think, is a great idea.
You mentioned your partnerships with social media companies. One in particular, Harley, I wanted to ask about was Facebook, because I know you have a big partnership with them, but they're also launching Facebook Shop and trying to build an e-commerce platform. Isn't that ultimately a threat to your business?
Actually, we're their partner on Facebook Shops. In fact, when Mark Zuckerberg announced it, he announced it with Toby, our CEO. They did that live together. So we are the commerce partner for Facebook and for Instagram. But what you're suggesting, Sarah, is right. There's going to be so many more surfaces that are going to open up, that are going to be introduced to the consumer, where consumers can buy. Every time there's a new surface, whether it's social media or it's cross-selling on a marketplace, or it's a new type of physical retail concept like pop-ups a couple years ago, all of those are new opportunities for merchants to sell to new consumers. The key, though, is that as there's more opportunities, more surface area, the complexity of commerce and retail goes up. And we think that leads to Shopify being more valuable. And I think Shopify is really this rare story where we were this incredible pandemic story, and now we're becoming a recovery story as well. And that, I think, makes us quite unique.
Harley, great to see you. Thanks so much for stopping by. Harley Finkelstein of Shopify. Still to come, a tough week for Tesla, and DoorDash delivers a big spike. We've got details on those stories and much more next in the Market Zone. And May is Asian American and Pacific Islander Heritage Month. All month long, we'll be spotlighting CNBC contributors, business leaders, and our own on-air anchors and reporters. Here is the CEO of MongoDB.
I had the benefit of amazing role models growing up. They taught me three things: dealing with adversity, adapting to different cultures and norms, and taking risks. And those three things were seared into me as I was growing up and allowed me to start my first business when I was 31, gave me the strength to deal with setbacks and challenges as I was doing so, and also allowed me to build a global business where I could connect with people from different backgrounds, cultures, and norms. And for that, I'm eternally grateful.
14 minutes left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here to break down all these crucial moments of the trading day. And today we've got Ariel Vice Chairman Charlie Vorinskoy back as well. Charlie, good to see you. We'll kick it off with the broader market. Stocks are rallying for the second day in a row near session highs. Despite today's gains, though, the Dow, S&P 500, and NASDAQ are all on track for their worst weekly performance since late February. Mike, it was a tumultuous week for the market. We're ending on a high note. What's the driver for this rally, especially in the NASDAQ, which is coming back?
I would say the driver for this rally was the sense that the shakeout over 3 days was not necessarily about anything that was core to why this market is up here necessarily. That little inflation scare, a little bit of a positioning shock. We also have had the big NASDAQ stocks, the growth stocks, having been leaders on the downside. They did seem like they got a little bit stretched. That was the one part of the market that looked like it was oversold and primed to bounce. Yields down, allowing it to happen. So I do see this as a lot of the typical give and take of a pullback. Today's action, this sort of just low volume levitation over the course of the day is showing you that nobody really felt compelled after this to sell aggressively into it. It's still bringing the market right back up to another one of these little points where it's an obvious place to have a little bit of an argument about what comes next, because it's right up near this area where the market stalled for 4 weeks before this week's spill.
So, Charlie, inflation arrived and has gone again already, right?
Oh, stop. Well, no, absolutely not. Inflation, finally, we're getting that people are acknowledging inflation is here. Mr. Powell has been denying that was here. He was saying, what are you going to believe, me or your lying eyes? And we saw a very scary number, 0.9% in 1 month. The apologists for inflation say that this is all about where inflation was a year ago, but that 0.9% is versus a month ago. So we are having real inflation right now. All the markets are showing it, the tips market, the commodities markets. We are just now seeing inflation in the numbers, but we're going to be seeing a lot more of it for the next at least year.
But what leads that to actually hurt stocks, Charlie? Have we seen this week that only when yields spike as well, the stocks sell off? They've settled back the yields over the last 24 hours or so, and stocks are rallying. So does that mean, again, that for the next few weeks at least, until we get another print perhaps on the inflation side, and unless or until rates do have to go up, that actually stocks are going to be the best place to be again?
Yeah, discount rates are not necessarily the same thing as 10-year Treasury rates. Discount rates are the rates in which people discount the future earnings, particularly of growth stocks. And that's not necessarily the same thing as the risk-free rate. I admit I'm stupefied as to why anybody would buy a 3-year Treasury rate for 33 basis points of return, knowing you're going to have a negative return, but there are people that are doing it. But that doesn't necessarily mean stock investors will. And stock investors are increasing the discounts that they're putting on long-term earnings. That's going to be bad for growth stocks and relatively better for value.
Now, it's been a very rough week for shares of Tesla. Phil LeBeau breaks that down for us. Phil, a little bit of a bounce today, but big declines week as a whole.
Yeah, Wolf, right now Tesla is on track, unless there's some big rally here in the last couple of minutes of this session, to have its 4th straight down week. And that has happened before. It happened earlier this year. You don't see it very often from Tesla. So this is they're on track for the 4th down week in a row. Look what happened this week with Tesla. The headlines, it would seem like they were swimming against the headlines all week. They had the weak China sales report. There was another NHTSA crash probe announced, although they did get some good news from the initial investigation of a crash in Houston that seemed to steer away from autopilot being linked to that crash. And then you have the Tesla shares dropping under the 200-day moving average, now trading under $600 a share. One other auto note, Honda early this morning over in Japan reported its quarterly earnings. And while they did swing to a profit, the company also said that the chip shortage will be hitting their 2021 earnings. Guys, back to you.
Phil LeBeau, thanks so much for that. Mike Santoli, of those factors that Phil just went through, the technical one, below 600, below 200-day moving average, perhaps getting the most attention this week, though important to see it bounce today because, of course, yesterday, while other things were bouncing, Tesla still closed lower.
Yeah, for sure. I mean, the stock really broke stride hard starting in January. It obviously is well below its highs. It's not really acting as almost any kind of bellwether except for, the collective enthusiasm for electronic vehicles and Tesla's ability to exploit it. By the way, in the huge sell-off in the heart of the COVID crisis, March of April of last year, it barely just touched its 200-day average, along with the overall market crashing, and then it just vaulted from there. Not to say it's going to do the same thing, but the fact that it's down so much off its highs and it's only now coming in contact with that longer-term trend line shows you how the stock just went parabolic. So it's kind of, charting its own path here, just in terms of magnitudes of a move for a stock above $500 billion in market cap.
DoorDash shares are surging today after delivering a bullish forecast. Deirdre Bosa with the details. Deirdre.
Sarah, so far, no evidence of a slowdown in food delivery. And as you said, more bullish on the remainder of the year. Take a look at some of these numbers the company put up. Revenue tripled, grew nearly 200%. Gross order volume, 222%. Now, DoorDash faced the same labor issues that Uber and other gig economy companies have been facing, but the company said that they were resolved by the end of Q1. Remember, too, that DoorDash is far more profitable on an adjusted EBITDA basis. It's in the black on that metric. Dash is having its best day since its IPO. Shares up more than 20% as we head into the close.
Deirdre Bosa. Deirdre, thank you. A bit of a surprise, Mike, for this one, because you might think that restaurants reopening and reservations going up, which we see in the data in places like OpenTable, would hurt online food delivery. Still going strong.
Yeah, I mean, obviously, this was an area of consumer behavior that was already on a huge upswing before the pandemic. You have to distinguish, I think, between things people started to do or do more only because they were locked down and things they were getting in the habit of doing before. So I think it's a relief. It's not so much a fresh reason to think that the story has changed entirely for DoorDash. I mean, if you look at that chart, it shows you we're just kind of taking back a few weeks worth of losses, really coming into a little more balance probably between kind of the bears and the bulls. It is a pretty heavily shorted stock for one that's only been on the market several months. So I think it's good fundamental news, but you still have this tremendous question over long-term profitability, business model, and how much to pay for it today.
Charlie, you mentioned earlier, pivoting back to the broader markets, that the outlook therefore favors cyclicals and value stocks in a relative sense over growth stocks. The fact you use the word relative, does that mean in absolute terms even all of your favored stocks are looking a little bit expensive, a little bit pricey?
No, I wouldn't say that. I'd just like to reemphasize the point that, quoting Warren Buffett, inflation is a force like gravity that brings down all financial assets, and value stocks are not immune from that. And so if we do get a significant increase in inflation, which I think is very likely, then we will need a real strong recovery in the earnings of many of my favorite stocks, many of which are trading at very reasonable multiples. So we talk about BorgWarner that makes the powertrain for electric cars and gas cars, and that stock is trading for 11 times earnings. So long as we get real demand for cars, BorgWarner stock is going to do fine. But if I'm wrong and we don't have the economy expanding at the rate I think it will, BorgWarner won't be spared.
Recent IPO stocks have taken a beating over the past few weeks. Names like Airbnb, Palantir, and Affirm all significantly lower from their all-time highs. Goldman Sachs turning bullish on one recent IPO, upgrading cloud company Snowflake to buy. The firm says Snowflake is well-positioned to capitalize on a generational shift of data and analytics to the cloud, and that overall software stocks remain winners as structural changes accelerated by the pandemic continue to drive growth. Shares of Snowflake are still down more than 30% in the last 3 months. Mike, there's a sort of slight feeling that a few of the brokers have been waiting for a pullback to then be able to go bullish on the company that they've liked the most in this space for the last few weeks, which is not a criticism, it's to be commended. Trying to be dynamic and make a big call when there's more upside, and it feels like that for this one on Snowflake a bit.
Yes, something that's been just about cut in half since the high in December. I think almost everybody gave the company tremendous benefit of the doubt in terms of being in the best part of a great, fast-growing secular growth business in cloud and data analytics. The question was, it just came out with this crazy valuation from the jump at $100 billion out of nowhere. So now I think the trick is just deciding if the market is going to return to these things, become more selective name by name. As we know, maybe this isn't an ARC stock, but it is an ARC type stock in terms of being a disruptor, being a multiple of revenue type story, and all those things have moved in a group. So now the question is the market going to start to distinguish among them and have those longer term trends reassert themselves?
Charlie, do you distinguish among tech at all, or you're just away from the group as a whole? I know you're not into these hot IPO high flyers, but is there value there in some of the bigger cap tech, like a Google, for instance? All the FANG names having a good day today?
Yeah, I think you can do a spectrum here. I mean, at this point, Google and Amazon are real companies. It's not debatable. Microsoft is a real company with real earnings. Still, in my opinion, probably not worth their stock prices, but there's a big difference between those companies and some of the IPO companies that are just business plans. I happen to like Oracle, which is trading at kind of a 15 times forward multiple 2 years out. That would be my favorite in large cap tech.
And it's had actually a pretty decent year. We've got almost 2 minutes left to go in the trading day. Dow is up almost 400 points. NASDAQ again bouncing back strongly, 2.4% higher, still looking lower for the week by about 2%. The S&P 500 down 1.4%. Mike, what are you seeing in the market internals as we march into the close?
Actually, very, very strong. So yesterday, the story about the internals was that it was really much less enthusiastic than the index move. The breadth was pretty weak. Today, we have nearly 90% upside volume. Not quite, but almost. Some people think 90% is an important threshold. Whatever it is, this is very lopsided. It's pretty much across the board buying. It's just a matter of growth being up a little bit more than the rest. So you can put that check mark down and say, okay, this piece of the rally maybe qualifies as being a little more meaningful. Take a look, though, at one of the divergences that is sort of starting to narrow today, which is banks versus mega cap growth. So massive gulf opened up between the KBW Bank Index and the NASDAQ 100. Still more than 25 percentage points just in the last 3 months. And this is the kind of dynamic where even if the market itself isn't really going to change its character, you might see these things narrow in the very short term just because they've gotten a little bit stretched. So that is going on today. And then the volatility index has been a real story for this move. It has given up pretty much all of that spike that we got in the first part of this week. We're back under 19. So it again starts right now, at least, to look like one of these passing storms. And maybe we can say the market has settled down a little bit. Certainly, never know. We haven't regained all the losses in the index, but it does seem like a pretty twitchy reaction to that 4% pullback that's now mostly been unwound. Well,
yeah, 40 seconds left of the session. As Mike says, a very strong and broad bounce to what has been a negative week, highlighted by the fact that you have a cyclical sector, energy, and a growth sector, technology, that top the sector performance charts today, though all 11 sectors are higher, with the S&P up 1.6%, the Dow at 1.2%, and the NASDAQ composite up 2.4%. Worth pointing out, though, all three of those are lower by more than 1% for the week as a whole. The NASDAQ down 2.3% for the week as a whole, but nonetheless a nice way to end the week. Tesla bouncing 3%, but remaining down 12% for the week. The ARC ETF up 4.5% today, halving its losses for the week. Still down 5% on the week, but nice 4.5% gain today. At the close, Sarah, the Dow at 1%, the NASDAQ up 2.3%, S&P 500 splitting the difference up 1.5%.
Ending on a high note, still worst week for stocks since February. Welcome back, everyone, to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost and Mike Santoli, CNBC senior markets commentator. Take a look at how we finished up the day on Wall Street. Dow higher by 360 points or so. The biggest contributor to the Dow gains, Goldman Sachs, Boeing, Salesforce, Microsoft. So you had a good mix there of the cyclical names tied to the recovery, like financials and Boeing, and also some of the tech stocks, which played into the rally. The S&P finishing higher by 1.5%, still leaving it down for the week. Actually, its first down week in the last three. S&P 500 down 1.4% for the week, despite today's broad rally where every sector rallied. There's the NASDAQ, up 2.3%, so a nice comeback, but also still lower for the week by 2.3%. It's been down for the last few weeks, and technology has been especially hard hit, came back strong today. The small caps also did 2.5% higher there on the Russell 2000. Airline stocks taking off after the CDC announced fully vaccinated people do not need to wear masks in most situations. Coming up, we'll discuss how high these stocks could fly, what the outlook is looking like. Charlie Babrinskite from Ariel Investments is still with us, and Alicia Levine from BNY Mellon Investment Management joins the conversation. Nice to see you, Alicia. First, though, I will send it to you, Mike, on a bumpy week for stocks, a week in which lumber prices, for instance, came off 7.5%. Big moves there. A lot of people looking at that as an inflationary tell. And the market overall struggled.
Yeah, some of the trending moves that really seemed to get out of hand a little bit in the short term did unwind slightly. They had the stock market where I think almost everybody was thinking, oh, we're probably due for a little bit of choppiness, a little bit of a pullback. We got it. It so far looks somewhat like what we've seen earlier this year, these sort of single-digit percentage drops. A little bit scary in the moment. Not really sure if this is going to be really bring some more pile-on sellers out. It didn't do that yet. We still obviously have to see. And again, I was mentioning the S&P 500 did reassert itself over 2 days, but then conveniently brought itself right back to an area where, just a week ago we were saying, wow, it looks like that's an important threshold it should hold on the downside. So we'll see how it plays after the weekend.
Alicia, does the action in the latter part of this week suggest that we're not going to see more than a 4%, 5%, 6% pullback for the course of 2021?
Yeah, it looks like this pattern's really holding, where the market self-corrects up to about 5% and we continue higher. I mean, you can't get around the fact that we're going to have a spectacular growth year, both in the real economy and therefore in earnings, driven by the cyclical and the value sectors. And the markets are really reflecting that. We are still tilted to cyclical and value here and buying into reflation going forward. And particularly that means good days ahead for financials, even from here. Technology was terrific today, but I'd say this, I think there are more tough days ahead for technology. And we saw this past week a tantrum in the equity market, not in the bond market. And you're probably going to get more of those going forward as we get some of these hotter prints moving forward that last longer than the Fed's presupposition that it's going to be very temporary.
So you're not buying that it's a temporary inflation story? Is that what you're saying?
What I'm saying is, the data so far suggests it can be synonymous with it being temporary. I just think it's going to go on longer than the next couple of months, which is when we lap the calendar in those negative reads. And every month that it goes on longer, you start getting inflation expectations moving higher. And so I'd say that's the one risk. And then technology is really in the crosshairs here. We'd be very cautious on the speculative names, although we do like, those large cap profitable tech names. They'll earn through everything.
Charlie, what's your take as to whether those financial stocks, Mike mentioned that discrepancy in the performance over the last 3 months, whether they can continue to perform? Yes, we get the argument that they're better hedged to inflation and economic rebound, but have they outperformed too much too quickly?
If you look at absolute valuations, then I would say no, they're not overpriced. Goldman Sachs is trading at 11 times forward earnings. Bank of New York is trading at about 11 times forward earnings. And those earnings are going to go up a lot if we get a better interest rate environment. Bank of Oklahoma, that we happen to love, is I think at 13 times forward. So they are, compared to the S&P at 22 times earnings, still very attractive. The one thing I would warn people on is it's become, everybody says that banks do wonderfully in an inflationary environment. Go take a look at the savings and loan environment and what happened to savings and loans in 79 and 80 and 81. They went out of business because they were lending long and borrowing short. And you better have your book in the right position in a rising rate environment.
Financials were one of the three sectors, Mike, to finish higher for the week. Looks like financials, consumer staples on top, and materials, which is an odd combination.
Right.
Those were the only three sectors positive.
Yeah, they don't necessarily tell the story of, in unison of what's going on with the economy. In general, though, there was more of a reflationary tone to the leadership. That has not really changed. It shows in the broad index comparisons as well. Materials have a lot of momentum. A lot of that is things like chemicals as well as metals. And we'll see as the commodity prices come off whether that's something that can continue, because that really started to seem like a momentum trade as well.
Disney shares under pressure today after disappointing streaming subscriber growth. Julia Borston's got those details for us. Hi, Julia.
Well, Wilf, Disney's earnings far surpass expectations, but the highly watched metric of Disney Plus subscribers fell short. The company added 9 million new subscribers rather than the 14 million that analysts had anticipated. Though Disney CEO Bob Chapek telling me that the company is on track to hit its goal of at least 230 million subscribers by 2024. Chapek also said that Disney's parks business is rebounding with demand back at pre-COVID levels.
We see that confidence that we've been able to instill in our guests that we can operate our parks in a responsible way during this pandemic, plus the affinity for the content and all the experiences that we give them and the magic that we create, that's all going to pay big dividends for us and our shareholders going forward because they've got confidence in Disney and they can't wait.
And Chapek was very optimistic about the impact of the CDC relaxing its masks rules, saying that it will make Disney's guests a lot more comfortable in hot Orlando this summer. Guys, back over to you.
Julia, I guess the other area of that they're, of course, geared to is movie theaters. What is the outlook now, the slate, as it were, for big movie releases? Is there a flood of them ready to come from companies like Disney, or have they been hard to make in the last couple of months?
Well, look, there are a lot of movies that are coming out that have been done for quite a while. Disney has a number of big releases coming, including a Marvel movie, Black Widow. And these movies in the next couple of months are going to be distributed to theaters, but also on Disney Plus for that additional premium fee of $30. So they're going to be doing that simultaneous release. But then Disney announced just yesterday that they're going to have a film at the end of August and also one in September. One is a Ryan Reynolds comedy. The other is a Marvel movie. And both of those films will just be in theaters for an exclusive 45-day window. So Chapek's saying that going forward, they're going to have more flexibility. They're not going to be locked into the 90-day window that theaters used to get pre-COVID, but they will be favoring their own streaming service when it makes sense, because they really are interested in having that direct-to-consumer relationship. So a lot more flexibility going forward.
They're all kind of going at this in different ways. Julia, thank you. Julia Borston. Charlie, where are you on Disney? Is this ever a stock that you liked? It's had a nice run over the last year, but it's had a pretty weak start to 2021.
Yeah, this is a wonderful, wonderful, wonderful company that is unfortunately not attractively priced. You guys missed the company that's got wonderful movies coming out this year is Paramount, owned by Viacom, which has Top Gun 2 coming out, which has got to be seen in theaters, as well as A Quiet Place 2. So watch for Viacom to have a great year in movie theaters. Back to your question, Disney is a great company, but I only think it's going to make about $5 in 2022, and so the stock is trading at a big multiple of that $5.
Alicia, what's your take within the media space, the higher profile names or the traditional players?
So I think that the traditional players here are actually primed to run. I'm concerned about stocks that had their price, the future price booked in last year and have run so far so fast. As I said, those parabolic moves have to come in somewhat, and I'd be cautious on some of the price action that we saw earlier in the year. I like the more traditional names, and I think, the names that are attached to an experience will do very well this year, because I think demand is enormous, and it's enormous for people to re-engage, and I'd be looking at those kinds of names.
Alicia, I wanted to ask you about gas prices, which were another story this week, and we'd probably be talking about it up higher several years ago in terms of the impact on the consumer. So gas prices on average across the nation have gone above $3 a gallon, and according to AAA, and they're up 19 cents. 9 cents on the week, 18 cents from a month ago. More than $1 over a year ago. So this is happening at an increased time of demand, and clearly that's boosted energy prices, but also the Colonial Pipeline shut down. Do you think this is going to have any impact on the consumer?
I think we're already seeing that there's an impact on the consumer that we saw in the consumer confidence data today. It's clear that consumers are noticing the higher prices, and in some cases they'll go ahead and spend because the desire is so strong to re-engage. But I think overall that when you have the population noticing higher prices on everything, from restaurants to food to car to gas, it's going to affect. And the question is, at what point does it start affecting demand? And that's a real question out there. We don't know the answer. Very hard to predict it because we are going to have massive demand all at the same time. And we're seeing that in the data this week, that it turns out it's actually harder to reopen the economy than it was to close down. And so those supply bottlenecks are all over, leading to higher prices. There is risk that the consumer is going to say enough already. I don't think we're there yet because we've supported households. Households have $6 trillion in savings. So we're not really denting demand yet, but it's a possibility the longer it goes on, we're going to get there.
We have a news alert just crossing, by the way, on Viacom CBS.
Oh, a gift for Charlie.
Well, maybe, or maybe a negative. I don't know what it is yet. Julia, what is it?
Well, Dow Jones is reporting that the disputes between former CBS CEO Les Moonves and the company have been resolved. And it seems like Les Moonves, former CBS CEO, will not be getting the $120 million that he sued for. So when Les Moonves was dismissed in the wake of those sexual harassment and misconduct allegations, he sued demanding $120 million. That $120 million was put in a grantor trust to wait until the proceedings were resolved. Now the arbitration has been dismissed, and those assets, that $120 million, will not go to Moonves, but it will revert to the company. So this is a win for the Viacom CBS management, and Les Moonves is not getting that $120 million that he was pushing to get in that lawsuit.
Julia, thanks so much for that. Charlie, is it also a big win for shareholders or not perhaps a crucial factor?
No, a modest win in the less than $1 a share category. So no, but certainly better than going the other way. I don't want to say poo-poo. And the bigger news is that it's settled, that this is going to be not a recurring problem. So I'll call it a mild positive.
Charlie, just round things off in terms of your outlook for stocks for the rest of the year. We know your preference between growth and value, but are you less constructive perhaps given the run-up than you have been at any point earlier this year?
Yeah, I have to say, the Ariel Fund is up about 27% year to date. It's not going to be up another 27% the rest of the year. So clearly we have narrowed the gap between our valuations and the market. But I will say earnings have surpassed my expectations. For our own companies, for the whole market, they've come in better. I will say just a one cautionary note. That last jobs number was spooky, and that consumer confidence number today was spooky. And if we get a couple more of those, I'm not going to be quite as confident as I've been.
There we go. Charlie, Alicia, thank you very much for joining us. Have a great weekend. Still ahead, airline stocks are soaring on the CDC's new mask guidance. The index up 170% over the past year. Up next, we'll ask an analyst whether there's still time to cash in on the carriers. Plus, the CEO of crypto exchange FTX on whether Bitcoin can bounce back from this week's huge sell-off. We're back in 90 seconds. Airline stocks getting a lift today. This comes as the CDC relaxed its mask guidelines, saying fully vaccinated people don't have to wear masks or socially distance indoors. However, federal rules still mandate all travelers do wear masks, and people are on the move. The TSA screening more than 1.7 million travelers at airport checkpoints yesterday, the highest since the pandemic began. Joining us now, Sheila Kahyaoglu, analyst with Jefferies. Great to see you, Sheila. Thanks for joining us. I mean, clearly that's good news today, but the airline stocks jumped quite significantly when we'd already seen demand pick up a lot and airplanes fairly full. So what do you make of the stock reaction today?
You know, I think it's another positive data point we're receiving that the CDC is relaxing news. But don't forget, only 35% of Americans are fully vaccinated. About 50% are one dose in. So there's a way to go. But what we're seeing in the U.S. is U.S. capacity is only down about 27% versus 2019 levels. But Europe is really lagging, and that's what these airline stocks need. Europe is still down about 60% for the month of June, we're estimating, in terms of capacity relative to normalized levels. And also Asia is lagging. It's now down about 50%. So airlines are having a pop. You know, we continue to favor domestic over international for the reasons I just mentioned, the lag in vaccinations globally. You know, that's why you're kind of seeing Southwest lead the way here.
So domestic over international, does that also mean leisure versus business travel? And which airline does that mean you favor?
Sure. Southwest is our top pick in the space. We're giving them a premium multiple. These airlines trade at big discounts to the market. They trade at about a 50% discount to the market historically. So we assume Southwest trades at a 15 times PE multiple. The other airlines lag. The next one we favor would probably be Delta, given its U.S. domestic exposure and its European exposure, and then American. American is about 35% international, but when you look at that international breakout, it's a lot of Latin America, a lot of Caribbean, where we're seeing the market come back. And United is lagging given its corporate exposure as well as international exposure.
Do you think the airlines are going to have a tougher time enforcing mask wearing on flights now?
I don't think so. I mean, you've had TSA numbers that are above 1 million, 1.7 million a day. I think you've only had 1,300 cases of people rejecting to wear a mask since the start of the year. So those are pretty good statistics. I think the mask mandate is just being held in place because you can't necessarily reinforce that somebody's had the vaccine. And as I mentioned, only 35% of Americans are vaccinated right now.
What's your outlook at the moment on Boeing and I guess Airbus as well, and whether deliveries will start to play catch up fairly soon?
Sure. I mean, Boeing is improving. You know, we see the MAX electrical fix getting off the ground. About 170 of the 195 regulators have approved the MAX to get back in the air. We're still waiting on China. The one watch item for Boeing is what we're looking at right now is the 787, which is their wide-body aircraft, which carries passengers internationally. They have a little bit of a stockpile right now. They have about 100 of them in inventory, so we're watching that item. And that's why right now our favorite aerospace name, or the way to play aerospace, is Raytheon Technologies, a $100 billion company, and TransDigm, which is levered to maintenance spend for the airlines.
Got it. Sheila Kahyaoglu, thank you very much for joining us. Good to see you.
Thanks for having us.
That new data from the University of Michigan showing growing inflation fears are weighing on consumer sentiment. Mike Santoli taking a closer look to what Charlie Babrinsko just called Mike's spooky data.
Yeah, at least inklings of it. We'll have to see, though. Very important to see if it continues or not. So this is the one-year inflation outlook embedded within that University of Michigan consumer sentiment data set from this morning. And you see this huge shot up well above 4%. Now, that is spooky if, again, it's predictive of anything that's going to be coming down the pike. But look at this. 2011, we had a big run up to the same level coming out of the crisis here. 2008, similar type reading. So they also ask about further, like 5-year inflation outlooks. That also had a big jump. So the Fed's going to be attentive to that mosaic of things that say that inflation expectations are being anchored at a higher level. But for now, you have to just basically say this is like a straw in the wind. You have to see if it continues. Take a look at where money's flowing now. This is from Bank of America's weekly report on investor flows. this is the flows into TIPS or Treasury inflation protected securities. So that's basically a play on higher inflation rates, as are bank loan funds, because the yields on those loans rise as interest rates in general go up. So that's an inflation play. And gold and silver, also traditionally an inflation play. These are the three biggest categories of fixed income and commodity inflows for the year. And this is as a percentage of overall assets under management. 1.2% of all assets under management in TIPS funds came in the past week. What that tells me is we're really already bracing in advance. We're pulling forward the worry about inflation. It's not going to come necessarily as a surprise. Maybe that means that the market action this week showed you that there's a little time here. There's a little slack. We've already tried to kind of pre-position for a run in inflation, whether it comes or not, guys.
So gold is flat for the week and down for the year. Interesting.
Yeah,
Mike,
I said it's a traditional play, not that it's a good one on inflation.
Mike Zantoli.
Yeah.
Bitcoin, speaking of, bouncing back to end what was a very rough week for the cryptocurrency. Up next, the CEO of crypto exchange FTX on the future of Bitcoin and the outlook for the red-hot Dogecoin. Plus, BlackRock's Russ Kostrich on how inflation fears will impact the market, the sectors that he thinks look very attractive right now. Coming up on Closing Bell.
It sounds like a good opportunity to sign off today. It's a little early to sign off from what I normally do. However, I've got like no one viewing today, so why not sign out early? You know, it's been an awesome day actually. I mean, my brokerage portfolio is up about 3.5%, nearly 4. Um, my other my other long-term stuff will be up probably about 1.5 to 2%. So that'll be it. So overall, I'll probably gain well over 3% in my entire portfolio, which is going to be massive. I mean, just a huge, huge win now. I don't think it gets back everything that it lost this week, unfortunately, but I'll take at least one big good day. Other good news, lumber's down again. Go find out how this is happening. Like it's down for the entire week, down nearly 20% from its high, from 1,700 down to 1,300. So go figure how that's happening. I don't know if there's any fundamental reason for that. One of the big losers I saw today was Coinbase. They did pretty well yesterday, and they did really well after their earnings report, and then just didn't do well today. Of all the things that did well today, Coinbase did not. So very, very interesting. Even though you look at like its a competitor of it, Voyager, was up 12.67%. You know, so that was huge. ARKK was up 4.5, nearly 5%. Definitely trying to just claw its way back to normal. Meme stocks, I think we thought AMC was going to take off again today like it did yesterday. We got up to about 14.2 this morning, and then it fell off. I mean, it's still at around 13. They're still doing well, but not like we maybe expected. Same with GameStop. This actually started negative, went to positive, and then ended the day negative. But we did have good days from BlackBerry, Bed Bath & Beyond, and a few others in that category. Nokia, for example, Nokia is up to 4.9. So I mean, I'm personally nearing a break-even point with Nokia. Let me go to it real quick. I own Nokia at 5.84. So if I own it at 5.8, no, sorry, 5.85, it's right at 489 now. I'm only down 16% on Nokia, which is fantastic compared to what it used. A couple other good days. Firm up near 12% today. That's huge. DoorDash 22.5% today. It actually was yesterday super, super high, 25, 26%. EXPI bounced, which I was just saying 2 minutes ago how I wish I had some cash available for the EXPI at 26. There's a 26.5 got down to was it low 22, and even had 22 something yesterday afternoon. Now it's 26, 27 today. So great day. The good news is we saw a lot of people talk about yesterday and today that this sell-off is over. I don't know what that actually means. I don't know. like speculative, seat of the pants kind of feelings like that, but definitely will love the advantage of taking advantage of today. On the crypto side, let's see where the crypto's at. I think we were kind of hoping that there'd be just a huge breakout day with Dogecoin and Bitcoin, both, but Dogecoin more specifically because, of course, the Doge father tweeted about it yesterday or early this morning, whatever it was. It was up, nearly at 47% in the last 24 hours, so it did really well. Way up from currently up now from what it was a week ago at the same time. Barely, but it is. It's basically right where it started a week ago. So pretty good number. I mean, it's good. It's building a shelf of legitimacy around 50 cents. I don't see it bouncing back up to 75. Once it kind of stalled out around 55, 56 today, I knew it was going to, bounce up to dollar. It would have been great, but honestly didn't expect it. Litecoin's back up, Ethereum's back up from its low, Bitcoin's back up from its low. So overall, crypto did a good job of bouncing back today as well as the stock. So if we took all that into account, plus retirement accounts, plus everything that's invested, plus real estate, keep in mind, today's a pretty big positive day. Let's say that a big positive. So that's super, super exciting. I love big days like that. Anyway, we are going to hold on, let me see what we're talking about here.
Excuse me, Bitcoin got slammed because Tesla is no longer going to be accepting it. Why does he have so much power over the crypto market?
Well, I think it's not just crypto. I think he has power over a lot of markets. And I think just looking at the TSLA stock, I think you can see a piece of that as well. For whatever reason, I think he's emerged as one of the most compelling figures over the last few years globally. And, when he tweets, markets listen. And I think that in particular, his sort of affect is very much in line with the crypto ethos and with the crypto ecosystem's general appreciation for, memes and trading and meme-based trading. And so I think those have all combined to make him an incredibly popular and influential figure in crypto, especially.
So what do you say, Sam, when people push back on the questions that poses for what exactly crypto is as an asset going forward? It makes it harder to be a payment of exchange. It makes it harder to be a store of asset because of its volatility. Do you accept those pushbacks, or in fact, for your business model, does it not matter? You just want to see the volumes come in for trading?
Well, I mean, certainly for FTX, what matters the most is volumes. But, in terms of the utility of the asset class, one thing I'll note is that there are stable coins, which are, pegged one-to-one to the U.S. dollar and other assets. And so those will always have, the stability for payments. The other thing that I would say is that, when you look at sort of the price action of crypto, and, who knows what will happen in the future? None of this is investment advice. But certainly looking historically, there's been huge volatility and huge price appreciation. And I think those are not unrelated to each other. It's very hard to have an asset class that has huge price appreciation if it doesn't have huge volatility along the way. It just comes part and parcel with the big movements. And I think that as there's been, massive just price discovery for crypto, and I expect further price discovery for it going forward, until the world is confident what a Bitcoin is worth, it's not going to stop being volatile.
So Coinbase last night in their earnings release referenced the competition allowing some cryptos that they don't trade, alluding to Dogecoin, said that they're going to look into adding Dogecoin in the next few months. Do you allow Dogecoin, and do you think that what started as a joke actually is a viable cryptocurrency?
We do have Dogecoin trading, and in fact, it is the third most traded cryptocurrency on FTX today. There have been days when it has been the most traded cryptocurrency on FTX. And, I think that it does have a chance. I certainly a lot bigger of a chance than I would have said 6 months ago. And I think a key point for this is it absolutely started as a joke and a meme and nothing more than that. And I think it's a lot less clear right now that it is just a meme. It has a market cap of like, at 20, $30 billion. And you could say, oh, come on, that's ridiculous. But it trades tens of billions of dollars a day of volume. So you can get off size there if you want. And one thing that I would really say about it is, yes, it has historically absolutely been a meme. But a lot of things in the world just derive their value from our collective imagination about what they're worth. When you look at, gold is an example, right? Like it's worth what the world decides it's worth. And what the world decides it values is sort of like, collectible asset at. Dogecoin, although it started out as a joke, in the end shares that similar fundamental property or lack of property. It is what we make of it.
Well, Sam, thanks so much for joining us today. I know it's very early in the morning over in Hong Kong. We appreciate it.
Thanks for having me.
Crypto doesn't sleep.
Sam Bankman-Fried. Well, quite exactly. We also wanted to ask him about some of the particular trading they do on stocks, tokens that they ran around that.
Like
But maybe we'll get him.
GameStop.
If Sam can still hear us, maybe he'll come back and join us another time. Time for a news update. Melissa Lee has that for us. Hi, Melissa.
Hello, Wilf. Former Florida tax official Joel Greenberg will cooperate with federal investigators as part of a plea bargain revealed today in exchange for a lenient sentence recommendation. He will admit to crimes including using a website to find women he would later pay to have sex with him and others. Greenberg's case led to an ongoing sex trafficking investigation of Congressman Matt Gaetz. A spokesman for the Florida Republican says Greenberg can't be believed and Gaetz has done nothing wrong. The University of California system will not be using SAT and ACT test scores in its admissions process through 2025. That is part of a settlement today of a suit alleging use of the standardized test discriminates against applicants based on race, income, and disability. In a new bulletin, the Department of Homeland Security warns domestic extremists may try to exploit the easing of COVID restrictions to attack a broad range of targets. And now that the CDC has loosened its recommendations on masks, the National Restaurant Association is dropping its suggestion that fully vaccinated indoor diners should wear a mask, but it will be up to individual establishments to make their own rules. And tonight on the news, a look at the many different ways states and businesses are reacting to the new CDC guidance. Back to you, Wilf.
Melissa, thanks so much for that. Gaming stocks are rallying after Wynn Las Vegas announced it's allowing vaccinated workers to go back to work without a mask. Find out whether other casinos will follow Wynn's lead and help those stocks. We'll be back in a couple minutes.
All right, now I'm signing out. Probably won't be streaming next week. I will be away from my computer or traveling, so maybe the week after we will see. But otherwise, guys, I appreciate you joining this week. Adios.